Okay, good morning, everybody. Welcome. It gives me great pleasure to open the Inflation Drivers and Dynamics Conference for 2025. Let me welcome everyone here in the room in Frankfurt, and also welcome to all of the colleagues who are joining via live stream online. I think I'm very happy to say that we have a very rich program, both in terms of the topics that we're covering over the next 2 days, but also the presenters. And we have a wide representation across different regions, across different institutions, central banks. And as you'll have seen from our program, we have 5 sessions over the course of the next 2 days. So this morning we're starting with pricing and production networks. Then we also have a session on inflation expectations. Tomorrow we have firms pricing theory, and then we also have sessions on inflation and trade and inflation and monetary policy. Also, as you'll have seen in the program, we've got 2 poster sessions where we'll be covering the work of 10 very interesting papers. And we're also very happy to have our keynote speakers here with us also today. So we have Christiane Baumeister, who will be presenting later this morning on oil, inflation expectations and household characteristics. And we also have Gauti Egertsen, who'll be presenting tomorrow and on the question of when do deficits fuel inflation. I'm also very happy to say we have a policy panel after lunch today, so that'll be chaired by Benoit Moujon from the BIS. And on the panel, we have our ECB Executive Board member and Chief Economist, Philip Lane. We have President of the Federal Reserve Bank of Cleveland, Beth Hammock. And we also have the Deputy Governor for Banking and Markets, Dave Ramsden of Bank of England. So before we move to the first session, I'd just like to reflect that the last time we had this conference in Frankfurt was at the end of August 2023. So I think a lot has changed in the world since then. A lot has changed with inflation. At that time in the euro area, we had inflation still above 5%. We were still in this very steep disinflationary cycle where we were seeing, from 1 month to the next, a reduction of almost a percentage point in the annual growth of inflation. We were not at that time fully at the end of our tightening cycle. We had one more 25 basis point hike at the time before we reached our maximum rate in that cycle. And in the US at the time, inflation was lower than it was. It was around between 3.5%. They had already reached their peak rate in the tightening cycle at that point. So I think now, if we look today in the euro area, we're at 2%. The last couple of policy meetings, we've seen no change in our rate. Whereas in the US, inflation is a little bit higher. And also, as you're aware, the policy rate has been adjusted. So I think the next 2 days, both the research and also the policy panels, give us a very nice opportunity to be able to take a step back, to be able to hopefully understand and learn more about inflationary dynamics more in general, and also to understand not only how inflation outcomes can differ when shocks hit the economy, but also why and how they unwind at different speeds and paces. So bottom line, we're looking forward to learning from each other over the next 2 days, so that even if the world we're operating in is uncertain, that we can hopefully improve the way we forecast and also make policy in this environment. So let me close the welcome address by thanking you all for being here today. Thank you in particular to the team here at the ECB for organising a great event, in particular Iris and Linda. Thank you both very much. And yeah, on behalf of the organising committee, we're looking forward to a productive 2 days. Thank you all. Okay, so we're ready, as I said, to kick off session 1. I'm very happy to invite Michelle Gasiba to present the first paper, which is on business cycles and pricing cascades. That's joint work with Anton Nakov here from the ECB. Michelle, you will have 25 minutes for your presentation. I'll give you a warning on the time. And then afterwards, I'm happy to invite then James Costain will be discussing the paper. So, Michelle, I pass the floor to you, 25 minutes.
Can you hear me? Good. Yeah, thanks so much for this very generous introduction. It's a great pleasure to be here as always in Frankfurt. This is joint work with Anton Nakov from the home team, and the usual disclaimer applies for that reason. So what we're doing in this paper, we're trying to revisit the resurgence of interest in inflation that we observed in the last couple of years. And I think there are 3 particular aspects that have interested us. The first one is this whole idea that even in advanced economies where you have the entire infrastructure like inflation targeting to prevent inflation resurges, you can still get these gigantic increases in the rates of inflation. So in the euro area, in the US, in the UK, and so on, we've seen this persistent double-digit rates of inflation despite all the infrastructure that has been set up in place. The second key feature is that at the micro level, when you look at the origins of this inflation, a lot of it in advanced economies came from the surge in the frequency of adjustments. So it's not only coming from firms that are adjusting by more conditional on adjusting, it's also coming from a larger fraction of firms adjusting. And the third aspect is that the origins of this aggregate surge in inflation have mainly been sector specific. So shocks to industries such as oil, agriculture, and so on have contributed greatly to the overall increase in inflation. So all these three features are, of course, very important, but the unfortunate feature is that the sort of models that we have at our disposal that are popular both in academia and in central banks tend to be linearized models, so they cannot talk about large swings. They tend to be models with a fixed fraction of adjusters, such as Calvo model, and they also tend to be a one-sector model. You cannot talk about sector-specific drivers of inflation. So what we're trying to do here is to develop a new business cycle framework that can help us think about episodes of the sort that we've seen recently. So we really want to add the minimal set of ingredients to help us understand these features. Now, what are these minimal sets of ingredients? Well, we need a model with three things. First, we're going to have a model with many sectors interconnected by networks to make sure you can have sector-specific shocks that are propagating and causing aggregate fluctuations. The second minimal ingredient we need is state-dependent pricing. So we need the frequency of adjustment and more broadly all pricing moments to be endogenous and vary over the business cycle. And third, we need to solve them all fully nonlinearly. So abstract from linearizations to think about large swings. So that's the new framework we're going to develop. And then we're also setting up kind of benchmarks against which we're trying to evaluate the performance of this model. And there are three broad benchmarks or issues that we'd like this model to address. The first one, you cannot see here, the first real challenge is that a good model to think about inflation and quantities over the business cycle should be a model with a realistic non-neutrality of money or realistic slope of the New Keynesian Phillips curve. That's something we'll try to get in this model. And a big issue with this slope idea is that as soon as you match the slope, you usually need very big shocks to rationalize the inflation given that slope. So Jean-Paul Lullier here in the audience has a great paper about this point, that they always face this tension between slope of the Phillips curve and the sizes of shocks you need to generate a double-digit inflation surge. And that's something we'll try to address with our paper. The second benchmark is the ability to kind of match the micro origins of inflation. We want our model to generate a realistic surge in the frequency of adjustment without, of course, the usual problem associated with that, which is the implausibly steep Phillips curve that you usually get in models, say fixed menu cost model, that you need to match the surge in frequency. And the third benchmark against which we'll evaluate our model is the ability to achieve 1 and 2 with shocks that are structurally interpretable. So we want shocks, say to oil or to agriculture, that can be directly disciplined with the data. We want them to be able to generate this realistic surge in inflation given the slope, as we see in the data. So that's kind of the broad things we want to achieve in this paper. So the reason why the paper will, I think, pass all of those kind of tests pretty well, otherwise I wouldn't be presenting it here probably. But the reason why it's doing all right, I think, is because of a novel theoretical channel that happens to be so important that it made it to the title of the paper. And this mechanism is called pricing cascades. So what we define by pricing cascades in this paper is a situation whenever large movements in aggregates trigger additional price adjustments at the extensive margin. So that's just definition of cascades in this paper. And the nice thing about cascades is that it actually helps you both on the side of matching the slope of the Phillips curve and on the side of generating inflation with structural interpretable shocks. And how you do that? Well, key thing is that it interacts differently with different kinds of shocks. So as we show for demand shocks, such as monetary interventions, networks actually slow down movements at the extensive margin of adjustment. So they create what we call cascades dampening. The reason why that's happening is because in models with intermediate inputs with networks, nominal wages, or more generally, nominal prices or primary factors account for a small fraction of your marginal cost, the rest being accounted for by intermediate inputs. Demand interventions affect primary nominal prices or primary input prices. So whenever there's a surge, say in money supply or easing of nominal interest rates, you do generate this change in nominal wage, say, but it accounts for a tiny fraction of your marginal cost movements, which means your kind of desired price changes are small. So you're much less likely to be willing to pay the cost of adjustment, right? For that reason, even very big demand surges say coming from central bank interventions, are generating very little inflation in the aggregate because they affect marginal cost so little. And that's the reason the model will be generating a very flat Phillips curve, even in the limit of a fixed menu cost economy, which is usually be an issue for menu cost models. Now, at the same time, networks speed up or amplify the extensive margin after supply shocks. And that's called cascades amplification. To see why that's happening, again, let's consider a simple example. Imagine there's an aggregate GFP deterioration. This naturally, mechanically increases your marginal cost 1-for-1, and that would be the only effect you would get in a standard model with only labor in production. Now, with networks, there's another effect working on top of that, which is the prices of your suppliers that are going up in equilibrium. So you get like a double whammy increase in your marginal cost, coming both from the direct GFP deterioration and from the surge in your input prices. And this double whammy increase in your cost, of course, makes a desired price change very large, making you more willing to pay the cost of adjustment on the margin. And that's why you're really amplifying the extensive margin of adjustment, which in the aggregate helps you generate a gigantic inflationary surge of this kind we saw a few years ago. And crucially, you can do that without shocks that are too large. So moderately sized shocks, either aggregate supply shocks or shocks to sectors that are major and concentrated suppliers to the rest of the economy. I'll be very precise about the meaning of major and concentrated with a novel network statistics. That can help explain the aggregate surge in inflation as well as the surge in the frequency of adjustment. So that's really what's going on. The novel channel, which is generated by the interaction of the three additional ingredients, help us generate both a flat Phillips curve and a realistic surge in inflation with structural interpretable shocks. That's what the paper is about. Let me jump straight into the model. So it's a setup where you have households that are very standard. So you have a representative household with log linear utility and a cash in advance constraint. So the central bank will be controlling money supply, which we introduced through this constraint. Of course, we can extend this, as we do in the paper, to cashless limit with the Taylor rule and so on. But for today, it will be a cash economy. So consumers have like n sectors in their baskets, and there's a Cobb-Douglas aggregator over them. And then on top of that, within each sector, there's a variety of firms producing these differentiated goods. Key thing you should notice here, we introduce this idiosyncratic quality shock, zeta, which is kind of the thing that will be generating heterogeneity across varieties within the sector. Here, and this quality process follows a random walk in logs. Now, firms are more interesting. So each firm has access to a Cobb-Douglas production technology of the following kind. So the output of a firm J in sector I at time T has a few components. The first component is, again, the inverse of this idiosyncratic quality part. The second component is sector-specific productivity A. And then you have the labor input of that firm L and the intermediate inputs bought from the other sectors. Here, omega IK is the cost share that firms in sector I buy from sector K. That's the meaning of that parameter. Now, if you've solved the cost minimization problem associated with this production function, you get a marginal cost expression, which for me really summarizes the mechanism of this paper. So the marginal cost naturally rises in the quality of the variety, falls in productivity, and beyond that is some combination between the nominal wage and the prices of intermediates weighted by your exposure to them in the cost share sense. So again, to me, the form of this marginal cost conveys the key cascades mechanism that we really get in this paper. So how? Imagine I killed production networks. I only had labor in production. Then alpha will be 1, and all these omegas would be 0. In equilibrium with log linear preferences, wages equal to money supply. So money supply and productivity are isomorphic in their effect on the marginal cost up to sign. So if you have a doubling of money supply, or if you have a kind of doubling of productivity, that would have the same effect on the marginal cost up to sign. All right? Now, once you add these intermediate inputs, crucially, they are no longer the same, and they actually move in opposite directions in terms of the kind of amplification or dampening of the effect on the marginal cost. So now, if you have a doubling of money supply, it creates an increase in the marginal cost only to the extent to which wages affect the marginal cost, right? And since prices are sticky in equilibrium, they will not adjust by as much as the wage. So a doubling of money supply now creates a less than doubling of marginal cost. And that's what kind of dampens your desired price changes. At the same time, now if you have this deterioration in productivity, this still has a 1-for-1 effect on your marginal cost. And on top of that, the prices will go up in equilibrium, creating a double whammy of an increase in marginal cost, which amplifies the desired price changes and makes you, as we'll see later, more willing to pay the cost of adjustment in the margin. That's what's going on here. It's kind of marginal cost expression, which is driving the differential cascades channel. All right. Now, pricing is interesting, more interesting than before. So as I promised, we have state-dependent pricing. So resetting the nominal price involves paying the sector-specific menu cost kappa measured in labor hours. Okay, tiny technical points. Since both money supply and this quality are non-stationary, you need to keep track of stationary objects. The correct stationary object here at the firm level is this nominal price adjusted by quality and money supply, which we call the quality adjusted log real price. That's the stationary kind of micro level object, which allows you to Bellmanize the whole pricing problem. So you can say that the value of a firm in sector I at time t, which has just set this quality adjusted real price P, contains the contemporaneous profits D and the continuation value. The continuation value is saying that with some endogenous probability, you will not adjust next period. And if you do not adjust, you get the value associated with the eroded real price. If you do not adjust the nominal price, your real price will still change. It will change because it will be eroded by the quality realization and by money growth. With some complementary and endogenous probability, you will adjust your price, in which case you get the maximized value net of the menu cost. That's the Bellman equation associated with pricing. And of course, depending on the functional form of eta, this probability of adjustment function, you can nest a variety of pricing models. So if eta was a fixed number, eta bar, and kappa was 0, you'll be back in the Calvo model with the fixed probability of adjustment. In the paper, we can nest basically anything here. For perhaps pedagogical reasons, we'll consider the diagonal opposite of Calvo, which is the Golosov-Lucas menu cost model, which just says that the probability of adjustment is a step function, where you adjust with probability 1 if your value gained from adjustment exceeds the menu cost, and you adjust with probability 0 otherwise. But we can nest anything in between Golosov-Lucas and Calvo by appropriately parameterizing eta, and we can actually use that to match any kind of steady-state distribution of price changes that you like, that you observe in the micro data sets, such as Prisma here in the euro area. So to understand what is going on and exactly why you get in these cascades, let's consider a simplified version of the problem kind of in a static way. So let me kill foresight. Let me say that everyone is just myopic and discounts the future fully, in which case you can only focus on the initial time period. We know that in this world, the whole value is just contemporaneous profits. And we know that the kind of value of profit gained from adjusting your price is approximately quadratic in your price gap. Your price gap is kind of a deviation between where your price is now and where you'd like your price to be in the profit maximizing sense. That's the price gap. And then since the production function is Cobb-Douglas, we can actually analytically solve for the optimal reset price for any firm in sector I, right? So with the Cobb-Douglas production, the optimal real reset price for any firm in sector I is just 1 over the productivity of that sector times kind of this weighted average of your supplier's real prices, again, weighted by your input-output cost shares. And then we can plug this P star into the expression for the price gap, right? So in logs, the price gap now has 2 terms, kind of the more standard term, which we know from the menu cost literature, which is erosion. If you do not adjust your nominal price, your real price and your price gap get eroded by quality draw and by money supply growth. That's the standard part. The new part is that when you have intermediate inputs, it's also getting eroded by the productivity realization in that sector, as well as the movements in your supplier's prices. Why? Because both the sectoral productivity and your supplier's prices affect your optimal reset price, right? So if you do not adjust your price, but the reset price is moving, your price gap is also moving around, okay? That's the new part. Yeah. Now, as you notice, if I plug in this P tilde back into the value gain of adjustment expression, the only idiosyncratic component here is the idiosyncratic quality draw, which means I can explicitly solve for the inaction regions for each firm, which tell me whether or not I should adjust given some realizations of aggregate sectoral variables. We can do that, okay? So for monetary shocks, here's the expression for the inaction region. So if I kill, there's no supply shocks, only for monetary shocks, the inaction region is centered around kind of this money supply net of your supplier's real prices, and the width is governed by kind of the size of the menu cost. So imagine there were no networks and I increase my money supply, that would be the Golosov-Lucas economy. What happens is that your inaction region shifts to the left, and you can see that you need really extreme draws of quality, really extreme negative draws of quality to still not adjust, which means the probability of adjustment is going up by a lot, right? You see that the probability that you draw the idiosyncratic quality here in this new inaction region is tiny, right? That's what will be happening in the standard menu cost economy. Now, as soon as you add networks, the real prices of your suppliers are also moving, right? And to the extent to which prices of your suppliers are sticky, they will increase less than 1-for-1 with money supply, which means your real sectoral prices will fall after the money supply increase. And the fall in the real prices of your suppliers creates a counteracting movements in your inaction region. In other words, these sort of values of the idiosyncratic quality that you need to not adjust are not as extreme as before, right? So the probability of adjustment is rising, but it's not rising by as much as it would without networks. And that's the key reason why you get cascades dampening. And you can actually formally prove that this change in the adjustment probability that is coming from networks following a money shock M is approximately proportional to the customer centrality of each sector. In other words, the more you are exposed to intermediate inputs in the total sense, directly or indirectly, as captured by the customer centrality metric, by more will your probability of adjustment get shrunk by networks. That's the cascades dampening channel formula. Now, with productivity shocks, you get the opposite, right? So if there were no networks, productivity shocks are isomorphic to money supply shocks up to sign. So if there's a fall in productivity, the inaction region shifts to the left, right? That's the standard channel. But then on top of that, the real prices of your suppliers are going up, which means you get a further shift to the left of your inaction region. So you really need extreme draws of quality to still not adjust. Or in other words, the probability of adjustment is going up by really a lot following this supply shock. And again, you can formalize that by saying that the amplification in your adjustment probability following an aggregate TFP shock A is approximately proportional to your customer centrality. So the more exposed you are to intermediate inputs, the stronger is the amplification coming from networks. And that was for aggregate productivity shock. We can actually do this for sector-specific productivity shocks and study the effect on aggregate probability of adjustment. And you can formally prove that after a productivity shock to sector A, the response of aggregate probability of adjustment, economy-wide probability of adjustment, rho bar, is approximately proportional to a novel centrality metric called the supply-Herfindahl of the shocked sector. The supply-Herfindahl of the shocked sector consists of your average supplier centrality, or Katz-Bonacci centrality squared, plus a novel term, which captures the dispersion in other sectors' exposure to you as a supplier. So if you're really a disproportional exposure, kind of disproportionate supplier to some parts of this economy, so the variance term is high, conditional on some average importance, your ability to affect aggregate probability of adjustment will be stronger. If you really want to see which sectors are able to drive the aggregate adjustment probability well, the theory predicts that those are the sectors with the high supply Herfindahl, either major sectors or sectors that are disproportionately important to some parts of the economy. Let me just kind of summarize the theory part with a few simple examples. So if you had a simple roundabout economy with one sector, firms trading within that sector, you can see that if I kill networks and only had labor and production, monetary and productivity shocks are isomorphic up to sign, which means frequency of adjustment will kind of increase by the same amount as you start at different shock sizes. Now, as soon as you add networks, you can see that probability is rising by a lot less after money shocks. And that's the cascades dampening effect in action. On the other hand, it's rising super quickly after aggregate supply shocks, and that's the cascades amplification channel in action. Another simple example is a two-sector economy with an upstream sector and a downstream sector. So the upstream sector uses labor, produces intermediates, sells that to the downstream sector who sells output to households. Those sectors are equally big in equilibrium. They have the same pricing statistics. The only ex ante difference is their position in the supply chain. And you can see that whenever you shock the upstream sector, the aggregate frequency of adjustment is rising a lot faster than when you shock the downstream sector. And that's because shocking the upstream sector affects the marginal cost and the reset price, both in that upstream sector and in the downstream sector. But this does not work in the other direction. If you shock the downstream sector, you only affect that sector's marginal cost and reset price. And that's once again the cascades amplification channel in action. Finally, if you have this vertical supply chain, whenever you shock the more upstream sector, you affect marginal costs and reset prices everywhere else downstream, which means you can affect aggregate frequency adjustment by a lot, but not vice versa, which once again is the cascades amplification channel in action. In the final 5 minutes I've got, let me show you some quantitative results. So we calibrate this model to the euro area economy, where the aggregate parameters are very standard. The sectoral parameters are the input-output coefficients coming from world input-output tables. And we also estimate the sector-specific menu cost and standard deviations of idiosyncratic shocks to match sector-specific frequency and size of standard deviation of price changes from the Prisma dataset for the euro area. So for monetary shocks, the key picture is on the left-hand side. Here we study how the aggregate frequency of adjustment responds to money shocks of different sizes in economies with and without networks. And you can see that in the economy with networks, the frequency rises by a lot less, even after a very big money shock. And that just shows you that in a rich quantitative model, this cascades dampening effect is very strong, which is also translating to much stronger non-neutrality of money, even in the limit of a fixed menu cost economy with networks. So you can see that relative to the blue line, which is the GDP in the economy with menu cost and without networks, GDP responds a lot more strongly to money shocks. And perhaps another way to visualize that is to kind of scatter the fully nonlinear Phillips curve by kind of hitting your economy with money shocks of different sizes and looking at the implied combination of inflation and the cumulative output gap. You can see that in the Golos of Lucas economy without networks is basically vertical. In the Calvo economy is horizontal. And the Golos of Lucas economy with networks is actually closer to the Calvo economy than to the Golos of Lucas economy without networks. So that's really why you get this flattening of the Phillips curve as coming from cascades dampening. Aggregate TFP shocks, you get the opposite. So after supply shocks, aggregate supply shocks that are big, the economy with networks features a very strong surge in adjustment frequency, much stronger than without networks, right? Which translates into CPI inflation, which has a very nonlinear dynamic. So you see that even after relatively small aggregate TFP shocks, the economy with networks and menu costs delivers a strong surge in frequency, whereas the Calvo economy would require gigantic shocks, like minus 10%, to generate a 1% month-on-month inflation surge, roughly something we saw in the euro area post-COVID, right? That's the reason Calvo struggles so much to generate inflation with realistically sized shocks. Sector-specific shocks, we also shock kind of the economy with supply shocks to different sectors of minus 20%. Key thing for some sectors, such as food and beverages, chemicals, and so on, the economy with networks features a much stronger aggregate frequency surge, which really means networks are somehow amplifying shocks to these specific sectors, and it does not really amplify the other sectors' shocks so much. And what's really special about those sectors? Well, the theory section in the simple setup told us there was a supply Herfindahl being major and concentrated. And that continues to be the case in the rich model. When you plot the aggregate frequency surge against the supply Herfindahl, you can see a very strong linear relationship. So it's really about being major and concentrated, which is driving your ability to affect aggregate adjustment frequency. If you try to plot this with just Katz-Banach's centrality, so the standard supplier centrality measure, this would not work. So it's not enough to just consider average centrality. What matters is being central and concentrated. Final thing, in the last 1 minute, let me apply this model to think about euro area inflation. So what I'll do, I will feed in only 4 shocks into the model and see the extent to which the model can explain aggregate frequency and inflation dynamics. So I will feed in an aggregate demand shock coming from euro area nominal GDP. I will feed in energy and food price shocks as sector-specific supply shocks to match the energy price movements and food price movements. And finally, I will feed in a productivity process of the labor union sector to exactly match the earnings dynamics in the euro area. Once you feed in those 4 shocks, you can see 2 things. So just these 4 shocks can explain essentially the entire surge in inflation in the euro area up to 11%. So we're matching the peaks very well. And you can also match the surge in frequency extremely well. It was just 4 shocks without appealing to markup shocks, cost push shocks, or any other constructs of that kind which have no structural interpretation. Once you remove these supply shocks, the commodity price shocks, you can see that the model generates essentially no CPI inflation surge and no frequency surge, which means in the euro area, aggregate demand shocks and labor market shocks are really not enough to explain the inflation surge. You really need the commodity price movements to explain the inflation surge in the euro area. What if we remove various model sub-ingredients? If you remove the network structure but keep the menu costs, you can see that it can explain maybe 5% of inflation surge out of 11. So really, networks seem to be important. And you explain essentially none of the frequency surge. So just having menu costs but not having networks is really not enough to explain the inflation surge and the frequency surge. At the same time, imagine I kept the networks but replaced menu costs with Calvo. Well, then you can explain about 7% inflation out of 11. But of course, by construction, they explain not of the frequency surge because the frequency is fixed by construction. So just having networks gets you 7%, but the additional 400 basis points is really coming from the frequency surge, which you're missing with the Calvin model. All in all, you really need the combination of networks, menu cost, and large shocks to the supply to the commodity sectors to explain the euro area experience post-COVID. And I think with that, I will conclude. So I've shown you a new model which combines network, state-dependent pricing, and nonlinear solutions. It creates pricing cascades, which are extremely important for understanding the euro area inflation experience post-COVID. Thanks a lot.
Thank you very much, Michelle, for this great first presentation. Let me now invite James Costain to the podium, please. James is a research economist at Banco de España, and he will discuss the paper. So, James, you have 10 minutes. Thank you.
Okay, well, thank you very much. It's a pleasure to be here and to be discussing this this beautiful paper. Let's see. How do I advance these? There we go. Okay, so the way that I see this paper is that it's talking about a very old idea in macro theory, the idea that strategic complementarities are the key ingredient to make tiny frictions in price adjustment really matter at the macro level. And so we've known that in theory ever since, for example, the paper of Cooper and John, 1988. But that's always been a very difficult thing to actually make work quantitatively. So what I feel is that 30 years later, here is a paper that really quantitatively shows how the fact that my suppliers may not adjust at the same time that I do slows down aggregate adjustment in the economy and thereby increases non-neutrality. And on the other hand, Michelle was also showing that this allows the response to supply shocks to speed up, create this cascade, and have a large effect on inflation. Okay, so these are actually old ideas, but it's a tremendously challenging thing to finally model in a quantitative way, because what it's doing is it's putting together two extremely technically challenging literatures. That is to say, the state-dependent pricing literature required the whole development of heterogeneous agent macroeconomics in order to implement that, and then at the same time, this is also all based on the literature on macroeconomic networks, another heavily technical area of macro literature. So we're putting together these two frameworks, which by themselves are each difficult to work with, and at the same time, the authors are not losing track of the data. This is not just a theoretical example. It seems to me that it is quite close to really being a quantitative description of what's gone on, particularly in over the course of the COVID pandemic. Okay, so main findings: input-output relationships really matter for aggregate dynamics, and they matter in a very different way for demand shocks and for supply shocks. Okay, so in particular, price adjustment in response to monetary shocks is slowed down by the networks. In response to productivity shocks, it's sped up by the network relationships. Okay, the authors show that these effects are really strongly non-linear. There's a huge difference in the shape of the impulse response to a 1% shock versus, say, a 10% shock. The authors derive analytical formulas for which sectors in the economy matter. That's what they call network centrality. And then they do a simulation of post-COVID inflation. They show that they can get the the size of the fluctuations roughly right, and that all of these model ingredients are really needed to do that. Okay, so just very, very briefly, how do they make this whole complicated model tractable? Well, first of all, it's because of this log linear utility framework. There's going to be a constant marginal disutility of labor, and so then that allows you to make the wage essentially exogenous. The wage ends up being a shock that equals the money supply in equilibrium, right? So that's just treating an important part of the economy as a shock. But what it allows you to do is then endogenize all of the price dynamics through the network. So their economy has an empirically relevant number of goods producing sectors, and within each sector, there's a continuum of firms. Each firm produces one variety, and each one is subject to menu costs. So then aggregate consumption is an aggregate across sectors. Likewise, the inputs to any firm are an aggregate across sectors, okay? It's the same aggregation. So basically, all of that stuff aggregates up in a tractable way. Likewise, aggregation over firms it's the same for consumption and for materials inputs, and so again, it's tractable. And then the other very nice thing that they do is that they have one sector they call the labor union. So the labor union is the only sector in their model that buys labor time. So workers all sell their labor time to the labor union. Then the labor union is a state-dependent pricer, just like the others. So it pays a menu cost to adjust the salary, and so that gives you sticky wages. Okay, and so they can then look at how that's the ultimate upstream sector. They look at how that propagates through the economy as well. Okay, all right. So one of the really nice things about this paper is that they give these analytical formulas for how adjustment frequency varies in each sector. And so I'm just showing you the formula, not that I can explain it at high speed, but this expression is written in a way such that the log Markov, now the log markup mu bar on average is 0. So after a money shock, assuming that that your input suppliers do not all immediately adjust, your markup is going to fall. Okay, and so mu bar is going to become negative, and that's why you get a negative term in here that is offsetting the money shock M, and so that will give you the dampening effect on money supply shocks. Okay, so the formula is very similar for the case of TFP shocks. It's just that then all of the network related terms enter with the opposite sign. But basically, instead of having the money shock M, you have the TFP shock A, and then the terms go on the opposite sign, go with the opposite sign. So you get exactly the same analytics for both types of shocks. Okay, so Michelle explained this very well. So I guess the only thing I would say here is that when we look, what exactly is being shown in this diagram, the initial movement without networks means setting the input shares from all sectors to 0. So that includes, for example, the share from the labor union. Okay, so the case without networks is setting all of the omegas to 0, and it's setting alpha, the labor share, equal to 1. So in the economy without networks is simultaneously eliminating all of the network heterogeneity, all of the inputs, and all of the labor supply from the labor union. So it's mixing a bunch of effects, okay, which is fine, but it would be nice to separate some of these things. Okay, all right. I have to get to my final comments because otherwise I'm not going to have time. So so input-output structure is very important here, but as I was just saying, the demonstration in the paper really hasn't separated out the effects, and it would be extremely interesting to know how much of this is driven by wage stickiness, how much of this is driven by the existence of inputs with sticky prices, and how much is driven by the heterogeneity of the structure of the network. Okay, and so there are some nice exercises that you could do. So, for example, imposing BASU-style roundabout production, that just means setting all of the omegas equal, except for the one on the labor union. Okay, that would be a very natural exercise to report. You could put it in the same graphs, and it would help a lot. Why is that useful? Well, I like the realism of this heterogeneous setup, but if other people are going to apply this, they're not going to want to do the whole heterogeneity thing. They're just going to want wages, inputs, and so forth. So that would be a much easier model to work with, and it would be very interesting to know, do you get most of your effects or not? Okay. So a second major suggestion is, it's nice that you show that you can make the Golosov-Lucas fixed menu cost framework work, but I feel that the goal of this paper is actually quantitative realism. So if you're going to do quantitative realism, why work with a setup which we know does not match microdata on prices? Okay, so I'd be much more interested to see some sort of setup with a smooth hazard function. Anton and I have written down some possible microfoundations for smooth adjustment hazards, but there are many possible microfoundations for that. We know those things fit the data better, so why not make that your base case? And in fact, Alvarez, Lippi, and Oskolkov have shown in principle how you can back out the right distribution of stochastic menu costs to match any observed price distribution. So I'd make that your base case. Put Golosov-Lucas in the appendix. And then the last thing is, this paper has a ton of useful exercises. It has both toy examples and serious quantitative examples, but what it really doesn't have is a lot of testing. So the one part of the paper that really tests the mechanism is the final exercise about matching COVID dynamics. I like that very much, but that only asks whether your mechanism works at the aggregate level. What I'd really like to see is, can you test your model against sectoral evidence? So like you showed that there's this relationship between Herfindahl's and adjustment probabilities, but if I'm not mistaken, that's the relationship in your model. If you can give evidence for that in the data, then this paper would have a much greater possibility of publishing as well as I believe it deserves to be published. So this is a fantastic paper. I believe it will be very influential, but it's still a work in progress, and I think there's stuff that could be done. Thanks.
Thank you very much, James, for that very lively discussion. Let me then just invite people in the room and also people online via Slido to, if anyone has any questions now, that we can take them. And then I'd ask maybe Michelle to respond to James and any other questions that might be in the room. Maybe I could ask it very quickly. I was interested, first of all, great paper, really liked it. What is your intuition on, say, global value chains? So I would imagine that this should, if you've got, say, a more domestic supplier base, then the demand cascades would be, let's say, less dampened, I would say. But what does that mean maybe on the supply side? What's your intuition? If we're moving to a world where you've less global supply chains, how would that influence the model predictions, do you think?
Right, and thanks a lot for this question. Let me probably address yours and then get back to Jim's points. So I think the intuition for the global value chains would be that if you're becoming less exposed to labor abroad, essentially, then wages in China or wages somewhere abroad are less relevant for your marginal cost. And what becomes more relevant is the wages domestically, which are controlled effectively by the central bank. So in that sense, if you're moving to a less globalized economy, this cascade dampening effect should be stronger. So you'd be getting a flatter Phillips curve coming from you leaving global value chains. I think that would be the prediction that, yeah, cascade dampening will be stronger if your supply chain is becoming less global, because domestic wages will become more important for your marginal cost. And then coming to Jim's points, let me probably address the first one. So on the roundabout economy, I agree that would be fantastic to have some benchmarks with Basu-style economies. We know that formally the adjustment frequency are approximately quadratic in those centralities. So we know that if you collapse an economy down to a one-sector economy with some average centrality, by Jensen's inequality, it will not be the same in terms of frequency movement. So we can show formally that heterogeneity matters for aggregate outcomes. But I agree that we could perhaps play with some diagonal input-output structures which are more tractable. Yeah, we can also remove wage stickiness to see how important that channel is for the Phillips curve shape. Smooth hazard pricing, well, with Anton on the paper, is a bit of a crime to not have that. And if there's one person who knows how to implement that exactly, it's Anton. So we should definitely do smooth hazard pricing, especially if we could try and use that to match sector-specific distributions of non-zero price changes, not just specific moments, by entire distribution shapes. I don't know if the Prisma dataset could give us sector-specific histograms for distributions of price changes, but if we did have that, we'd be able to fit smooth hazard functions sector by sector to address that point. On the empirical evidence front, I think, again, if from the Prisma dataset, we can get a time series for the sector-specific frequency of adjustment, we could regress the sector-specific adjustment frequencies on measures of centrality and see if it is indeed true that if you're a sector with a higher customer centrality, condition on a monetary shock, your frequency is moving by less, and vice versa for aggregate supply shock. So I think here the constraint is really the availability of sectoral frequency data, which we'd love to get from the institutions collecting that. But overall, thanks so much for the fantastic discussion and for the question.
Thanks, Michelle. We actually have another question from Jean-Paul in the room, and
Peter.
Then Peter afterwards.
So in terms of Golos of Lucas versus Calvo Plus, I actually think Golos of Lucas is the right starting point for the paper, because, you know, what you want to know is, you know, you start from this very difficult benchmark in terms of fitting the aggregate data and how much networks and, you know, all the amazing stuff that Michel and his co-author do is how much does it bring to the table, how much you can improve upon that. You know, I think the search for a model that is going to match everything is a little bit futile for me. You know, we know all models are simplifications of reality, and I feel the point of the paper is to show us, starting from a very clear benchmark that we understand in the literature, how much these new techniques can bring.
Thanks so much, Jean-Paul. I mean, I agree that, should I respond to this now or should we wait for the second question? Peter, right? Okay, let's collect the two questions and I'll comment.
Thanks. So Virgilio Madrigal recently made a point that most of these models have a problem matching inflation and frequency relationship. Mm-hmm. So that recently what we saw, a 10% inflation and around 20% increase in the US, might be Golos of Lucas is kind of the best, but mm-hmm. It's still not good enough to actually match this. So is your mechanism helping in matching this fact?
Yeah, let me actually collect these two questions and they're related. So I think that's precisely the point. So the one of the point of Virgilio's recent paper, and I think Jean-Paul's related paper too, is that it's a bigger problem with sticky price models. So the models that help us explain the frequency surge, such as Golos of Lucas, would predict counterfactually steep Phillips curves, and vice versa. Models that predict realistically flat Phillips curves, so stochastic menu cost models or Calvo, would really struggle with fitting the frequency. So that's precisely what we're hitting here. Our argument is that a model can simultaneously give you the flat Phillips curve, even with Golos of Lucas pricing because of cascade dampening, while at the same time being able to explain the surge in frequency and inflation without sacrificing the Phillips curve slope. That's precisely our point. That we help resolve this kind of big picture puzzle in the sticky price literature, which is the relationship between slope and the ability to match inflation with realistically sized shocks. That's what we're really fitting here.
Thank you. Could you please elaborate on the role of the energy sector in amplifying the costs, the shocks? In the discussion on euro area inflation, you hinted at the role of commodity prices. I haven't seen it in your slide with sectoral evidence, but maybe it was too fast. But it would be very important if you think that this is indeed very central and if it stands out in amplifying supply shocks. Thanks.
Yeah, thanks a lot for this question. So we do 2 commodity price shocks, one to energy and one to food. Quantitatively, I believe that food is actually more important than energy in explaining euro area inflation surge in the aggregate. Perhaps one exercise we have not done is to feed in the shocks one by one, separate just energy, because of course the shocks need not be additive in nonlinear models. So it's not clear how much of it is the 2 shocks acting together and kind of reinforcing each other, and how much each of them is important on its own. So perhaps we could either feed in energy and food separately, or perhaps more correctly, we should take them out one by one to kind of do the counterfactual, what would happen without that one specific shock. So I think in a non-linear setup is better. I think that would be the quantitatively correct way to answer your question.
I think we have one last final question, and then we will close. Thank you.
Now, I just wanted to follow up on this. You said that food would be more important than energy. I'm just, if you could elaborate a little bit on that, because if you look at the numbers, I think back in 22, it looked like energy, at least the direct impact, was more important than food. But was it the propagation? So if you can just elaborate a little bit on that.
Yeah, so we're saying it's not the absolute sizes of price change in those sectors that were different. So for sure, energy price surge was much bigger than the food price surge. What we're saying is that the propagation of those increases in commodity prices to the aggregate CPI inflation are not proportional to the shock sizes. So although energy had a bigger price increase in that episode, the effect of the price increase on aggregate inflation in the euro area was smaller than the effect of the smaller increase in food prices. So food and energy per percent change in the price seems to have a stronger effect on the aggregate. And if you go back to one of the slides where we show you the supplier Herfindahl's, the reason is that food and energy tends to be a sector that is more concentrated in its importance as a supplier than energy. So energy is very important on average, but its supplier Herfindahl is not as large as that of food. That's the reason why. And again, that's also the reason why it would be amazing to test it in the data. So if we could really identify exogenous shifts in prices of commodity sectors, which I think would be feasible to the extent to which we believe they're exogenous to the euro area, then we could see whether the supply Herfindahl is a good sufficient statistic to predict the effect on aggregates. But again, I think that's another empirical exercise we could do to really solidify that point.
So thank you all. Thanks especially to Michelle and James for this first great paper. And I will then open the next paper, please. And that's by Giacomo Candian. Giacomo is an associate professor in HEC Montreal, and he'll be presenting a paper on uncertainty through the production network, which is joint work with Matteo Cacciatore. Giacomo, please, you have 25 minutes.
Thank you for this nice introduction and for putting the paper on the program. So I don't think I need to say a lot on the motivation for this paper. We have seen how recent events have highlighted the importance of sectoral shocks for the inflation dynamics, in particular the inflation dynamics that we've seen after the pandemic. And I think by now we have a good understanding of how first moment shocks transmit through production networks. There's a lot of work that has been done and that continues to be done. See Michelle's presentation, for example, and how these shocks create aggregate fluctuations. We want to switch the focus a little bit on an angle that hasn't been studied so much, which is how supply chains transmit the effect of another type of shock, which are uncertainty shocks or second moment shocks. While this is highly debated in policy circles and financial circles, for instance, what is the implication for supply chains of sector-specific trade tensions, financial instabilities, or even regulatory changes, we don't have a lot of evidence of how this uncertainty propagates through production network and what are the aggregate effects. So we're going to try to fill in this gap in this paper, both empirically and theoretically, by trying to answer questions such as, how does uncertainty that spurs in a particular sector of the economy affect production, prices, and uncertainty also elsewhere in the network in connected industries? And what are the macroeconomic effects of this uncertainty, and are they dependent on where this uncertainty started to begin with? Let me say in advance that this is answering this question is quite challenging because, of course, any source of aggregate uncertainty that you may imagine using to answer these questions will not work because aggregate uncertainty contemporaneously affects different sectors of the economy and would not allow you to trace the effects of sectors of shocks through the network. So our first challenge that we need to overcome is to construct sectoral measures of uncertainty, and we're going to do that using option microdata that are available for all the options that are traded on US exchanges on this beautiful data set called option metrics. We're going to construct uncertainty measures at the most fine level that we can, which is Nike's 4-digit. This is the most disaggregated level at which we have consistent data on employment, prices, and input-output linkages. And of course, then we're going to need to identify variation in this uncertainty that we can use as true shocks. So this is going to be uncertainty that is orthogonal to first moment shocks and to uncertainty that arises in connected sector. So the first challenge is familiar to anyone who has worked on uncertainty, how difficult it is to disentangle uncertainty from first moment shocks. But the second challenge is our own challenge when we think about uncertainty having a more granular sort of origin. So with that, we're going to estimate dynamic responses of employment and prices to these shocks to see how this uncertainty affects the industry where it arises, but also other industries that are connected in the supply chain. And we're going to study also its aggregate effect. Finally, we're going to build a new Keynesian production network model with time-varying sectoral uncertainty to interpret the results that we see in the data. Let me preview my results and hopefully I can get to all of them. So higher uncertainty we find is contractionary and inflationary in the sector where it originates. So employment falls, but producer prices in that industry go up. The effects of these shocks are not confined to that sector, but they propagate through the supply chain and in asymmetric ways. First of all, uncertainty in one sector creates uncertainty also in upstream and downstream industries. And on top of that, uncertainty propagates upstream like a negative demand shock, whereas it propagates downstream like a negative supply shock. What I mean by that is that when uncertainty increases in one sector, the suppliers of that sector experience a fall in employment and a fall in prices, as if hit by a negative demand shock. Whereas the customer industries of that industry affected by the uncertainty shock instead experience a fall in employment, but an increase in prices, as if hit by a negative supply shock. At the aggregate level, these shocks are contractionary, but I guess most crucially for this conference, they're going to be inflationary only to the extent that they arise in upstream industries. And this highlights how central bankers that want to tackle the effect of uncertainty shock need to take into account the network dimension of the shocks. The theory is going to highlight how production linkages are essential to understand the upward and downward propagation of the shocks as well as its aggregate effect, because what production linkages do is to translate changes in input demand and in marginal cost into changes in demand or cost for suppliers and customer. And it's also going to reassure us that this type of effects arise both when this uncertainty is on the supply side or on the demand side of the industry. So we touch on, I think we are at the intersection of two literatures, one that studies the effect of time-varying uncertainty, but we take a more granular perspective on this, which allows us to study the network propagation of the shocks. There is, of course, a large and always expanding literature that studies the macro implication of production networks, but so far, not so much work has been done on the propagation of second moment shocks, so we hope we can inform that discussion. There are a few papers out there on sectoral or the production network of network dimensions of uncertainty. I think what we bring to the table is a high frequency identification of sectoral shocks that can really tell us how these shocks propagate through the network, and then evaluate that through the lens of a new Keynesian model. So without further ado, let me get into the data and our empirical results, and then a few words on the model. So the data that we use is firm level implied volatility of US stock options that are issued between 1996 and 2009. If you're not too familiar with IV, this is the conditional variance of stock returns over the life of the option. This is a measure of uncertainty that is fairly well known and used in the uncertainty literature. It's a forward-looking measure of uncertainty. It's available at high frequency. And for this particular project, we also found out that it's got extensive sectoral coverage at the next 4 digit, which allows us to do the analysis that we want to do over here. Let me stress that option implied volatility is different from realized volatility, which instead reflects past changes in stock prices, and it's more closely related to first moment shocks. I'm going to exploit this idea to try to disentangle the effects of first moment shocks. We're going to focus on all the options that are equity-based at the money with 30 days maturities, because these are the most liquid options that we have in our data set. And I'm going to constrain the sample in some ways to make sure that these options are representative of the sectors. But in the end, I'm going to work with 6,300 firms that are going to cover over 100 industries, about 120. So I'm going to have a lot of sectors that I can work with. My sectoral level of uncertainty is going to be, as baseline, a weighted average of the implied volatilities across firms within a given sector. You can see the formula here, where the weights are given by the previous month market cap share of that firm within the sector. So the idea here is that we want to capture the common uncertainty that affects these firms within a given sector, by also taking into account the disproportionate impact of large firms within a sector. We obtain very similar results if we use previous year sales share, and we have also alternatively tried to use the first principal component or a time fixed effect within an industry, and results stay quite similar. This is something that I can construct at the daily level. We're going to go to the monthly level by taking the last 5 trading days of the month average of this measure. So think of this as really the end of the month implied volatility for that particular sector. And we're going to define analogously a measure of realized volatility over the month by using realized square returns for the firms in a sector. Here's a few properties of these measures that I constructed. The top panel is basically showing you how much the sectoral measure that we have constructed explains of time variation of firm level implied volatility of firms within a given sector. So this is the R squared of regressing firm level implied volatility on a sectoral measure. As you can see, our measure explains over 2/3 of this variation when we don't control for aggregate implied volatility. Of course, when we add that control, the explanatory power drops to some extent, but we still can explain at least 25% of this variation. So this is the sense in which our measure is a good representation of a common component of implied volatility of firms within an X4 digit. In terms of how it behaves, this series behave over the business cycle, you can see that there is a strong correlation with aggregate uncertainty on average. There is a mild negative correlation with industrial production that varies across different sectors. At the 10th percentile, it's minus 30%, and it's almost 0 at the 90th percentile. And then it's basically not really correlated with inflation, although Some industries are a little bit on the left or on the right of the zero. These measures are also correlated pairwise to 0.87%. So that tells you that there is co-movement across this series, but there is still some part that is idiosyncratic to each sector. That's the part that we're going to try to exploit in our empirical analysis. So what we would like to do would be to run a local projection of the following type, where we regress outcomes such as employment and prices on these measures of uncertainty. But of course, these measures are endogenous. They can respond to sector-specific or even aggregate first-moment shocks. Think about when commodity price rises, that by itself increases uncertainty in industries that are energy intensive. So that's something we'll need to deal with. But given the sectoral dimension, we're going to have to deal with the fact that uncertainty could rise elsewhere in the production network, in supplier and customer industries, and there's also movement in aggregate uncertainty. So the first thing that I want to do is try to control for supplier and customer industries uncertainty. The way that I do this is by combining the uncertainty measures that I have for my industries with the total requirement input-output tables. So I'm following the Acemoglu playbook here in defining supplier uncertainty as being a weighted average of the uncertainty of the industries from which I take intermediate inputs. And these are going to be weighted by the fraction of output that I source from that particular intermediate in its Leontief inverse form to capture also indirect linkages. Similarly, I'm going to construct customer uncertainty for industry I as a weighted average of the uncertainty from the industries that use my own output, and it's going to be weighted by the output, the fraction of output that is demanded by those industries. So here is our first stage regression that is basically going to take that measure of uncertainty that I have constructed before. And the idea here is going to be to try to control for all those confounding factors that I mentioned a couple of minutes ago, and basically extract this residual new IT, which is going to be our sectoral uncertainty shock. So we're going to try to control for first moment shocks by controlling for realized volatility, not only at the sector level, but also in the suppliers and customers of the industry in question. This is exploiting the identification of Berger, Dubecker, and Giglio that say that realized volatility is reflective of first moment shock and can affect contemporaneously uncertainty, but the reverse is not true. The average effect of an uncertainty shock on realized volatility should be zero. So that allows you to control for first moment shocks by controlling for realized volatility. The idea here is that basically when there is an uncertainty shock that increases stock prices, for example, realized returns would go up. But if you take an uncertainty shock that does the opposite, that lowers stock prices, realized volatility would still go up because realized volatility is realized return squared. So the average effect of an uncertainty shock on realized volatility should be zero. So that justifies the control. On top of that, I can use the constructed supplier and customer uncertainty to control for uncertainty arising in connected industries upstream and downstream. Here we're going to exploit the timing as well, constructing these measures using the only first 16 days of the month to have the information there not overlap with our left-hand side, which was constructed using the last 5 days of the month. And then I can also control for aggregate implied volatility, which is going to take care of aggregate uncertainty. So in the end, we're going to, this is some of the data that we work with. We have several industries that are either very upstream, very downstream, or in the middle. Upstream industries are chemical manufacturing, iron and steel. Downstream, we have motor vehicle manufacturing, insurance, and healthcare. In black here, you see the raw measure of uncertainty for all this series. So as you can see, there is a lot of time variation in all this series that is also in some cases quite idiosyncratic. And then the red line is the residualized shocks that we have from this first stage regression. So you see that our controls absorb a lot of the variation in this time series, and we're left with these idiosyncratic spikes that are basically our proxy for this uncertainty shock at the sectoral level. In the paper, we do some analysis to not only convince the reader that these shocks have good statistical properties, they're not autocorrelated, they have a very small cross-sector correlation, but the largest of the shocks coincide with regulatory changes or financial restructuring or technological transformation, trade tensions that increased uncertainty in those particular sectors where we have identified them. So with those shocks in mind, we can go back to our local projection and see what happens to uncertainty, employment, and prices, not only when in response to the shock happening to that own sector, but also to suppliers and to customer shocks that are constructed with the same weighted average idea that I mentioned before when I was constructing the measures themselves. I have some controls, of course, for lags of shocks and lags of the outcome variables. So this is our key result at the industry level. Let me guide you a little bit in reading this picture. So at the top row, I have the response of uncertainty, in the middle, that of employment, and at the bottom, that of prices. And now going through the column, in the middle column, I have the response of an uncertainty shock in its own sector. And then to the left, I have what happens to the suppliers of the industries affected by the shock, and to the right, what happens to the customers. So here I want to make 3 points. The first is that the uncertainty shock increases uncertainty not only in the sector of origin, but also upstream and in downstream industries. So there is a direct propagation of uncertainty to customer and suppliers industries. The uncertainty shock reduces employment, but increases prices at the sectoral level. These are producer prices. So we're going to see that this in the model is going to be explained by a precautionary pricing motive by the firms that are exposed to an uncertainty shock. But you can certainly come up with other reasons why firms facing uncertainty may want to increase prices. This price increase is going to affect also customer industries that you see here to the right. And these customer industries are experiencing a fall in employment and an increase in prices. This is consistent with the fact that they see the price of their intermediate inputs go up, and so they experience a negative supply shock that manifests as a fall in employment and an increase in prices. To the left, instead, you see that the suppliers of the industries affected by the shock experience a fall in employment and a fall in prices. And this is consistent with lower demand for intermediate inputs from the firms affected by the uncertainty shock, which results as a negative demand shock for suppliers upstream. When we think about the aggregates, what are the aggregates effect of this shock? We're gonna, and given the different inflation dynamics that we saw at the sectoral level, what's gonna happen to inflation? So to answer this question, we're going to aggregate these sectoral shocks up by basically period by period, taking an average of them weighted by the market cap share of each sector. So that's going to be basically an aggregate sectoral uncertainty shock. And we're going to use local projection to see what happens to aggregate uncertainty proxied by the VIX, employment, and to prices. And here the answer is that these sectoral shocks, on average, they increase uncertainty persistently, they reduce employment, but they don't really have a strong impact on core CPI, on inflation that you can see to the right here is not moving very significantly. But given that we saw differential price movement in different sectors in response to the shock, it makes sense to ask whether inflation responds differently, whether uncertainty originates upstream or downstream. And to achieve this, we basically condition this weighted average of sectoral shocks to be happening only in the top upstream decile or only in the bottom upstream decile. So this is basically only industries that are in absolute terms very upstream or very downstream. And this is perhaps our key aggregate result. When the shocks are happening in the top upstream decile, the response of inflation is persistent and significant, whereas when it's happening downstream, this inflation response is significant on impact, but then it becomes not significant. So the takeaway is that uncertainty shocks are inflationary when they happen upstream in the network, but they are contractionary all the time. In the last few minutes that I have, let me tell you that we developed a new Keynesian model with input-output networks and time-varying volatility to try to rationalize these facts and to understand the mechanism behind this. So the model is relatively simple. Aside from Epstein's in preferences, I have a household that maximizes utility from consumption and leisure. Consumption is a bundle of the output produced by different sectors of this economy. Labor is supplied to different sectors of the economy and is imperfectly substitutable across different sectors. There are firms that produce differentiated goods in a monopolistically competitive fashion. They face Calvo-style price stickiness and a production function that uses labor and intermediate inputs that are going to be they're going to be complement. So it's going to be a CES production. These inputs are coming from the other sectors of the economy, similarly to what Michel had. And every sector is going to sell this output either to final consumption or to the other sectors of the economy. Monetary policy is going to be very standard. It follows a Taylor rule that responds to inflation. And the most novel part of this framework is that the process for sectoral TFP is going to be shocked by changes in the volatility for this shock. So this is the shock that we consider a second moment shock to sectoral TFP. I'm going to show you what happens in a 3-sector case of this model where the production network is linear. So sector 1 provides intermediate input to sector 2, and sector 2 provides intermediate input to sector 3. And I'm going to shock with an uncertainty shock the sector in the middle, which is sector 2. So basically, you see in this impulse responses that the new Keynesian model with production network replicates these results that we have in the empirics. In particular, the sector 2, which is the sector hit by the shock, experiences a fall in employment and an increase in inflation. This is due to the precautionary pricing motive by which firms that face higher uncertainty, in order to avoid being stuck with a too low price in the future, they decide to increase prices today. The increase in prices today is going to reduce demand for output from sector 2, and this is going to reduce the demand for employment, which results in equilibrium fall in employment in sector 2. This is not the end of the story, though. Of course, these shocks via these production linkages transmit upstream and downstream. So upstream, the fall in demand for employment is going to come also with a fall in demand for intermediate input, which results in a fall in employment in sector 1 and a fall in prices in sector 1. So that's the propagation that we saw happening also in the empirics. And in sector 3, this inflationary effect that happened in sector 2 is going to increase intermediate input prices in sector 3, which are going to basically experience an increase in marginal cost. So employment is going to fall and inflation is going to rise in sector 3. The model also has different prediction for aggregate inflation, whether this uncertainty shock hits very upstream or very downstream. So if it's hitting sector 1, the response of inflation is delayed and persistent, whereas if the shock hits in sector 3, then there is a bit of an increase in inflation initially, but it's very short-lived. So that's also in line with the data. And keep in mind that these effects that I'm describing here are the dominant one that happened in this model. But of course, in the background, there is also precautionary pricing across all the sectors of the economy. There is a precautionary saving motive that would tend to reduce demand across the board. So that would be deflationary across the board. And then there is precautionary labor supply that would tend to push employment up across the board. But the network propagation channel is the dominant channel. This is what the lesson comes out from this particular model. So let me conclude by saying that we have studied uncertainty shocks and how they propagate through supply chain, asymmetric transmission upstream and downstream, which results in differential effects of at the aggregate level, depending on where the shock originated. So these shocks are very inflationary if they originate upstream. And I think there are important lessons for macro policy design because, of course, if the position in the network matters for the output and inflation dynamics, then this is something that a central bank might want to take into account. And it matters not only for uncertainty shocks when they arise by themselves, but also when they are stemming from first moment shocks because they may exacerbate or dampen the inflation output trade-off. So I'll leave it at that, and I look forward to Ephraim's discussion.
Thank you very much, Giacomo, for that great presentation. Now I hand the floor to Ephraim Castelnuovo, who's Professor of Economics at University of Padova. Ephraim, you've got 10 minutes. Thank you.
So thank you very much. It's a pleasure to be here and to discuss this fantastic paper. So Giacomo made a fantastic presentation. So the recap is going to be a little bit redundant, but anyways, so the paper is about the role of sector uncertainty shocks and their propagation through a production network. And there's basically two main contributions. The first one is empirical. So what they show is that a conditional shock hitting, say, sector J, that sector is going to experience inflation and a drop in employment. Sectors that are downstream are going to experience the same, so inflation and a drop in real activity. Sectors that are upstream are going to experience a drop in inflation and employment. So you see that there's a drop in real activity across the board, while the response of inflation depends on the position of the network, the sector, apologies, on the network line. Now, theoretically, what they do is to propose a framework to interpret this stylized fact. The framework is a framework with features, well, the usual characteristics of a new Keynesian framework with network. And this is my overly rich, I guess, figure, which is their very neat one plus my notes. So sector 2 is the one that is hit by the uncertainty shock. And this sector experiences inflation because of precautionary pricing in the first place. So firms fear future marginal costs that might be high, and so they increase prices today in order to avoid running negative profits. Okay, so this increase in prices is going to spill over to downstream sectors because sector 2 provides inputs to sector 3. Okay, so these inputs are more costly, and therefore sector 3 now experiences higher marginal cost, and therefore inflation goes up there too. Okay, output goes down in both sectors because of higher prices and precautionary savings, as Giacomo said. Now, from sector 2 to upstream sectors, there's a lower demand of inputs from 2 to 1, therefore a drop in marginal costs in sector 1, drop in inflation there, and drop in output too. Okay, so you see that there's different effects, more supply or demand effects, depending on what sector gets the spillover, actually, and the position of the sectors in the production line. What I like about this is that precautionary pricing is key, and precautionary pricing is being shown in several papers to be an empirically relevant transmission mechanism among the many that might transmit uncertainty shocks. And so it's a model that kind of, well captures some characteristics of the data, I will say. Now, I like the paper very much, I have to say. There's different merits there. One is the shift to sector uncertainty. As Giacomo said, we don't know much about the effects of sector uncertainty shocks. The second one is that it clarifies the nature of uncertainty shocks, which are not necessarily demand shocks, as previously thought by the literature. And then I believe that the theoretical intuition about downstream and upstream sectors hit by sectoral shock can be applied more generally to more global realities, if you want, but that's actually for other papers, I suspect. So my two main comments, we revolve on the idea of a true regime inflation view, so the fact that normal times might have certain features that are different with respect to high inflation regimes, and if I have time, policy recommendation in this new Keynesian frameworks. Okay. So to regime inflation view. So we know that some policy institutions out there during the pandemic put out the idea of, well, different dynamics of inflation when you are in normal times as opposed to high inflation regime. Okay, and I see some people smiling here. I guess I can identify as people here, but let me proceed with that. So why am I saying it's your regime inflation view? So I'm kind of thinking of the relationship between uncertainty and inflation. Okay, and here I'm sticking to the VIX, so an aggregate financial uncertainty proxy and core inflation. And there's basically nothing in the sample they analyze, which they also comment on in the paper. And this nothing, by the way, in light of their paper, can be seen as there's a lot behind the scenes. Okay, so there's no correlation apparently in terms of aggregate financial uncertainty, aggregate inflation. But behind the scenes, there might be a lot of inflation and deflation, upstream and downstream sectors. And there's a canceling out effect so that we don't see matching if there's a lot. Okay, and in fact, as he showed, there's no correlation with inflation, but there's correlation with the VIX out of sectoral uncertainty shocks. And so that might be a way to interpret this correlation. Now, this correlation changes dramatically if you go to the pandemic. It becomes clearly positive, okay? That's conditional on inflation realizations being above 4%. It's not just a correlation. I got a paper with Gianni Pellegrino and Laos Sarkier, where we try to document the different effects of macroeconomic uncertainty shocks when inflation is low versus high, if you want, okay? And as you see, left column, the response of CPI inflation industrial production is not particularly large when you're in normal times, the response to a macroeconomic uncertainty shock. But when you are in an inflation regime, the response is much larger, okay? And that's conditional on the same size uncertainty shock. So it's not a matter of larger shock or smaller shock. Okay? So this would be like a conditional, if you want, interpretation of the unconditional correlation I showed you before. Now, this change, this switching correlation, say, leads me to ask Giacomo and Matteo a couple of questions about the potentially time-varying role of sector uncertainty shocks. No? So, and here, what I mean is what sector or sectors are more relevant during the pandemic, were more relevant during the pandemic as opposed to normal times, and if common shocks due to a variety of global shocks that we know occurred, materialized during the pandemic, might have taken a larger role during the pandemic itself with respect to sectoral shocks per se. Okay, we might more like an empirical orientation to these questions. Then from a theoretical standpoint, I'm kind of wondering if we think, if we want to study, say, high inflation regimes, if we can take their model right away like it is and apply it to the pandemic. And there's two elements that I'm thinking of here. The first one is state dependence of the price setting, and the second one is trend inflation. Okay? So state dependence here, there's this paper by Antonova, the urgent market paper, which shows that upstream sectors tend to have more flexible prices, but downstream sectors have price flexibility that is more state dependent. So when there's large shocks, they adjust much more, okay? So I'm kind of wondering if during the pandemic, these large shocks that hit a variety of economies actually might have led perhaps downstream sectors to adjust much more and therefore contribute to this positive correlation between uncertainty and inflation I was talking about before. Okay. The other consideration is about trend inflation. There's Guido Ascar here, so I'm trembling a little bit because the master is in the room, okay? But as he told us, basically, when there's trend inflation price, well, in general, no matter, well, forget about uncertainty shocks for a second, when there's the possibility of reoptimizing, firms do so, and do so by increasing their prices more than they will do in the absence of trend inflation. Because they have to chase this price index that grows over time, so they know when they reoptimize that the erosion of their relative price is going to be faster than in the absence of trend inflation. Now, we have a model without sectoral heterogeneity where we apply this concept to uncertainty shocks, as a matter of fact. Okay, and with uncertainty shocks, there's this precautionary pricing, as Giacomo very clearly explained. So firms already have an incentive to increase their prices with trend inflation even more. This is like a toxic combination between trend inflation and uncertainty shocks. Okay, and so in a model without sectoral spillover, there's no sectoral heterogeneity. I repeat, we are able to replicate the jump in inflation and a large drop in output that it seems to be occurring in pandemic data. Okay, that doesn't mean that there's no role for spillovers or sectoral heterogeneity, but it would be nice to understand how to apply Giacomo's model to this high inflation regime. Okay. I guess it's -1 in terms of remaining time, but given that I'm Italian, I'll go ahead until I'm kind of blocked by the police. Oh, 2, fantastic. Okay, so policy recommendation here. So it's interesting that they have this model where there's a simple monetary policy role, and I would like them to use it to some extent to tell us something about policy. And policy is difficult, and optimal monetary policy condition uncertainty shocks even more, okay? But so something that we know about optimal policy when it comes to uncertainty shocks is that even if they look like supply shocks, they don't necessarily induce a trade-off for the central bank, okay? Inflation up, output down, strict inflation targeting makes it. That's the idea. And the intuition is that basically strict inflation targeting is such a threat to firms that you're killing precautionary pricing. You're killing basically their willingness to increase prices. Their expectations remain anchored, and therefore, there's no problem under certain conditions without particular rigidities in these frameworks, okay? Frankly speaking, in their model, I wouldn't know, in the sense that their model is intriguingly sophisticated to some extent. And so it's going to be difficult to design, I guess, optimal policy. But simple simulations with differently calibrated Taylor rules, conditional on aggregate inflation, as opposed to different sectoral inflation rates, might perhaps tell us something on like the direction to take when it comes to designing optimal policy. Although, again, it's an heroic exercise, I understand, but, I will kind of at least think for a second if to do it or not. Okay. Wrap up. It's a beautiful contribution on sector uncertainty and inflation. There's two main points, I guess, in my discussion. One, think about normal times as opposed to high inflation regimes. The pandemic is the example, okay? And exploit their model to think about policy recommendations. If you work on uncertainty, you get to read this paper. That will be my take about it. Thank you very much.
Thank you very much, Ephraim, for that very engaging discussion. I'll open the floor now for questions, comments also online. Yeah, please, a question at the front.
So do you really need to take Calvo super seriously for this pricing, precautionary pricing mechanism to hold? So for example, because, I'm thinking, the idea that a firm will adjust its price today because she's scared that tomorrow she's not going to be touched by the Calvo fairy on the shoulder, it's, in the end, we know that in reality, it's a nice model, but we know that in reality, a price is a choice, and changing your price is a choice. So what would happen if I had a menu cost model in mind, for example, like if you change your price today because you're scared, then you might anticipate that tomorrow you're not going to have to change your price again if you were wrong to be scared. So you will end up paying like a double menu cost. So might be that actually firms decide not to adjust their prices. So is the Calvo assumption crucial? How do you think about it?
Another question at the middle.
I love how option pricing is making its way into macro. One might think that when you use option implied volatility, you're masking the effect of uncertainty because options incorporate a risk adjustment as they are priced under the Q measure. So we know that this is a problem, for instance, for the VIX that incorporates a part that we call risk aversion. This is commonly measured as with the variance risk premium. So if you think that risk aversion in firm level options doesn't vary over time, then you're safe. If you think that maybe investors, the marginal investors in these firm level options have different levels of risk aversion across firms, then taking the principal components of these volatilities is fine. You get an aggregate or sectorial level of measure of uncertainty. If this is not the case, though, you might get into trouble, and some of the results might mask indeed the effect of a risk aversion shock. How are you thinking about it? I'm thinking, typically people construct forward-looking measures of volatility under the P measure by just forecasting realized volatility. This might be something that you can do also for with firm level options. Thank you.
Perhaps I can start addressing some of this very interesting question. Regarding the Calvo assumption, Jean-Paul, so it's I think we know from the literature that the strength of this precautionary pricing depends quite a bit on that. So if you have a model with, say, Rothenberg adjustment, then the precautionary pricing is going to be different, typically not as strong. It depends on the monetary policy rule as well. So so the strength of that channel depends on the Calvo assumption. What would happen in a Calvo in a menu cost model? I followed your reasoning. I think you're on the right track, but I would need to think a bit more on that to see exactly what would happen. And it's putting it into the model would be, I think, fairly challenging because we're already solving this model to third order in order to be able to get the effects of uncertainty. So having that extra also non-linearity in there would be challenging, but I think it's a good question, and I can say that as Ephraim mentioned, there is evidence in the literature for this precautionary pricing motive, which is the reason why we decided to go that way. But there are also other stories that one can come up with to justify the increase in the prices when uncertainty goes up. Think about stories of financial frictions where when there is a higher uncertainty in a sector, perhaps external financing becomes more expensive, and then these firms might want to pass on that increase in the cost of financing to their customers. So that would be sort of the Gilchrist way of thinking about it. Coming to the question about options. I'm happy to bring options to the macro crowd, but I'm also a macroeconomist, so I'm also learning about options as I go through the process. I spent some time on this idea of the risk premium. So you have anticipated part of my answer, which is that if this risk premium is constant or basically constant across different sectors, then what we're doing is fine. The concern is, of course, if it's time varying. And I think so far what we can say is that we have a series of controls in this first stage regression that includes realized volatility in that sector. We have aggregate uncertainty there with a sector-specific coefficient. All these coefficients are sector-specific. So to the extent that this time variation correlates with some of the controls that we have in that regression, namely realized volatility and sector-specific or aggregate uncertainty, then we would be taking care of that. But I'm happy to talk more offline of other ways of taking care of that. Yeah, and coming to Ephraim's a beautiful discussion. Thank you so much. I think the thinking about the state-dependent effect of uncertainty and high inflation regime versus low inflation is a great suggestion that we can explore both empirically and theoretically. Empirically, there is a lot of we can do with this local projection framework, just concentrating on certain states. But I also want to stress that our uncertainty shocks are showing that uncertainty itself has very different implications for inflation. So I think here one has to be very careful when one wants to establish the causal effects, because is it the uncertainty that's generating different inflation regimes, or the other way around? It's I don't think it's an easy question to answer, but it's certainly a worthwhile one to explore. In the model, we can certainly talk to Guido for introducing trend inflation. I haven't gone that far yet, but the policy exercise to think about different Taylor rules and how that would affect the propagation of the shocks is certainly something that we can manage even with the current technology. Let me say that like you brought up some intuition that, of course, if you have inflation targeting and you kind of kill this precautionary pricing motive, so in a representative agent, a representative firm economy, this is all fine. Of course, here I think things will be more complicated, because not only targeting the aggregate inflation is not necessarily going to prevent firms in a particular sector of the economy from adjusting their prices. And if they do that, then this whole upstream and downstream propagation begins. So I think the picture is going to be more complicated there, also in terms of what happens to the output in all these different sectors. So let me see if there are more questions. Guido? Yeah.
Thank you very much. I'm not going to talk about trending features, about this uncertainty shock at sectorial level. No, when I saw many of these papers about uncertainty shock, usually there is a slide or a figure with some narrative interpretation spikes. So I just wonder if you have some external validation of these shocks. So there must be, you have a lot of sectors, but at least some of these spikes that you can put some narratives to externally validate what they are, because in my mind that is a bit difficult to figure out. Thanks.
Yes, so we do some of this in the paper. So this was a short presentation. I didn't have too much time to do that, but yeah, we investigate some of these large spikes, and some of them are associated with, for example, regulatory changes that are very industry specific. So, for example, there is a case in the insurance industry where there was a ruling by the New York attorney who basically declared as fraudulent some of the ways of compensating agents that these insurances were using. And you can see, because then we can go firm by firm and see what happens to their option implied volatility. We see this spike as basically each of these firms is basically backing off from this type of payments to their agents in the future. And this basically increases uncertainty about their whole business model, because a lot of it was basically centered around this. We have a few other cases. It's a bit difficult to be exhaustive here because we have over 100 series, and we cannot just do 140 graphs with dates. But I think, yeah, we should. I think it's a good suggestion to bring up at least a few examples to convince the audience. Yeah, thank you.
Thank you, Giacomo. I think if there's no other questions in the room, maybe I just ask one quick question. I was interested because you look at employment and inflation. You don't consider wage setting dynamics in the model, or do you? And I'm just wondering how that would potentially change your results, because I'm thinking of even examples in the euro area of certain sectors who are, say, the auto industry hit by inflationary shocks, and maybe then workers are more willing to, let's say, take a real wage cut in exchange for maybe job security. So I'm just wondering, have you considered that as a channel when you're looking at employment and inflation?
No, but that's a great suggestion. We basically put in the model so far, I think, the minimal set of the ingredients that we needed to explain the empirics. This precautionary pricing is the reason why these uncertainty shocks have any real effect in the model, because the model has no capital. There is no forward-looking decision other than price setting, given the nominal rigidity. But I think it's very interesting to consider also, as we explore the model a little more, the effect of different wage setting and how that could shape the transmission of the shocks. So thank you.
Thank you very much, Giacomo. So let me now thank both Giacomo and Efren for great presentations. And we will break now for coffee, and we'll resume again at 11. So let me thank all four presenters for a great morning session. Okay, welcome back, everybody. So just while you're all taking your seats, just to introduce the final paper in the first session, which is being delivered by Ina Hajidi from the Federal Reserve Bank of Cleveland. She's a research economist, so we're very happy to have her with us here today. Ina will be presenting a paper on supply chain networks and macroeconomic expectations of firms. So Ina, you have 25 minutes. The floor is yours. Thank you.
All right, thank you so much, Sarah, and very excited to be here. So this paper is joint work with Saten Kumar, Samrin Malik, Jordan Norris, and Matthew Pedemonte, and the usual disclaimer applies. Okay, the literature has shown that macroeconomic expectations and uncertainty, they are important drivers of aggregate fluctuations. And moreover, a number of serious papers recently have documented that the macroeconomic expectations as well as uncertainty of firms can induce changes in firms' decisions, key firms' decisions such as prices, investment, employment, wages, and so on and forth. However, we know that firms operate in production networks, and a few recent papers, they have shown that incorporating or accounting for these production networks can have important ramifications for the transmission of monetary policy as well as the transmission of aggregate shocks. What this also implies is that then shocking the macroeconomic expectations or the uncertainty of a singular firm is going to have spillover effects onto the expectations, the uncertainty, and actions of other firms on the production network. Then that is exactly what we're after in this paper. We're going to try to quantify these spillover effects, and we're also going to try to uncover the underlying mechanisms. And as a spoiler here, I'll say that these spillover effects, they're large, and they can be as large as direct effects. And we're going to show that the inter-firm communication is the key mechanism behind such large spillover effects. What are the contributions of this paper? Well, first, the paper is going to implement an RCT experiment in what we think is a very novel setting, and I'd like to use this figure to visualize what we're really doing. So instead of applying an RCT on singular firms, where one would basically randomize firms into a treatment versus a control group, we're going to instead apply an RCT on pairs of firms. Right? So we're going to randomize assigned pairs of firms into treatment versus control groups. Within the treatment group, given a pair, we're going to provide an information treatment to only one firm, say firm A in this figure, and then we're going to estimate the effects of that information treatment, not only on the expectations and the actions of firm A itself, but also on the expectations and actions of firm B that firm A is connected with via supply chains. And of course, the whole analysis will be conducted relative to pairs in the control group. Given this setting, then, we're able to estimate the spillover effects of macroeconomic expectations and uncertainty on the expectations and actions of firms in the production network. We'll be able to uncover the mechanisms behind the estimated spillover effects, and then using a production network model similar to RUBA 2023, complementing it with uncertainty and a communication network, we're going to be able to study the role of communication for the transmission of output expectations and uncertainty for firms' pricing decisions, as well as aggregate inflation. What do we find? So the key main results of the paper are that first, higher expected future growth causes firms to increase prices and employment. However, higher uncertainty about future growth will cause both main and connected firms to lower prices, lower employment, and lower investment, pretty much acting like a negative demand shock. These spillover effects on the connected firms will be nearly as high as the direct effects, and as I mentioned earlier, the inter-firm communication is the key mechanism. Through the lens of the model, we're going to show that communication symmetrizes the transmission of uncertainty shocks upstream and downstream, and it amplifies the impact of macroeconomic uncertainty on inflation. However, it does reduce inflation persistence. The paper is related to three strands of literature. It's connected to those papers that have been documenting the effects of macroeconomic expectations on optimal decisions, to that branch of the literature that has been studying the effects of aggregate uncertainty, and the set of papers that has been studying the role of networks for macroeconomic expectations and outcome. And I'll keep it short to jump immediately to the data. So the data is coming from a two-wave survey of firms managers conducted in New Zealand in 2024. Firms are characterized as pairs of customer main supplier. In the first wave, we're looking at about 1,000 surveyed pairs. In the second wave, there is a little bit of an attrition, so we'll be looking at fewer surveyed pairs. We'll be observing data on firms and managers' characteristics, as well as communication between firms, on top of eventually the data coming from the RCT experiment. So at a high level, the RCT experiment goes as follows. First, we're going to randomize pairs of firms into 3 groups, a control group and 2 information treatment groups. We're going to elicit prior expectations and uncertainty about future growth of these firms, as well as their plans on prices, investment, employment, and wages at the firm level. Then we're going to provide groups of firms with some information. One group of firms will be given information about professionals' real GDP growth forecast in New Zealand. Another group of firms will be given information about professionals' uncertainty around future real GDP growth. And eventually, there's a third group that will be receiving no information treatment. After this, we're going to elicit firms' posterior expectations and uncertainty about future growth, both at the end of the first wave as well as in the second wave. And in the second wave, we're also going to gather information about firms' actual changes in their prices, investment, employment, and wages over the past 3 months, so that this would be the intermittent period between the first and the second survey. And of course, we're also going to gather quite a bit of information on the intensity of communication between firms in a pair. What about the empirical strategy? The empirical strategy really relies on having these treatments move around firms' expectations and uncertainty about future output growth, right? And once we have that, we're going to use the exogenous variation in firms' posterior expectations and uncertainty about future growth to isolate the effect of those onto the firm's actions, such as prices, investment, and so on and forth, not only for the directly treated firms, but also on the firms that the directly treated firms are connected with. And finally, right, given all this, we're going to use different data to inspect the mechanisms behind the spillover effects. Okay, so on the first step, we're going to try to see what are the effects of treatments on expectations. Right, so the way that we're going to do that is by regressing posterior expectations or uncertainty on the prior expectations or uncertainty at the firm level, a treatment dummy, as well as the interaction of the treatment dummy with priors. Now, all we care about here is that we get gammas and thetas that are statistically different from 0, especially so for the thetas. And the way that I'm going to show you the treatment effects is by making use of a few figures. So what we're looking at here are basically the treatment effects on both the directly treated firms in the left-hand side and the connected firms on the right-hand side in the baseline first wave period. Right? What these figures are showing is basically scatter plots between prior and posterior GDP growth expectations. In the left-hand side, eventually, you have the control group whose posterior expectations are pretty much well aligned with their priors, right? They didn't receive any information treatment, so that's to be expected. The firms, however, that did receive some information treatment, eventually they are updating their posterior expectations, so they move away from the priors, right? So there is a flatter relationship between the posterior and the prior expectations for the treated firms. Going then to the connected firms, this is the first wave. There is no way that they're being exposed to the information treatment. Hence, as anticipated, it has to be that the posteriors and the priors, they're pretty much aligned for these connected firms. Moving on then to the follow-up period and focusing on the connected firms. Now, the connected firms that are that were connected with the firm that was treated in the first wave, their expectations, they're behaving very similarly to the expectations of the main firms that were firsthand given an information treatment in the first wave, right? So now we see that the information treatment has diffused somehow to the connected firms in the second follow-up period. Okay. What we show in the paper, and I don't have it here, is that the effects of these treatments on the posterior expectations as well as on the posterior uncertainty of the connected firms, they are very similar to the treatment effects of on the posterior expectations and uncertainty of the main firms. Right, so it's almost as if the connected firms were first handed this information treatment, even though they were not. Okay, now we know the treatments, they're moving expectations around. Okay, so we're going to take advantage of that to try to figure out what is the effect of expectations and uncertainty on firms' actions. Now let's start with the main firms because that's the easier one, and the literature has already worked quite a bit on the procedure, so it's relatively standard at this point. The idea here is that we want to isolate the effect of those posterior variables on the actions, and the way that we're going to do that is by instrumenting those posterior variables using the exogenous treatment that comes in them that's being induced by the treatments. Okay. When we look, however, at the connected firms, things are a little bit more complicated because now the treatments, right, they can affect the actions of the connected firm not only via the expectations of the connected firms, but also via the actions of the main firm, right? So what we have to do here, in addition to controlling for the posteriors eventually, we need to also control for the actions of the main firm, okay? And here, just like as we do for the posteriors, for the action too, we're going to use a similar strategy and make use of the exogenous variation that's coming in the actions of the main firm from the treatments alone that firm is being exposed to. The other remark that I want to make sure that I bring up here is that the instrumental variable for the posterior variables, the posterior expectations, it's coming from treatments that were given to the main firm, right? These connected firms, they were not directly from us exposed to any information treatment. What do we find? This table is showing the effects of posterior output growth expectations and uncertainty on key firm decisions, price, investment, employment, and wages. In the first row, what you're seeing is that higher expected output growth typically induces firms to raise prices and employment. However, higher uncertainty about future growth makes firms want to lower prices, lower investment, lower employment, and we don't see any effects whatsoever on wages. The other important thing to note here, comparing the first and the second column, the third and the fourth, the fifth and the sixth with one another, shows that the magnitudes of these effects for the connected firms, they are nearly as large as the magnitudes for the main directly treated firms. So what's happening here, right? We're giving an information treatment to a firm that I've been calling the main firm. We see in the follow-up period that the expectations of both the main firm that was directly treated and the connected firm, they're moving very similarly to each other. And on top of this, we see both types of firms, the main and the connected, they're acting similarly in response to the change in the expectations that was initially induced by treatments. So all in all, what we're observing is that these spillover effects, they're at least second round spillover effects, right? They're nearly as high as direct first round effects. Where are these coming from then? So let's go back and look at the posterior expectations of the connected firm, because that's where we see the first changes or the first reaction of the connected firms happening to the information treatments. The posterior expectations of a connected firm, they can move, we think of, because of two channels, two mechanisms. One is that the directly treated firm simply communicates the information that, or some form of the information that was given. The second channel is that the directly treated firm acts on the new information. Its action is observed by the connected firm, and the connected firm, in response to that, updates its expectations and then further updates its actions. We can disentangle these two channels using equation number 4, where we can look at the variation in the posterior expectations and uncertainty of a connected firm J that can be explained by the posteriors of the main firm versus the actions of the main firm. Okay, and what we're going to see, and here I'm hiding a few of the other actions undertaken by the main firm, but I promise you there is nothing significant there if I were to show that to you. So what I want you to take away from here, focusing on columns 1 and 3, is that it's really the posterior expectations or the uncertainty of the directly treated firm that's moving or that is explaining the changes in the posterior expectations and uncertainty of the connected firms. The other key thing to note here is that if we failed to control for the expectations of the main firm in columns 2 and 4, we would wrongfully conclude that it's maybe the prices of the main firm that are explaining the movements in the posterior expectations of the connected firms. Highlighting once again the importance of firms' expectations to try to understand really what's happening here. Indeed, the data shows that treated firms talk a lot more about output growth than firms in the control group. What you're looking at here, if you focus on the red histogram, is that the majority, over 60% of firms in the control group, they report to never have talked about real GDP growth in the intermittent period between the first and the second wave, whereas firms that have been treated, right, they have been talked at least once about real GDP growth, taken all of them together in the intermittent period. So it is really the case that treated pairs of firms, they are talking about real GDP growth. The communication channels are already there. What the treatment is doing is really switching a little bit the topic of conversation for firms in a pair. Now, one might think that, well, you know, maybe there are some strategic considerations in how you think about communication. Maybe a supplier has different incentives to communicate than a customer. We don't find that to be the case. The way that we're going to see that is by creating this triple interaction variable where H main there is going to be a network specific characteristic of the main firm that has been directly exposed to the treatment. That characteristic would be, you know, the firm is a supplier versus a customer. It would be the number of its customers or suppliers, and so on and forth. And as you can see in the table at the end of the slide, we don't see any significant effect coming from that. So it seems that communication, that suppliers, right, they communicate as much as customers. Indeed, again, looking back at the data, we see that treated suppliers, they communicate with their customers as often as treated customers communicate with their suppliers. Okay, and what this figure is basically showing is the treatment effect on GDP communication for supplier versus customer in under both treatments, and we don't see any significant difference between the two. So all in all, what the empirics seem to show is that higher expected growth leads to higher prices and employment. Higher uncertainty about future growth leads to lower prices, lower investment, and lower employment. These spillover effects, they are as high as direct effects, and the connected firms, they seem to be affected primarily because the directly treated firms communicated some version of the information treatment, which we don't know exactly which version, but we know that is some version of that information treatment to the connected firms. And there's no evidence of strategic motives in communication. With this, then, we wanted to understand what is the role of communication relative to a world without communication for firms' pricing decisions and ultimately inflation. And so the way that we're going to do that is is very simple. We're going to take the production network model of Rubo 2023 and just the price setting part of it, rewrite the Phillips curve in terms of price levels. For the sake of argument here, we're going to think of the sector as being a firm. And we're going to take a very partial equilibrium view on this, right? Where output growth will be given. We're just assuming that it follows some IID process, but it has two components. A deterministic component, mu star, which if I were to observe a super large amount of data on mu star, it would just behave like an IID process, and an epsilon. Iterating this equation forward becomes very clear that expectations about output growth, whichever is your favorite version of slack in the economy, is important for current pricing decisions. Okay, now, given that the results on uncertainty are very salient in our empirics, we wanted to think of uncertainty in this framework, but we also wanted to keep things linear. And the only thing that we could come with was assuming that firms are facing Knightian uncertainty about the deterministic component of output growth, and that they are averse to such ambiguity. And Ilut and Schneider, they have an AR paper that is extremely insightful that tells you how to deal with this form of uncertainty while maintaining the framework of a linear model. All we care about eventually is expectations about output growth of these firms. The firms are assumed to receive some information about forecasters' uncertainty about future output growth from where they can extract a signal about the worst possible scenario of output growth from the forecaster's point of view. They'll use that to update their expectations about output growth. And let's not forget, there's also communication happening between firms. We'll discipline that via communication network matrix C, where Cij indicates the intensity of communication from firm J to firm I. In the end of the day, the final expectations about output growth of a firm J will just be a weighted average of all the posterior expectations of any other firm that firm J is trading with. In the paper, we derive a series of theoretical results, and eventually, depending on what you want to assume on the communication matrix, that can really tell you what types of results you're going to get. So we wanted to really go quantitative and let the data inform what the model implies. And so what we do in the quantitative exercise is start with the 3-firm model. We have a firm 3 that is representative of customer firms. It purchases inputs from firms 1 and 2. Firm 2 is a supplier firm in the network. It purchases inputs only from firm 1. And firm 1 pretty much represents the rest of the network. And here what we do is simulate the response of prices to a one-time signal, a one-time shock to the expectations about output growth of firm J, while varying input shares in the IO matrix, and consider 2 scenarios: a scenario when there is no communication whatsoever, and a scenario when there is even communication, no strategic consideration in communication. Everybody communicates with everybody else equally. What I'm showing here then is a distribution of initial price responses to output uncertainty in the left panel when the treatment is originating from the supplier firm, and in the right when the treatment originates from the customer firm. Now, there are 2 things to note here. First, when there is communication, the distribution of prices on impact is the same, regardless of where the treatment is originating from. Why? Because even communication is basically making a private signal become a public signal, and everybody becomes aware of it. Everybody responds to it, and really the heterogeneity that you're seeing is just heterogeneity driven by other structural differences in the firms, because they have different frequency of price adjustment and so on and forth. The other key thing to note is that communication really reduces the dispersion of price responses to a treatment, right? Why? Because now you're pretty much killing the dispersion in prices that is coming because of dispersed information. Now, let's look at the evolution of prices and inflation when treating customer firms. Now, of course, in the absence of, and I think this has been a point that was raised in the earlier presentations today, in the absence of communication, eventually shocking the customer firm, we should not see lots of effects on the prices of the supplier firms, right? However, when there is communication, things change quite a bit, right? As you can see in the left panel, where we're plotting the evolution of the price responses when there is communication in red versus when there is no communication in blue. And as you can see, prices across all firms, they respond a lot more to this shock about future output growth when there is communication versus when there's not. In turn, and this was somewhat clear maybe from the previous graphs too, we also see that communication eventually really reduces the dispersion of price responses. When there is no communication, different firms' prices, they're reacting differently. And it takes a while for those prices to converge to the eventual new aggregate price level in the economy. What this means then for inflation is that in the presence of communication, we're going to see a much higher impact of output uncertainty on current inflation, but that is going to be very short-lived, right? Inflation will return back to steady state almost immediately. When eventually there is no communication, it's going to take a while for things to wash out, for the shocks to, for the private shock to play out in the rest, not only in the firm that was initially exposed, but also for firms in the rest of the network. So inflation is going to take a while, a few more periods until it gets back to steady state. So then macroeconomic implications and some food for thought. What we show is that communication symmetrizes the transmission of uncertainty shocks upstream and downstream. It can amplify the impact of firm-specific shocks about macroeconomic uncertainty on inflation, but also reduce its persistence. And I didn't go into details about this in the slides, but we have something about this in the paper where we show that accounting for firms' expectations becomes particularly important when estimating structural parameters such as the Phillips curve slope. And interfirm communication is a key channel through which firms' beliefs propagate. And we think that this might also be helpful for policymakers to design alternative communication strategies. And I'll leave the concluding remarks here because I know that I'm running out of time, and I look forward to Tiziano's discussion.
Thank you very much, Ina, for that great presentation. Now let me invite our discussant, who's Tiziano Ropelle from Banca d'Italia. He's an advisor in the Economic Research Unit. Tiziano, you have 10 minutes. Thank you.
Yes, thank you, and good morning, everyone. It's a great pleasure to be here at this conference and to discuss the paper by Ina and co-authors. And let me start with this slide that shows a simple Bayesian learning equation that tells us how agents learn and firm expectations. And it says that a posterior belief is just a combination of a prior belief and a signal. And depending on the precision and the relevance of the signal, the coefficient G can either increase or decrease. Now, I start with this simple equation because this equation is at the core of many empirical studies in the literature on the formation of expectations of agents. And this literature in the past few years has expanded enormously along many different directions. And the direction they pursue in this paper is very innovative and is on this matter. So they acknowledge that agents interact and that they can learn from each other. So they do not learn in isolation. So you have two sort of Bayesian learning equations, and they can interact. Now, to be more specific on the paper, the goal of this paper is to study how firms firm expectations and how they diffuse information along a supply chain. And to study this matter, they ran an RCT using a surveys on New Zealand firms and they focus on pairs of firms, customer and suppliers, belonging to a supply chain. And as Ina has already said, only one firm in each pair, in each treated pair, is actually treated, whereas the connected firm is not. And the treatment is the provision of information about GDP forecast of professional forecasters in terms of mean forecast and a measure of uncertainty. And the main empirical findings are the following. So they document some direct effects whereby treated firms revise their macro expectations and also revise their actions. And this is already established results in the literature. But they also document some spillover effects, whereby also connected firms revise their expectations and also revise their actions. And the effects are similar in magnitudes. And so this is a sign of a strong diffusion of information across agents. And they argued that the channels through which these happens is through direct communication about firms. Now, let me go through a set of comments, mostly on the empirical part of the paper. So on the experimental design, so the experimental design in this paper is very clean and executed accurately, but that it builds on a simplification. Namely, they focus just on pairs of firms, customer and supplier firms. But in reality, supply chains are longer and are more complex, and information, while traveling along the chains, can deteriorate. So information might undergo a sort of metamorphosis. So I would like to read in the paper like a richer discussion on what might be the limits of focusing just on pairs rather than taking into account a richer structure of the supply chain. And also connected to this comment is the identification of the causal effects, because they bring about some causal effects of information provision. And one precondition is the no cross-pair contamination. So you don't want the control group to be contaminated by the information provided to the treated firms. So they check these precondition by looking at the pairs. But of course, if the supply chain is richer than these, you cannot rule out ex ante these contamination. So it would be interesting to see in the paper like a description of how complex is the supply chain in New Zealand. Okay. Another common problem in survey data is the response rates. So in this paper, as in many others, the response rates are not that high, especially in the second wave. There's not much you can do ex post. Of course, there is a problem of representativeness and also external validity of the results, but there's not much you can do at the moment. But perhaps to ensure the robustness of your results, I would at least include in the specification for when using the data from the second wave some characteristics to check the robustness of your results. Let me go to the second comment on the treatment effects on expectations. Okay, so already showed us that information treatments affect the main firms, but not the connected firms during the first wave, whereas in the second wave, the treated firms continue to be affected, and so they revise their expectations, but also the connected firms, they are affected. This is a very innovative and powerful result, in my opinion. But there are some sort of concerns. One is that the effects between the main and the connected firms are really similar to each other. So the magnitude is pretty much the same. And I guess that in the paper, the version I read, that there's not much discussion on why these happens. And again, I would like to see perhaps more discussion on the descriptive statistics about the prior and posterior distributions of these expectations, of these macro expectations. That might help also to gauge the magnitude of these effects. turning to channels. So they explore two channels. One channel is through the observation of the actions put in place by the main firms. They rule out the relevance of this channel. And I would say also that ex ante this was not, in my opinion, very reasonable in the sense that to infer correctly the actions of the treated firms, the connected firms should have also observed the plans of the main firms. So, okay, this channel is not the key channel. The second channel, they say, is the direct communication among firms. Okay, and they provide some evidence. It would be interesting to see if the effects you document somehow could move with the intensity of communication across firms. So are those firms that communicate more, the effects are stronger for those pairs that self-report to have communicated more. But then I want to perhaps discuss another channel that might also explain the results. The fact that upon receiving the communication about the GDP forecast, perhaps firms become active in searching for information about GDP. Okay, so there is a channel that goes through this active information selection. It might be just pure coincidence, but I put GDP in Google Trends in New Zealand in the past 5 years, and as you can see, there is like a spike exactly during the second run of the survey. This is, anecdotal evidence, of course, but something. But the policy implication of this channel operates could be different, or at least complement the other policy implication. So maybe the policymakers shouldn't target, in terms of communication, the systematic firms in the network, but perhaps make sure that firms, agents have access to reliable and accessible sources of information. So these are, another angle to see this result. Supply chain collaboration, you mentioned in the paper that firms collaborate, so there is not a strategic behavior among firms belonging to the supply chain. And on this, there is a rich literature that I found out reading the paper on supply chain collaboration. There is a reference here in this slide. And this is interesting because it gives you some testable implications to see whether this is exactly what is going on between firms, among firms on the supply chains. So one testable implication would be to see whether there is more communication and therefore stronger effects in those sectors where the demand is more uncertain or volatile. And I guess you could check these on your data. Another possible test to be done is that to see whether you see less disagreements in terms of GDP expectations within those pairs of firms that do communicate more. And third, these supply chain collaboration literature also emphasizes the role of synchronization of decisions. I guess you cannot do these with the data set you have, but perhaps if you intend, to run these surveys other times, you could also check these testable hypotheses. And then there is a recent paper, 20 years ago, so a paper by these two authors on supply chain collaboration on New Zealand firms. And I think this could be an interesting reference to see whether this channel of collaboration is relevant in your case. And this is all to say that if this supply chain collaboration is strong enough, this might rationalize the fact that you obtain very similar magnitudes of the treatment effects. I conclude this for those interested in this literature on expectations and survey data. This is a must-read paper. It's really very innovative and at a very high level of execution. It addresses relevant questions also on the experimental designs in these type of exercises. It documents new effects on the spillovers, and I think it has a great potential for lots of new applications. And that's all I wanted to say. Thank you.
Thank you very much, Tiziano. Now I'll open the floor for questions in the room. Yeah, we've got 2, 3 at the, yeah. First.
It's a very nice paper. I have a question and that follows up a little bit on Tiziano's point. Maybe you can show us a little bit more about who these firms are, and I think it might be relevant to think about whether you have a a large customer talking to a large supplier or a large to a small one. I think this is where probably the information structure is quite a little bit different, or potentially not. I don't really have a strong prior, but I think it might be very interesting to see what's going on there.
So thanks a lot. It's very, very interesting. I was wondering now, going back to Tiziano's presentation, the first slides in which he shows that posterior is a weighted average of prior belief and the signal. That the kind of shocks that you put, like mean and uncertainty, might be a bit different in that setting. In particular, the uncertainty might actually change the weight that that firms assign to the signal. And I was wondering if you can check this in your data set. It's a kind of shock that changes the way that firms might process new information. So if you can check that, would be nice.
And then maybe we'll take one more from Jean-Paul, and then I'll pass back to you now. Thanks.
Very nice paper and a very nice discussion too. I had so comparing to Giacomo's work, and there's kind of an interesting comparison on pricing. So the impact of uncertainty on pricing, and I think the committee did a great job putting the 2 papers next to each other. If I follow, it seems that under nitrogen uncertainty in your model, with uncertainty, so you would have a fall in prices, whereas in Giacomo's paper, you would have an increase in prices coming from this precautionary savings mechanism, not precautionary saving, precautionary pricing mechanism. So which seems, it seems to be a very stark contrast. Am I right in this comparison? And do you have perhaps data to bear to kind of like figure out which of the 2 is going on?
Thank you so much, Tiziano, for the great discussion. I can maybe just mention a few things in response to Tiziano and then get to the question. So about the response rate, as you said, it is low, and then we also get some attrition in the second wave. It is, however, very similar to the paper written by Kumar Koibion and Goratnichenko on similar firms. So it's not unusual, at least for the universe of firms in New Zealand. The other thing to keep in mind here is that we're not only targeting summary statistics for single firms, but we're targeting statistics for pairs of firms. So that in and of itself becomes a lot more challenging. Just wanted to bring that up. And I also think that, I mean, you bring up some great suggestions that we can, there's things that we can certainly do with the data. There's others that eventually the RCT is done now, and we cannot go back to it. Raphael, on your question regarding firms, so we have a fairly good distribution of firms, from firms that have fewer than 6 workers to firms that have over 60 workers. We haven't split things because eventually the more you split the sample, the less power you get. But that's definitely something that we can, at least for internal consumption, look into and see whether we get any different results. My prior would be that we would not, but worth checking. On the way that firms assign to the signal versus the prior, I am not sure. I mean, I guess that we can definitely see, if you remember in that first regression, we can definitely see whether there's a difference in the estimated coefficient that goes in front of the interaction between the prior and the treatment, which would tell us something about the weight that firms put on the prior versus on the signal. Off the top of my head, I don't recall that estimate being significantly different for uncertainty versus mean expected output growth. So yeah, my prior would be that probably that's not the channel at work, but it's definitely interesting. And then Jean-Paul, so you're right. I thought about the same question that you raised. So there's a few things to keep in mind here. So first, empirically, right, we know this for a fact. We know this from previous research work. We were also able to confirm the documented effects that higher uncertainty about aggregate growth, right? So this is uncertainty at the aggregate level. This is not uncertainty at the sector level. It induces firms to lower prices, lower employment, lower investment. And if anything, the second moment effects, right, are a lot stronger, a lot more prominent than first moments. And so in that sense, right, in our world, higher uncertainty about aggregate output, it really acts like a negative demand shock. And that's exactly what the model is really replicating. Now, of course, there, as I mentioned, we do take a shortcut in the way how we think about uncertainty. We really think of it as being sort of a Knightian uncertainty, which in and of itself, in the end of the day, is just going to act like a negative demand, like a negative expected demand shock to come in the future. But maybe Giacomo and I can connect later and talk some more about this.
I want to just add one thing and then ask a question if there is time. So I think the way you put it is exactly correct. You're looking at aggregate uncertainty. Ours was sectoral uncertainty. So to the extent that, uncertainty about aggregate GDP reflects uncertainty about firms that are more downstream, then the results would be consistent, because in our model, if the uncertainty is downstream, and you're looking at the response of firms that are upstream, those firms are actually reducing prices. So that's, yes. Yeah, so that's another distinction, yeah. So I had a question which builds on what Tiziano discussed. If you want to distinguish between active communication and this fact that firms might by themselves search for more information, would you not want to show us, for example, how firms that are not connected to firms that are treated, how their posterior changes, and maybe in a second step, show us not the response of firms that are connected to the ones that are treated, but that with difference with respect to those that are not connected to those that are treated. That would be a way to kind of, I think, separate out the direct communication versus the search that could be going on.
So I think that there's many things there. So we know, right, that firms that are in the control group, right, these are firms that are these are connected firms or even main firms, but they were not exposed to information treatments whatsoever, either by first-hand information or second-hand information. And we know that the posteriors of those firms, they almost exactly coincide with their prior. So there's pretty much no change happening there. Now, for the firms that are connected with the main firm that was handed some information, the connected firms, something has to happen that ignites, an incentive to go search for extra information, right? And so it has to be that communication in the first hand happened, or even though Tiziano was a little bit more skeptical of that other channel, or they observed, an action like the price change, right, different from what was previously anticipated from the main firm, and that ignited eventually more an update in expectations, maybe more search going on. But it has to be that, I think that you still need that first step, right? You still need that means of transmission of information from the directly treated firm the connected firm. And so I'm totally sympathetic to the idea that, maybe firms, they go and search for some more information. I don't think that right now we have a way of distinguishing that in the data, but
Great. Thank you very much, Ina and Tiziano, for a great presentation and discussion, and thanks to everyone also in the room for the questions. So let me give a round of applause for a great first session. So next we'll pass over for the keynote, and Elena will introduce Cristiano.
Good morning, and hello also to those who are joining us online. It is my pleasure to introduce to you today Professor Christiane Baumeister, who is going to deliver the keynote speech in our inflation conference today on the topic of oil inflation expectations and households characteristics. So Professor Baumeister is the Lambert Family Professor in Economics, and she's a professor and associate chair at the University of Notre Dame. She is also the associate editor of top economic journals, just to name a few: Journal of Monetary Economics, International Journal of Forecasting, and soon also the American Economic Review. Professor Baumeister has a long list of publications in top journals with major contributions in the field of econometrics, but also more specifically in how we think about the link between energy prices and economic outcomes. And her latest research takes a deep dive into what drives inflation expectations, which is a key topic for us as central bankers, but for economists in general as well. This is going to be the topic of her lecture today. Thank you very much for accepting our invitation. Professor Baumeister, the floor is yours. Thank you.
Okay, well, thank you so much, Elena, for the welcome and the introduction, and thanks also for the invitation to present this paper here today. It's a great pleasure to be here, and I'm excited to tell you about the work that I've recently been doing with a very talented PhD student of mine, Pascal Frank, and as well Florian Huber and Gary Koop. So it should come as no surprise that understanding how macro shocks impact microeconomic units such as households and firms using vector autoregressive models has recently gained popularity. And the reason is that macro shocks such as monetary policy interventions, tax changes, or unexpected fluctuations in oil prices do not affect all economic agents uniformly. In fact, effects can vary quite substantially across different segments of the economy or individuals that belong to a particular population, which then results in distributional effects. And this new paradigm calls for econometric methods that allow us to quantify the heterogeneous responses at the micro level and then study the distributional consequences once we aggregate them up again and map them back to the macro level. And there are a couple of approaches out there that kind of use unit level data, among which probably functional VARs are best known by now, but this is a very active area of research currently. Now, another very relevant aspect of the transmission of aggregate shocks that has received a lot of attention lately, and that, however, none of these existing approaches takes into account, is the presence of asymmetries in the sign and the size of these aggregate shocks, various forms of state dependence, and other types of nonlinearities. So what we do in this paper is to develop a flexible modeling framework that brings together these two aspects. So heterogeneity at the micro level on the one hand, and nonlinearities in the macro to micro propagation of shocks. And so we propose what we call a nonlinear heterogeneous agent VAR model that in a nutshell integrates multivariate time series models with nonlinear dynamic panel models where the nonlinearities are inferred based on Bayesian machine learning techniques. And a very neat aspect of that framework really is that we can incorporate characteristics of those micro units directly into the estimation. And that means that we can then classify the results based on specific attributes of these units, which also will help us with economic interpretation. Now, we then apply this framework to address the long-standing question of the effects of oil supply shocks on household formation of inflation expectations, which again has received attention during the recent inflation surge and the supply disruptions that happened as a result of the Russian invasion of Ukraine. And so what we do is we examine whether households react heterogeneously to shocks of different sign and different size, and whether this heterogeneity that we observe in the strength and the persistence of the responses depends on particular socioeconomic characteristics such as gender, age, income, you name it. Now, there exists a literature that has investigated the asymmetric effects of oil price shocks on economic activity that was started by Hamilton in 1996, and also on inflation with a recent contribution by some of our hosts here, Elena, Sarah, and Catalina, together with Florian Huber. Now, there's also evidence that inflation expectations are sensitive to energy price shocks, but quite little is known actually about how the dynamic adjustment in response to these shocks depends on household characteristics and what role nonlinearities play in that kind of setting. Now, central banks often follow the prescription to look through energy price shocks, but of course, once these energy price shocks affect inflation expectations in a heterogeneous and potentially asymmetric way, then they cannot ignore these effects, given that inflation expectations play a key role in forming monetary policy decisions. So that's in a nutshell what we're after here. So what I'm going to do now is to introduce to you the novel modeling framework that we developed for answering this question. Then I'm going to describe the survey data to you, and then I'm going to show you a set of empirical results that we can derive based on this model. Okay, so here is the basic nonlinear HAVAR model which tries to capture the interactions between a set of macroeconomic aggregates, which are contained in our vector YT here, and a dynamic panel that consists of n units, be it households, firms, or any other micro level units that you can that you have data for, basically. Now, the model is composed of two blocks that interact with each other. So the first part really describes the macroeconomic dynamics here. So it's a structural VAR model, which is kind of like a pretty standard and empirical macro. So here, that's your standard structural VAR model, which we augment with this part here that captures the feedback effects from the micro level to the macro level. Here, we're gonna describe that as the, or we kind of capture that through the inclusion of quantiles of the cross-sectional distributions, but this is just one form that this feedback effect can take. So any nonlinear function of the cross-sectional distribution can capture this inter relationship here. So you could think of other parametric measures coming from the microblock. You could capture the disagreement or any higher moments of this cross-sectional distribution here. Now, the second block describes the microdynamics, which here follow an AR1 process. And then here is the linkage with the macro block. So here we have this function fx, which is unknown. So it captures the relationship of how the information in the macroeconomic aggregates feeds into the decisions by the micro units, or how it influences the formation of inflation expectations in our application later on. Now, in addition to past dynamics of the macroeconomic aggregates here captured by YT to YT minus P, which I denote in a compact way as WT, we also gonna include unit-specific characteristics ZI here, that it will become clear in a moment why this is useful. So we have these two blocks to the model that interact with each other in a dynamic way. Now, the key question is, of course, well, what kind of like functional form this relationship between our micro units and the macro dynamics should take. One option here would be to impose some parametric assumptions. In the simplest case, I'll postulate a linear relationship between the macroeconomy and the individual units, but that has the implication that shocks to YT, so aggregate shocks, would have proportional effects on our micro units, and that might be undesirable because, as I said before, we're interested in really studying asymmetries in the sign and the size of the shock. Now, alternatively, to get at that, we could use a nonlinear specification, but that would require us to take a stance on which functional form f of x should take. And it's actually hard to come up with a justification for what kind of like how for a specific form of how to think about this this nonlinearity at the micro level. And of course, if we kind of like get the functional form wrong, then that risks issues of models misspecification. So that's why we decided to basically approach the problem in a non-parametric way and treat f of x as an unknown function and estimate it. And in order to do that, we're going to exploit machine learning methods. And there's a variety of possibilities out there on which you can draw. So you can, for example, use Gaussian processes or neural networks. But what we're going to do in the empirical application is to use Bayesian additive regression trees, which have been shown to have desirable empirical properties and to work well in the type of context that we're interested in. However, even in that case, modeling f of x in an unrestricted way is not only computationally very demanding, but it can also be challenging from a statistical point of view if we are in a setting where both n, so our cross-sectional units, and t, the time series dimension, are large. Now, in order to make this problem tractable, we offer a novel solution by drawing on some insights from the finance literature here in order to introduce some additional restrictions. In fact, what we do is we're going to assume a factor structure in xt where the factor loadings are a function of these unit characteristics of the micro level information here. So that results in a semi-parametric specification where Qt is essentially the factor that summarizes the aggregate dynamics, but evolves according to an unknown function that uses the macroeconomic dynamics or the macroeconomic aggregates as an input. And then this gamma parameter here are the factor loadings associated with Q. And then by adding in the characteristic Zi, we're going to get individual specific sensitivities to those macroeconomic aggregates, to the macroeconomic shocks. Now, we then gonna, as I said, infer this unknown function mu here using Bayesian additive regression trees. But in the interest of time, I'm not gonna go into the technical details. We can talk about that later on if there are questions about that. Okay, so let me just summarize or highlight the key features of the model here. So we allow basically for different sources of asymmetries here. One are the unit-specific characteristics, which allow us to take cross-sectional heterogeneity into account. Then we're going to account for asymmetry in both the sign and the magnitude of the structural shock. So that allows us to study the nonlinear effects of macro shocks on the micro units. And then given that this is a nonlinear model, it also means that we can or that the initial conditions matter. So the point in time when the shock hits, what is the economic environment, that also matters for the propagation. Okay, so maybe one important point also relative to the existing literature that has tried to take or to model unit level data is that with our framework, we can consistently produce two types of nonlinear impulse responses namely at the unit level. So we can look at how each individual unit responds to an aggregate shock, but we can also study the distributional implications. So we can also have impulse responses that describe the distributional effects of the shocks. Okay, so one thing that we haven't talked about yet is, of course, how we're gonna identify the underlying structural relationships of the model here. Now, let me say that the model is very general, and any standard identification strategy can be used to recover the structural form here in the macro block. Now, in our application for the Euro area, we're going to go for a specific identification strategy, which I will talk about in a moment. But let me first tell you about the variables that we include in the macro block. So they're going to be 5 variables. The first one is going to be the oil supply shock that coming from the global oil market model that Jim and I developed in our earlier work. We're going to include the real price of Brent crude oil in log levels. We're going to model the energy component of HICP inflation as an indicator of the current state of the business cycle. We're going to include a measure of consumer confidence. And the reason for this choice is basically that it is in line with the survey data that we're going to use and that I'm going to talk about in a moment. So they're coming from the same source, and thus are well aligned with the inflation expectations in the microblock. And then our policy variable is going to be the 3-month Euribor rate that completes the macro block. Now, our sample period runs from January 2004 to December 2024, where the start date is determined by the availability of the micro data. And in order to deal with the COVID period, we're going to follow the approach proposed by Hamilton and downweight the observations during the pandemic. And we are going to account for a full year worth of lags here, given that we're in a monthly setting. Okay, so we're going to basically achieve identification by combining a recursive structure where we order the instrument, which is the oil supply shock first, with sign priors on the vector of structural parameters that describe the contemporaneous relationship between our shock measure and the other endogenous variables. So because we really want to approach this problem coming from a structural perspective, so we want to use all the information that we have available in order to distill the underlying economic structure. Now, here is just a way to think about the matrix of contemporaneous relations. So, as I said, we're going to have sign priors on the elements in the A matrix, which captures the contemporaneous relationships between our variables and the shock measure, and that would be the negative of the alphas that I showed you before here. So maybe just for illustration, take that last equation, right, which would describe the response of the central bank to a supply shock, to a change in oil prices, to changes in energy inflation and the consumer confidence index. And so, for example, we would expect if oil prices go up, then also the interest rate should go up, and that's what's captured here. But note that A is the negative of alpha here, so which means that we would have a negative sign in that in that position here. And we implement this by using truncated Gaussian distributions. Okay, so let me talk a little bit about the data in our microblog, which are based on the harmonized business and consumer survey provided by the European Commission. This survey follows the structure of a repeated cross-section. And the nice thing about this survey is really that it provides not only qualitative inflation expectations, but quantitative ones, and that it is consistent over the entire euro area member countries. So what is the survey question? Well, in a first instance, participants are asked about their qualitative inflation expectations, and if they answer that they think or that their inflation expectations have changed, then there's a follow-up question that asks them to indicate by how much they expect consumer prices to go up or down over the next year. Otherwise, if they say inflation expectations, if they say that their inflation expectations have not changed, then the amount is going to be automatically set to zero. So this is a survey that is conducted on a monthly basis and includes around 21,000 participants using a harmonized survey questionnaire and a common timetable. So based on that, we can then construct a pseudo panel of quantitative inflation expectations. Now, what is the pseudo panel? Well, we're going to use demographic data that the survey also collects in order to construct pseudo individuals based on various characteristics. So we're going to use information on income, gender, and age, as well as the nationality, in order to construct 305 pseudo individuals, and that form the micro block of our model. And we're going to compute within each pseudo group the average of their subjective inflation expectations. Now, due to gaps in the data, we're going to focus our analysis on 10 euro area member countries to have a long and complete coverage here. Okay, so given that survey is not that widely used, let me start by illustrating a few features of those data. So here I show you median inflation expectations by various socioeconomic groups, low and high income, male and female, young and old. And the key takeaway here is simply that there is some rich heterogeneity across these various household characteristics, especially when we compare high and low income groups. So inflation expectations do not just differ by the magnitude, but also really by the dynamics across these various characteristics. Now, we can also take a look at the distribution of inflation expectations over time. So here you have at each point in time the full distribution that is implied by the survey data, and you can see that there are important changes over time in the distribution of the monthly inflation expectations as well. Okay, so let's take a look at some of the results here. So let's start with looking at what happens in the macro block. So here you see the dynamic effects of a 2 standard deviation oil supply shock, which induces a 10% increase in the real price of oil. That in turn leads to an immediate increase in the energy component of HICP inflation of 1%, which lines up with the share that energy accounts for in the consumption basket. Now, higher oil prices also lead to a decline in consumer confidence. So we have a decrease in this forward-looking measure of economic activity here. And in response to higher oil prices and inflation and a decrease in economic activity, we observe an increase in the interest rate that kind of like evolves gradually in order to get inflation back to target. Now, what happens at the disaggregated level? Well, let's first take a look at inflation expectations aggregated up to across the pseudo individuals by applying survey and country weights, and let's focus on asymmetries in terms of the sign and the size of the shocks. So here you see the effects of a price increasing supply shock in red and a price decreasing supply shock in green, multiplied by -1 to put them on kind of like to make them comparable, in response to a shock of size 1 standard deviation, 2, 3, and 5, appropriately rescaled so that we can compare those effects. Now, what you see is that oil price increases trigger stronger and more persistent increases in inflation expectations compared to price decreases of a similar magnitude. And actually, the gap widens the larger the shocks get. So once we look at 3 standard deviation or 5 standard deviation shock, which implies a 15% and a 25% oil price change respectively, we see that the asymmetries become much more pronounced. Whereas for smaller shocks, kind of the asymmetries are not that pronounced. Now, what we want to do then, however, is to dig a little deeper and see how we can whether these asymmetries also exist at the unit level and whether we find heterogeneity. So we want to address the following 2 key questions. First is the heterogeneity in the reaction of inflation expectations at the micro level, so across our various pseudo individuals, and do these responses differ with respect to the size and the sign of the oil supply shock? So essentially, we want to now look at subgroups that are characterized by different socioeconomic characteristics, and also across countries, and see whether the reactions differ there. So the first 2 dimensions that we're going to look at are basically the country dimension and the income dimension. So here I show you the peak responses by country and by income group for a 2 standard deviation shock, which is a typical sized increase of 10% in the oil price. And here you see that for this smaller type of shock, actually the responses to positive and negative shocks are more or less the mirror image of each other. But what you observe as well is that there is quite a bit of heterogeneity both across countries and across income groups. So typically, low-income groups respond more strongly compared to high-income groups, and kind of like the countries are ordered also in a decreasing way. But it's not as visible in this setting how much heterogeneity there is across countries and income groups. But once we move to a large oil price shock of a 25% increase or decrease in oil prices, that becomes much more obvious. So here you clearly see that large price increasing shocks lead to a much higher response or adjustment in inflation expectations than the corresponding negative shock, and you also see the heterogeneity much more clearly. But if we were to zoom in this previous graph in the same way, we would actually observe as pronounced a heterogeneity across countries and income groups as here. Only the asymmetry is not there. Now that begs, of course, the question: well, how can we explain these patterns of asymmetries and heterogeneity? And that's the question that I want to turn to next. So one explanation is that the large price increasing shocks are obviously much more costly for households, which forces them to pay more attention to these shocks, because the marginal utility of updating information is much higher in the case of a price increase. So basically, the asymmetry can be traced back to a story of rational attention. So you would be more attentive to large price increasing shocks than price decreasing shocks. Now, what about the heterogeneity at the country level and within income groups? So as we saw, there are pronounced differences along those two dimensions, but how can we rationalize that? Well, the first thing that we are going to investigate is what we refer to static explanation that's related to the structural characteristics of countries or households based on the consumption share of energy across countries and across households. So the energy consumption share basically measures how exposed you are to oil supply shocks, and the idea here is the higher your share of energy in the consumption basket, the larger the adjustment of inflation expectations should be. And this seems to be borne out by the data. So here we're looking at the correlation between the energy weight in the consumption basket across countries and their the median response of that of inflation expectations of that country 1 year after the shock, and you see this positive relationship here. So the higher the consumption share of energy, the more you adjust inflation expectations in response to the oil supply shock. Now, there's also within country differences by income. So lower income households typically spend a larger fraction of their budget on energy, which should make them more sensitive to oil price shocks. And in fact, what we can do is we can break down the evidence that I just showed you by country, also by income groups, and we find basically this positive relationship now also by income group. So low income households, here for the case of Slovenia, they adjust their inflation expectations much more than lower and middle income households, and they expect them adjust them more than upper middle income households. And that holds across our set of countries. So here we have a summary table. So the higher the median energy share, the larger the adjustment of inflation expectations. Now, so that's kind of like based on certain characteristics of structural characteristics of either the country or the type of households. But there's also potentially a dynamic explanation that we can give here, because as we saw, an oil supply shock triggers a contractionary monetary policy response, and that would allow us to also explain the patterns that we observed in the responses. So the first channel where the monetary policy response comes into play is that homeowners with mortgages tend to pay closer attention to monetary policy, and they anticipate that tighter policy will actually lead to a decrease in or will dampen the inflationary impact of the shock. And so that means that homeowners with mortgages should react less to oil supply shocks than renters. The second channel where the monetary policy response comes into play is that households that are liquidity constrained tend to be more adversely affected by contractionary monetary policy, making the households more pessimistic and inducing stagflationary correlation beliefs, which means that hand-to-mouth households should react to oil supply shocks more strongly as part of this monetary policy transmission channel. And again, if we look at the data, this is borne out here. So we have a negative correlation between inflation expectations and the share of owners with outstanding mortgages, while we have a positive relationship of hand-to-mouth, the share of hand-to-mouth consumers and their formation of inflation, or the response of inflation expectations to inflation expectations. Okay, so these are two dimensions at the individual level of our micro units. But as I mentioned to you before, we can also look at the distributional implications by constructing density responses. Here we just look essentially at how the density evolves in the presence of the oil supply shock and compare that to the case without the shock. And let me just move right to the plots here. So here you see the median response of the cross-sectional distribution in the case with and without shock. So without shock is the dashed blue line. With the shock, it's the green line. And again, we're looking at the effect of differently sized shocks and the distribution after 1 year after the shock. And as you can see, there are quite, so the larger the shock becomes, the more the distribution here shifts to the left, meaning triggering higher responses compared to the the no shock case. But what is particularly interesting here is also that we see a lot of non-linearities in those distributional effects here. Now, in order to get a better sense of how different the adjustment really is, we can also look at differences in distributional responses, which basically tells us how the distribution shifts. So how mass from, in this case, lower inflation expectations shifts to higher inflation expectations. So basically, this is the mass that is subtracted and shifted to higher values here in terms of inflation expectations after a 5 standard deviation shock. And again, here you can clearly see that that the size of the shock matters, so that we have important non-linearities here as the shock size increases. Now, another thing that we can do based on these distributions that I just showed you, we can also estimate the share of the population whose inflation expectations are shifted above or below a certain threshold. And we think that might be particularly useful for policymakers, depending on what threshold they consider to be important. So what we can do is we can compute both downside or upside probabilities of passing a certain threshold. And again, the differences in inflation expectations then tells us how the overall share in the population shifts in terms of the inflation expectations. And so here for illustration, we look again at an oil price increase of 5 standard deviation or an oil price decrease of the same size for thresholds of inflation of 2%, 5%, and 8%. So what you see here is that after a 5 standard deviation oil supply shock, there is basically 0 probability for inflation to fall below 2%, but an increasing share of the population starts expecting inflation to exceed a threshold of 5% over a 1-year horizon, and an even larger share expects inflation to exceed 8% after. So for example, after 1 year, it's like 21%. And well, we can do the same for oil price decreases. But let me show you one other dimension that we haven't talked about yet. So here we're comparing the density impulse response function, so the distributional shifts for young and old, which is another dimension that kind of like we characterized our pseudo individuals with. And what you see here is that let me focus on the right-hand side directly, where we see the effects of again a large shock. So we see that the younger population, which refers to ages between 16 and 29, respond much more strongly than the older population, which refers to individuals with age above 65. Again, we can capture that in terms of the shifts in the distributional responses. And what stands out here really is that the younger population starts already at a higher level of inflation expectations, and then So shifts from 8% to about 12%, whereas the older population starts out at a lower level, so below 5%, but then in the end exceeds 10%. So we see important shifts in the probability mass here across for older relative to younger individuals. And a potential channel here is that the stronger adjustment among the older individuals, so that they move from a lower level to essentially the almost the same level as the younger individuals, would be consistent with a story of selective memory recall of past experiences, which would lead to a more pronounced belief update. And I believe Raphael is going to tell us more about that later on, and he can also tell me whether that story would make sense here. Okay, so let me just conclude. So well, there are two key takeaways from this paper. The first one is methodological. So what we did in this paper was to propose a new modeling framework of scalable macro interactions that links a standard structural VAR at the macro level with nonlinear dynamic panel with a nonlinear dynamic panel model to capture microdynamics. With this model, we can look at the propagation of micro to macro shocks, allowing, however, for a feedback also of microdynamics into the macro block and potentially altering macrodynamics as a result of this additional information coming from the disaggregated level. And we're particularly interested in the role of nonlinearities in this framework, where we, however, remain agnostic about the type of nonlinearities or the form that these nonlinearities take, and we infer them by using machine learning techniques. Overall, the model is very tractable. Computation is straightforward and fast, thanks to the efficient MCMC sampler that we develop. And we think that this framework lends itself to very many in very many contexts, to many different applications. Now, our particular application here to inflation the role of oil supply shocks for inflation expectations in the euro area yielded a number of new empirical findings. So we showed that oil supply shocks trigger asymmetric and heterogeneous reactions in household inflation expectations. And we saw that oil supply disruptions that lead to a price increase trigger stronger increases in inflation expectations compared to price decreasing shocks. And this asymmetry in the size of in the sign and size of shocks becomes more pronounced. And then we were able to also kind of like, thanks to the household characteristics that our pseudo panel incorporates, we were able to show that lower income households, older individuals, and countries with a larger energy expenditure share display a more pronounced adjustment to oil supply shocks. Thank you so much.
Thank you very much for this insightful keynote lecture. I will open now the floor for questions. We have one there and there.
Good morning. Hi, Cristiane. A very nice talk. Nice to meet you. Nice to see you. So this morning we had a little bit of discussion about, in a network, what is more important, the energy or the food? So when I think about inflation expectations on the household side, there's a lot of discussion about the two of them, right? So I think it's a very nice framework, your BAR, you could exactly do the same, with food. First-man shocks, you put the prices, and then you see how it transmits to the micro. Have you thought about this? This question could help us to see maybe the answer in household inflation expectations, which one of the two are more important. And the second question is related to this one. When you do this, are you not worried that your inflation, your shock, oil shock, is actually also not orthogonal to the food shock? So how could you now distinguish between these two? Thank you.
Thank you. Another question there.
Thank you very much for the presentation. I was wondering, one source of heterogeneity that I would expect for households would be like sources of labor income. How do we think about this in this framework? For example, if some households, not necessarily, well, sometimes maybe the low income ones might be employed in more demand sensitive industries, but I wouldn't think it's just by income decile, but just their sources where what sectors they're employed in. I thought that was an important source of heterogeneity as well. Thanks.
Thank you. Perhaps one related question to this, whether also the level of education could be a source of heterogeneity. The level of education. Thank you. And let me collect two more questions, if possible, before I give back the floor to you. There and there.
Okay. Hi. Thank you so much. I wonder, what is your view on whether the results also generalize to energy shocks in general, not only stemming from oil price shocks, because obviously what we've seen in the recent past is not only oil price shocks. So I'd be curious to hear your views on that. Thank you.
So thanks a lot. It's a wonderful, wonderful paper and a wonderful approach. So do you understand it correctly that shocks to expectations affect the macro block only with a lag? So yeah, so Guido will present a paper in the afternoon. I hope it's going to convince you that this might be a too strong assumption.
Thank you very much. Christiane, the floor is yours.
Much for these really useful questions. So let me try to give you a sense of what I think about these various aspects. So yes, food inflation, of course, is also, or kind of like food prices and the effect on inflation expectations. It's like, I mean, food and oil prices are both very visible to households, right? So because they're exposed to it by shopping, essentially, right? So this is also what this earlier literature said, why inflation expectations are so sensitive to energy price shocks, right? Because we see them basically on a regular basis by just driving around. Same with food prices, of course, if we do grocery shopping. So yes, I would kind of like expect there to be effects on inflation expectations also coming from food price shocks, right? But maybe one distinguishing feature, and that came up in the discussion also earlier this morning, is that food price shocks in a way are smaller and they are more dispersed, right? So it depends really on what type of food items you have in your consumption basket. Whereas, I mean, gasoline prices, which are directly related to oil prices, right? So is maybe a more homogeneous good, and we see larger spikes. Moreover, I mean, you could also think that there's a relation because you need energy in the production of food, right? So in that sense, these two, there's a relation between the commodities as well. Now, of course, if you would want to identify both food price shocks and energy price shocks in the same model, right, you would have to make additional assumptions in order to be able to disentangle kind of like, or to call them structural in some way, which I guess you could do. I mean, as I said, the framework in and of itself you can use any identification strategy that has been used, but you need to make additional assumptions, of course, for identification in that case, right? And again, just to drive home, I think, yeah, food prices and shocks there are important, but again, they're less tangible sometimes. So, I mean, we read about oil supply disruptions in relation to wars, geopolitics, whatever, kind of like very frequently, whereas food prices, right, or food price shocks are not as much discussed, I guess, unless you have like a bad harvest, or what was discussed like in last year a lot, like egg prices, right? So there was all of a sudden this egg crisis. But I think these things happen more sporadically and in very specific food items. Now, the question about the sources of income, yes, that's, I mean, I wish we could distinguish between that, but the survey only gives us information about the various buckets of low, middle, and high income. But I mean, conventional wisdom tells us usually that low-income households are deriving, or their main source of income is from labor, right? So whereas high income probably has a more diversified sources, but we cannot. I mean, we don't have that information in the data. So I wish we would. So that would be an interesting distinction to make. Then Elena's question about education. We have information about education in the survey, and we could use it as an additional kind of like way to come up with pseudo individuals. But then again, education tends to be highly correlated with income. So that's why we didn't think that there was a lot of independent information in the education dimension per se. So that's why we decided to go with income. But again, if there are other questions and you want to use that survey, you could. So it's really up to you, kind of what characteristics you want to exploit in constructing the pseudo individuals. Now there was this question about energy shocks in general, right? Sure. I mean, you could also, if you have a way to define these shocks or measure the shocks, right? So then it's a little bit like with food price shocks. You could, of course, look at other shocks. Now, again, given the tight relationship between oil prices and gasoline, and given that we're still mostly driving on gasoline, I think this accounts for the largest share. In fact, if you look at the breakdown of energy in the HICP, most of the time the component that moves most is actually gasoline. Only in the most recent event of the Russian invasion of Ukraine, right? You also see kind of like electricity prices move a lot as a result of the stop of natural gas imports. Now, yes, the question about inflation expectations from the microblock entering with a lag, right? So, I mean, 2 points there. I mean, one is an econometric issue, right? So you would have an identification problem if inflation expectations were to feed back into the macro block contemporaneously. I'm not saying it cannot be addressed, right? So potentially you could come up with a way to account for this contemporaneous feedback effect. But there's an economic reason why we haven't done that. And I'm kind of like now very intrigued by what you're going to tell us later today. But so given that it is, I mean, that it is the effect of the individuals on the macro block, right? So it's sort of the smaller units affecting or having an influence on the aggregate dynamics, right? So we thought it's reasonable to assume that there is at least a lag of a month before that happens. But I'm happy to be convinced otherwise.
Thank you very much for the great keynote lecture. Let's give a round of applause to Christiane Baumeister. And let us all break for lunch and for the poster session in the D foyer.
Time to resume. My name is Benoît Maujon. I'm the head of economic analysis at the Bank for International Settlements in Basel. I actually have a long career in central banking. I began in this building on the 2nd of November 1998. I remember it as if it was yesterday. My badge number was 452. So for those who joined the ECB since, you know what it can mean. And I've been also a ECB Monetary Policy Committee member for the Banque de France from 2011 to 2018. So it's a great honor for me to be here today and to moderate this panel with our three distinguished speakers. To my extreme right, Dev Ramsen, Deputy Governor of the Bank of England since 2017, after rising through the ranks at the Treasury. Given where we are today, I'd like to recall that Dev knows the euro area quite well. Given that he led the Treasury's work on whether the UK should join the euro, but that's more than 2 decades ago. And in my experience at the BIS, I had the privilege to witness Dev's interventions in the BIS CGFS, where his interventions are among the most passionate and engaged, and it's always great to see the energy that he brings to the committee. Next, to his left is Elizabeth Hammack, who is the president and CEO of the Federal Reserve of Cleveland. She has been a staff and then a partner at Goldman Sachs. And as a member of the FOMC, President Hammack is experiencing an elevated level of media, social media, and societal attention at the current juncture. This being said, she animates the current debate on US monetary policy in her speeches, where she asks very profound and important questions on the level of R-star at the current juncture and what should be the size of the Federal Reserve balance sheet. Our third speaker, Philip Lane, is the chief economist of the ECB and former governor of the Central Bank of Ireland. He's playing at home, so he doesn't need an introduction. So we will proceed in 3 rounds. First, the outlook for inflation. Then second round, what you see, you members of the panel see as the most relevant conceptual challenges for monetary policy decisions. And then we will venture into more specific issues for each of you in your specific jurisdictions. In a recent speech, President Hammack gave in June, she stated, "My job as a policymaker is to separate the signal from the noise in financial markets." I have no doubt that today, that's very much what this panel is about. We'll need this insight, and I'm sure that you guys will convey a lot of it. So let's begin with the outlook on inflation. With 3 very contrasted situations across the euro area, the US, and the UK. And we'll begin with President Hammack. Then Philippe will take the floor, and then Dave. President Hammack, the floor is yours.
Great, thank you so much. Appreciate being here and appreciate the opportunity to co-host with our partners at the ECB. This is really a great pleasure that we spend time on this. And as the committee is focused on inflation, we can start there because there's obviously a lot going on in that space. When I step back and think about where we are in the US right now, when I look at inflation, I think that we are too high. We've been missing on our mandate for 4.5 years. And when I look at the trend is in the wrong direction. Last September, when the Fed embarked on reducing rates for the first time, we had inflation that was lower than where we are today. And the trend was headed downwards. We had good line of sight that we expected inflation was going to continue to move towards our 2% objective after a long period of being above it. Over the past year, inflation has largely moved sideways. Some components have actually moved up. Obviously, tariffs are a big part of the story, and there's a lot of different perspectives on what that might mean and how tariffs might play out. But part of the inflation story that seems to me to be a little more concerning is that the services part of inflation has been remaining elevated. So when you look at some of the sub-measures, when you look at core services ex housing, that measure has been closer to 3.5% and has actually ticked up in the past couple of months. And it's harder for me to unpack that and attribute that to some of the tariff impacts that we're seeing. So I think it's important to remember that we do have a 2% objective. It's critically important that we achieve that 2% objective. And in order to do so, we need to balance a number of factors. For the US, unlike other central banks around the world, we do have two objectives. So we have the inflation objective, which we talked about, and our goal there is 2%, but we also have a maximum employment objective. And so we have to balance the two things. Right now is a particularly challenging time for monetary policy in the US because we're being challenged on both sides of our mandates. So in addition to the inflation side, which has been above target for 4.5 years, and from my forecast, probably won't get back to target for another 1 to 2 years. I think end of 27 is what I have in my forecast for when we'll get back to target. We are starting to see some emerging signs of fragility in the labor market. Largely that's come through in the headline payroll numbers that we've seen. Now, other indicators, other measures of the labor market are reasonably stable. If I look at the unemployment rate, it's ticked up slightly to 4.3%, but that's right around my estimate of maximum employment. And it's been reasonably stable between 4 and 4.3% over the past 12 to 18 months. The headline number on payrolls dropped pretty sharply over the past couple months, and we have had another year of significant downward revisions in the QCEW study. And so it is showing that there's something changing in the labor market. Now, that could be on the demand side. It could also be on the supply side, given the sharp changes that we've seen in the immigration picture in the US. Other indicators, whether it's the unemployment rate, whether it's the vacancies to unemployed ratio, whether it's the weekly jobless claims number that come out, would give you better evidence of balance. Those are more indicative of a market that's reasonably in balance. Again, it's this low hiring, low firing environment that we've been in for quite some time. When I'm out in the district talking to businesses, what I hear from them is that they took a long time to bring their workforce together. It was very difficult to find the talent they wanted through the pandemic, and they're loath to let people go. So when we look at things in the US, there's an indicator, a notice that companies need to file ahead of mass layoffs called a WARN notice. When we track those, which we do at the Cleveland Fed, we're not seeing that trending downwards. The thing that concerns me the most right now is inflation expectations and making sure that inflation expectations remain anchored. As you'll note, the committee reduced rates by 25 basis points at our most recent meeting. The summary of economic projections would have the median including 2 more rate reductions through the course of this year. I think it's important that in order to be able to support the US economy, we can only do that if inflation expectations remain anchored around our 2% objective. Broadly, I would say they do seem to be anchored, but there are some signs of elevation. If you look at in Cleveland, we run a daily survey of consumer expectations, and that's been trending up pretty steadily. Firm expectations have been a bit more muted. And when you look at other surveys, whether it's Michigan survey or some others, those seem to be reasonably well anchored. Market-based measures of inflation expectations have been reasonably stable, although we are seeing a little bit of elevation there, which is something that I want to watch carefully to see how that continues. So right now, from where I stand, inflation continues to be the bigger concern between the two sides of my mandate. Inflation remains higher than I want it to be. It's headed in the wrong direction. And on the employment side, though we are seeing signs of fragility, we're coming off of a reasonably healthy baseline, and the trend has been very modest at this point. So I need to remain attentive to that. I want to be open-minded about where things may head from here. But right now, when I look at those balance of risks over the future, I think we need to maintain a restrictive stance of policy to ensure that we can bring inflation back to our target.
Thanks a lot. Very, very clear. Can we now ask you, Philippe, the situation in the euro area?
So first of all, let me say it's a pleasure to be able to participate this joint collaboration between the ECB and the Cleveland Fed. I've participated in a number of these over the years. I think it's a really successful conference of this dedicated focus on inflation. And I will also focus on inflation in these remarks. So let me emphasize that in the end, even though inflation is around 2% now, even though in our latest staff projections, inflation this year will be very close to 2%, it's very important to look underneath the hood, because where we are now is for this year, the projections have non-energy inflation. So there I'm adding food inflation with core inflation is 2.5. But because energy inflation is -1.6, the overall number is around 2. It's a mix of non-energy inflation being still, markedly above target. So what's interesting about the next year or two is the transition. So we have, or the staff have, non-energy inflation going from 2.5 this year to 2.0 next year, and then 1.9 in 27. And that, just by the way, is part of a longer series looking backwards of a pretty elegant, smooth disinflation for non-energy inflation. Whereas for energy inflation, and if you remember, between 21, 22, it went up by 50%. We've had a mild energy deflation since then. And what's happening is we will still have energy deflation next year, but less so. It goes from -1.6 this year to -1.1 next year. And then it jumps in 27 to +2.4. And there is a discussion about the policy sources behind that +2.4. Now, I don't really want to get into that, but the bigger point here is the whole history of the euro area has been marked by very big swings in energy prices. And so I think it's kind of, again, interesting analytically to think about. Now, we know it spills over. So energy inflation matters for everything. But of course, energy inflation at 50% matters a lot more than energy inflation plus or minus 1 or 2%. But the question I have come back, I feel like that's, like inflation right now, the non-energy component is not at target. So the question is, why do we think there's more disinflation to come? And essentially, it reflects, number one, our beliefs about the wage disinflation. That we have, it's still the case if you read the monthly flow of data, wage inflation right now remains fairly high. But thanks to the people who organize this conference, we have a wage tracker, which tells us the second half of this year, going into next year, people are signing contracts already with much lower wage growth, nominal wage growth. So I think we have that. And then it's reinforced by the exchange rate appreciation, the energy deflation, and the fact we do have a fairly subdued profile for domestic demand. It's growing, so we're happy that domestic demand is sufficiently resilient that essentially there's no kind of talk about any kind of recession talk, and we have low unemployment. But the fact that we do have this disinflation, another year of disinflation, is important in thinking about the dynamic. Now, the question is the glide path. Are there forces there in the disinflation that mean we don't stop at 2, that we kind of break through 2% and go back to a kind of below target equilibrium? And I think the base case is, again, assuming monetary policy does its job. We should never forget to say, of course, inflation does depend on monetary policy. But assuming monetary policy does its job, having the elegant re-anchoring towards target, I think it's plausible. Number one, inflation expectations, have re-anchored at the target. We do have, I think, solid base foundations for domestic demand to keep on growing. That's partly the monetary easing. The fact we've eased from 4 to 2 is playing a big part in the current momentum in the economy. We will have more fiscal support than we're used to in the last number of years. And with the low unemployment and real incomes growing, it's plausible there's a good foundation for consumption. So I do think we still have a calibration issue. To nail being around 2%, it still requires monetary policy to calibrate correctly. But essentially, it doesn't look like we're going back to the pre-pandemic equilibrium, very low inflation. But neither does it look like, I think, right now, do we have substantial risks of remaining noticeably above the inflation target either. And again, the structure of our economy is different to the US and the UK economy, and maybe especially in terms of the labour market. And for these reasons, I think we do have this kind of assessment of the inflation outlook, which is reasonably benign at this point.
Thanks a lot, Philip. So basically, the trend in wages and real wage you see as one underlying force for the trajectory of inflation. I guess it should depend also in part on where real wages are after being dented, going into very negative numbers during the post-COVID inflation, and this was a very large shock. How long it takes to adjust to a new equilibrium? A point that we can come back to later in the panel. So let's now go to Dave to tell us about the situation in the UK, where inflation is much higher than in either the euro area or the US. And Dave, the floor is yours. I think you have a couple of slides.
I do, but thanks for the earlier introduction, Benoit. In being in this room, I must say I want the audience to know that well, something I did earlier in my career before the UK's decision on the euro was that I was the economist on the UK presidency team when the UK was president of the EU when the euro was launched in March 98. So it's very good to be back in the Euro Tower, and thanks to the organisers of the conference and the ECB and Cleveland Fed for inviting me to participate. So yeah, if I could, my first slide is up. To very briefly set the scene, I'm one of the 9 members of the MPC in the UK, and 2 weeks ago or so, we voted by a majority of 7-2 to keep bank rate unchanged at 4%. Think of that as the latest step in a period of gradual and careful easing in policy restraints since August 2024, when we've cut bank rate by 5 times in total, but it's still at a level of 4%, so significantly higher than the official rate in the euro area and very similar to the US. And I think that reduction does reflect the fact that we've had substantial disinflation until recently. But I think it's, as Benoit just highlighted, where the UK is now is in an interesting place. And what we've seen is inflation really rising since this time last year. So the headline inflation is now at 3.8%. And we expect it to increase slightly further, but that will be the peak in the hump of inflation that we've been expecting to see throughout this year. And I think why that's so relevant to this conference, as well as to our outlook, is because there is this key factor which Beth was highlighting around how inflation expectations have responded to that. But at the same time, and although we only have a mandate to get inflation back to the 2% target, we don't have a dual mandate. We have seen the labour market continuing to loosen with wage growth normalising. And I see that as supporting a continuation of the core disinflation process. And that anchors my view on the inflation outlook. And let me just go, I think Phil said we should look under the hood. So let me just look at the component parts of inflation. And this latest hump in inflation, you haven't actually got the headline here. You've just got the various component parts. And there are three key things to draw out, really. The pickup in headline has been caused by energy price falls dropping out of our annual comparison. Headline services disinflation slowing and food prices rising rapidly. Now, the energy price effects in red are interesting, but I wouldn't say they were that relevant to they're orange on there, to the current UK inflation outlook. But I think services and food prices, I'd like to say a little bit more about both of those. And they're also relevant to the research agenda, which we'll come back to later in this session. So services ex rents, shown in yellow, has been stuck pretty close to 5% for the entirety of 2025. Headline services at the moment in the UK are at 4.7%, whereas the euro area services inflation, the comparable figure is 3.1%. So you've got a really significant divergence in what is a very significant share of the UK inflation basket, and typically is much more homegrown in terms of inflation. But beneath that headline services figure, as well as rents, which are now coming off, as you can see in green, indexed and regulated prices have been a major component of the recent price increases. And actually, as have the impacts of government policy, for example, a year ago, putting up national insurance contributions for employers, which is our main employment tax. So if you assume that these various regulated and other price rises are not repeated this year, which I think is a fair assumption, we should see headline services inflation starting to come down much more materially, and that will be supported by the fact that underlying services inflation continues, when you look at higher frequency measures, to be on a disinflationary path. Food inflation is another story, and that's in blue. That's risen rapidly, and it's projected to reach 5.6% by the end of this year. Now, a lot of this does reflect global factors in a few food categories, as my colleague Swati Dhingra has been drawing attention to. But it's also important to really note the salience of food prices for household inflation expectations. And it seems to be the case from research we've been doing that I'll come back to, that inflation expectations have become more sensitive to food price inflation rises following the double-digit inflation of 2022 and 2023. And, we are at the same time as this pickup in food, seeing a pickup of inflation expectations for the whole economy, particularly on the household side, and that's adding weight to that argument. That's looking beyond, that's looking at the short term for what's caused this hump. But as I've said, I do remain confident that we're going to get inflation back to target with the current setting of inflation, which is of interest rates, which are still in restrictive territory, and also given the market expectations that we condition our forecast on. In a sense, we've got two sets of risks. We've got the upside risks to the outlook posed in particular by elevated inflation expectations impacting wage and price setting behaviour. But we've also got continued normalisation in wage growth on the downside. And so, particularly with the opening up of slack in the labour market. So I do see the central case, which is what we've got in our forecast 2 years out of inflation coming back to target, to be the most likely outcome. And although our short-term forecasts are quite mechanical for inflation, they're based on what you can see in the individual components. The fact that those have behaved themselves this year in indicating that the hump would appear and then we remain on track for it to peak does give me some confidence, more confidence, that our medium-term forecasts for inflation are well set, although that's not to underplay the significant uncertainties around that. As I said, I think key to the disinflation process will be continued normalization in wage growth. We are seeing wage settlements data come in line. We have problems with our main official indicators for labour market activity, and a little bit on the earnings side as well. But our pay survey from a year ago that suggested wage settlements would be at 3.7% by the end of this year is on track. That's from the latest settlement data. And those are also then pointing to settlements being lower, say closer to 3% further out into next year, which will be getting down to target consistent rates. Although, as I've stressed, there are real uncertainties, and one I'll highlight, which is also relevant to the research agenda, is the world of supply shocks that we now operate in. And particularly for us in the UK, I think we're less certain about what's happening in the labour market, and particularly what's happening on the labour supply side. And I'll admit, from what I've said on previous panels over the last year or so, I've been surprised by how long it's taken for that wage setting behaviour to come back in line. So I don't rule out that there are more structural factors at play in our labour market. But anyway, taken together, for me, the risks to the inflation outlook in the UK are balanced. We'll come back to the research agenda, but the more support everyone in this room and beyond can give to helping us as policymakers understand those risks around central projections and what they might imply for different scenarios is vital. But as of now, looking at the UK inflation outlook with those risks to inflation balanced, I think the gradual and careful approach that the MPC has taken to removing policy restraint remains appropriate. And I see scope for further removal of policy restraint looking ahead. And I'll stop there.
Thanks a lot, Dave. I think we had time to print your second slide, where we see that in particular some of the salient prices, food prices, but also services inflation and rents are fairly high. So if I go back to the experience of the euro area, where real wages took time to catch up, and we are still in the phase where real wages are catching up after going relatively deep in the negative. If you would apply the same metric to the UK, you could expect that there would be some form of real wages catching up in the pipeline. So maybe later you can come back to your assessment on these risks. Now we are moving to the second phase of this second round of intervention by the panelists, and after the third round, we'll open the floor for you to ask questions. So you can already take notes of questions that you want to ask later on, or you can indicate it for our audience online. If they want to ask a question, they can signal it through their device. So this is a research conference on inflation, and our understanding of inflation is, you can see the glass half full or half empty. If you want to carry on doing research on inflation, you want to see it half empty. But if you're a policymaker, you'd like to better your understanding of inflation for sure. So we'd ask now the three panelists to share with the audience, where we have many researchers and some of the best researchers on inflation that we have as of today. What is it that they miss? Where would they see gaps in our understanding of inflation? So we've had this surprise inflation, the largest in a generation, and the first true test of inflation targeting that most central banks through the world are going through, and inflation has come down close to 2% in most jurisdictions very rapidly after the spike in 2021, 2022, and disinflation since 2023. And it was very surprising. It was a surprise for most people in this room, for most observers, for most central banks. So with this recent history in mind, and given this audience, where do you guys see researcher, where should be the priority of researchers and economists who work on inflation? Where should they focus their attention? So we'll change the order, and Philippe has the floor first, and we'll go to Dave and then to President Haymack.
So I really welcomed this question since I know a lot of you spend a lot of time trying to decide what is the highest return research you can do. So maybe the first point I'll make, even though it's not to my immediate benefit, I do think that this very large inflation cycle, the shock and then the disinflation, while it's still fresh in our minds, people should be still, I mean, there's been many papers written, but I don't think the last word has been said. So having really good documentation, really good analysis of this inflation cycle remains very important, even if I hope it's totally irrelevant for a long time. Because I mean, honestly, when this happened, I went back, I was reading QJEs and AEOs from the 70s and early 80s, trying to find, okay, because that was the relevant material. A second one is, I think there might be a prize for someone who can integrate the low inflation before the pandemic, and then the spike, and then the disinflation. So having a unified theory of basically being below target for a long time before the pandemic, being above target, and now maybe, hopefully, re-anchoring at the target. I mean, I think this is it sounds, I think it's very non-obvious. It sounds common sense, but I think it's not obvious why it looks like there's a lot of anchoring around the target when we've been away from the target for so long. Okay, so then let me be more immediate, and this connects also to the strategy review we did this year, because the Eurosystem staff went through a lot of assessing, okay, what do we think are going to be the influences on inflation coming up? So the first point I'm going to make before I get into it is it's very important to differentiate inflation volatility and, if you like, the persistent component of inflation. And this is going to be recurring quite a lot. In other words, what do we have to react to versus what can we say, well, we can't fine-tune inflation every month. If inflation deviates from target for a few months because there's a shock, maybe that's okay. But, guided by the staff research, finding that when in real time you can be confident enough to say we look through, versus in real time saying, okay, we don't know for certain, but maybe through a movement in inflation expectations, maybe through some other mechanisms, the medium-term anchor is at risk if you don't respond. So what I would say here is, we do say in our review, which we also said before, we think there's a lot of structural changes going on in the world. So whether that's demography, and let me extend demography to include the migration question, which is currently under discussion. It's automation, AI, digitization. It's geopolitics, and also it's changes in the financial system. And then the question is, okay, these obviously will have an effect on the trend behavior of the economy. Are they going to affect inflation? And then the question is, are they going to create inflation volatility, or will they matter for the persistent component of inflation? And here, I think going back, there's been a lot of related work done about, for example, news shocks and macroeconomics. Because if something's anticipated, it's very different than if it's a surprise. Now, Russia-Ukraine war was partly anticipated. There's a lot of discussion in autumn 21, very early 22 about the likelihoods, but it was a big shock. The pandemic was a big shock. But other times, well, actually, I'm pretty sure I know the demographic profile. Am I surprised that the non-immigrant component of the European workforce is shrinking in many countries now? No, because it's we've known this for a long time. Then the question is, okay, most structural changes have an effect on supply and also on demand. You were talking earlier on about low hiring, low firing. So the question is, because it sounds sensible, if lots of people are retiring, that means a tight labor market putting upward pressure on wages. On the other hand, lots of people retiring is going to depress demand, as people, no longer have the same level of earnings. So working out, again, using the standard macro about anticipated versus unanticipated, supply versus demand, and then the role of the financial system in intermediating, either amplifying or smoothing all of that, I think is important. Okay, let me switch gears to kind of modeling. And again, this partly reflects my own background in international macro. I mean, I have seen, and we have it at ECB, but there's examples elsewhere as well, of you might think the gold standard should be a global, multi-sector, multi-country model with lots of input-output linkages. And therefore, you can really understand how a bottleneck elsewhere can influence cost dynamics in Europe, or an expansion in productivity. So if there's a big improvement in the AI capabilities in the US, how that might spill over to the US, to Europe. And there's a lot of progress here. But all I would say is, my bet is if you jump forward 20 years, we'll go back and say, well, that was real infancy. 2025 vintage was still in the infancy. So doing more to kind of integrate those kind of models, allowing for more and more in terms of the kind of nominal rigidities, realistic assessments of the demand side of the economy, realistic assessment of the non-traded sector, so we don't overweight the traded sector and so on. I mean, you were saying earlier on about the services. It's not tariffs, it's services. So
research techniques to an earlier period has become more and more important. And I think what I'd like to flag two related pieces of work which actually bank researchers have been working on. There was a staff working paper which actually grew out of the Cleveland edition of this conference last year, I think, by my colleagues Anestis, Asadi and Naylor. They find that during normal times, households are particularly sensitive to changes in food price-driven inflation relative to other. It's good to know that these problems aren't just in the Bank of England. Universal. But that this sensitivity is much greater for positive and large shocks. And one of those authors, Naylor, has done some work with Verlander at the bank and extending that work to more recent periods, finding the evidence that household sensitivity specifically to food prices has increased materially since the onset of the inflation surge. And I think that's very consistent with state-dependent dynamics. And I was struck by some of the posters over lunch that very much emphasize the research there, the sort of state dependency. And I think, that's why on the MPC and also why I personally are putting a bit more weight on the risk that current food price shocks that we're having to deal with, although they may be global in origin, could generate second round effects. So I think that would be super relevant to kind of build on that very much kind of almost real-time analysis. And I'm really looking forward to the presentations that are going to be given in this afternoon's session. Second area, again, and apologies if this is a bit parochial, is maybe more so than the first, is structural. Actually, from what Philip's saying, I don't think it is. I think it is more universal. But I think the particular issues we're facing in terms of changing structures, there's one in particular I want to draw out, although I recognise, particularly when you think of the shocks we've been through, like Brexit and subsequently, how migration dynamics can affect through structural changes in the labour market, the inflation process. But the one I actually wanted to flag very briefly is that we've seen falling participation in the UK labour market relative to prior to the COVID shock. And that seems to be linked both to health-related issues, not just physical, but mental health, and also changes in preferences, such as early retirement. And those structural changes may well have implications for the outlook for activity in terms of supply potential of the economy. And also potentially on the, to Philip's point he was making, will they affect demand equally? But certainly in terms of, and this is where bank staff are focusing at the moment, are they changing, what used to, what we would have seen probably greater encouraged workers effects with people coming back into the labour market, particularly after COVID. Has that affected the contestability of the wage setting process? It's really a question for discussion. And of course, that's, as I said, a challenging time with the UK's main labour market evidence base, which means you have to draw on other sources. But, we'd be super keen to look at that whole nexus of issues and whether through the interactions of trend participation, drivers of participation, and factors that could affect the NERU, such as matching efficiency, does that give us a supply-demand disequilibrium that we didn't have before? Very finally from me, just to say something about the how of research, as well as what I'd like to see more in real time. And this does link to it being real time. I think it's really important. I mean, the world is so interesting at the moment with more, if I can use that phrase, with more supply shocks and with uncertainty about them, that I think research really does have to find a way, and I know this is on everyone's agenda, to be responsive to that. So yes, we need to be reading it in 20 years when we have hopefully the next big spike in inflation, but also trying to understand helping us policymakers make sense of these supply shocks in real time, I think is important. And so trying to find a way to combine the necessary intellectual rigor with the needs of policymakers to be able to understand what is going on in their economies with more moving parts on the supply side than there used to be. Similarly, we policymakers have to be humble and show humility in recognizing the uncertainty. So we need to use that research judiciously. But I think, I would just encourage real-time research as much as is possible. And I hope that there's still enough interesting things happening in the world economy to mean that that you will see the returns from that research. And I'll stop there.
Thanks a lot, Dave. President Hamack.
So a lot of similarities in terms of the research agenda, and I think there's a lot of great ideas here. I'll focus on 4 different areas, and one area, to Dave, to your last point, that I've been particularly impressed on the speed with which research has come forward has been in tariffs. We went over a period where tariffs weren't a lot of discussion. Tariffs weren't a big factor in economic circumstances, and over the past 6 to 8 months, the amount of research that's been put forward on tariffs and their impact on the economy, on their impact on inflation, has been really impressive. And I think that's a place where we'll continue and want to continue to learn more about it. For the US, one of the big questions really is, are tariffs going to be a one-time price level impact, or are they going to be more persistent? And I imagine this shock will give all of you plenty of fertile ground for research over what it means if it's a one-time tariff versus it being layered in the way that these tariffs have been, the ongoing back and forth in negotiations. So I think there'll be a lot, of rich analysis to be done there. I also think understanding tariffs and their impact on inflation expectations, and I would say inflation expectations broadly is my second area of research. There's been a lot that's been done, and we saw some good papers this morning, mainly in the household sector on inflation expectations, but focusing more on firm inflation expectations. And so shout out to Ina, who's been doing some work in this area. I think it's been great to see more about how firms are coming to their decisions about where they're setting prices. I think that makes a significant contribution to the field and to how I think about policy. Similarly, how short-term inflation expectations impact longer-term inflation expectations. And I would say, your point on food inflation certainly resonates with me. We've seen a lot of food inflation in the US, whether it was the price of eggs 6 months ago, the price of beef right now, how that plays through, not just in the UK, but in other regions in the globe, I think would be certainly of note. And then I will go back to the keynote. I was interested to see that there was a divergence between older people's experience of inflation and younger people's. And so some work around, does it matter, as we have this aging demographic, does it matter how recent that most salient experience of inflation was for inflation expectations, for how that feeds through into the economy, I think will be another area. The third one that I'll talk about is policy strategies. In the US, because we have to manage both sides of our mandate, we look at the misses and we look at the persistence. Our new framework that we just finalized says it will balance those two. Now, balance doesn't literally mean 1 for 1, but understanding how should we think about those dynamics? How should we think about the miss? When I look at where we are today and I look at the miss on the employment side and that persistence, if you just take the SCP, you're looking at, a few tenths of a miss on the unemployment rate to persist for, 1 to 2 years kind of time frame, versus you look at, even if you just take the forward on the inflation side, that looks like that's going to be a much bigger number for a longer period of time. Do you just look at the integral, the forward integral of that? Do you factor in the historical misses, or do you ignore those? Do you weight those 1-to-1 versus one another? What's the optimal way to think about how you should set policy in those spheres? So I think that would be good work. And then the last one, which I know a bunch of work has already been done, but I don't think you can ever spend too much time, is on the unknowable R-star. And thinking about the neutral stance of policy. We're all trying to drive our economies towards our objectives. And one of the keys is understanding how far you are away from those objectives helps you to understand how much distance you need to travel. Right now, there's a meaningful, I would say, disagreement. You can see it in in the dot plot that we put forward, there's about 200 basis points of range between R-star estimates in the US. And, you know, this harkens back to what Philip was talking about. We went through this period before the great financial crisis where we had kind of 3 to 6% in the US, 3 to 6% nominal rates. There was a view that R-star was something around 2%. You go through the global financial crisis, and all of a sudden, whether it's due to productivity issues, regulation, other factors, you see that R-star estimates dropped precipitously, closer to about 0.5 to 1%. And now that we're coming out of the pandemic, is there something different? Are we going back to that pre-GFC experience and getting back to that similar inflation experience, productivity experience? What other things are driving it? Or are we going to continue to be in that kind of 2008 to 2020 type range of this very low R-star? How do we know that? We always talk in the US about we'll know it by its works. But how do you see, where's the evidence that you can draw on that, and how do you bring that theory and practice together to get a good insight about where policy actually is?
Thank you. So a lot of work ahead for you. So I will open the floor actually now for questions from the audience, but I will still keep the privilege of being in this position to ask my own questions, and then we will take several questions and we'll see who among you takes which question. So first, some shameless advertisement for using a global model with multiple countries, multiple sectors to estimate the effect of tariffs on inflation. It's available in the latest quarterly review of the BIS. It's an article which is providing you with the answer, and I'm not going to give you the answer now. You can go and check it by yourself. Just to say that the estimates that we get may be a bit high for US inflation because we assume that the effective tariff rate is 17%, which is like the announced weighted average of tariffs for the US. But effectively, if you look at how much tariff is paid to the US government, the effective rate is closer to 10%. But this may change over time. So that's first an advertisement, and then a question to Dave and to Philip, which is related, because Dave, so you mentioned that inflation is in part this government tax on labor that feed to services, but why do they feed to services and not to goods? And also related to the interaction between monetary policy and fiscal policy in your latest conclusion of the framework review, Philip. So the staff has this very interesting paper, occasional paper 371. It's 200 pages, but it's a lot of substance. And so there you show that fiscal policy did shave off as much as 1.5% of inflation in 2022. And then it comes back. So as a central banker, would you have preferred that fiscal policies do not interfere with stabilizing inflation? And can you elaborate a bit on that? But let me take questions from the floor. Yes, Beate.
Thank you very much for a great panel. One question on inflation expectations, which I think is of course relevant for all central banks here, but the situations may be quite different between the three of you. So on the one hand, in the UK, if you see that wage growth is still quite high despite a pretty slow economy, does that suggest that there is some issue with inflation expectations? In terms of the US, Beth, which between survey and market-based expectations, which do you rely on more and you think show better signals? And in terms of the euro area, are we going to get next year kind of worried about the anchoring to the downside because the projection is for inflation to drop below the target? So is that going to be kind of an issue on the downside again? Thank you.
Thank you, gentlemen here. Do we have another question from the floor to close this first round?
Yeah, thanks also from my side for a very interesting and very good panel. So maybe more a question to Beth in terms of how you interpret the relatively slow increase we have seen in US inflation after the tariffs. I mean, I think many people have thought it would probably have increased faster. Do you is it? I guess the question is it exporters who are paying the bill, exporters to the US, or is it more US firms? And is it just going to be delayed, or how should we think about this conceptually? Thank you.
Okay, who wants to go first?
I can go first if it helps on, and your question as well, Benoit, as well as Beat's question. I mean, I think the point for us is that we are, when you look at the structure of our economy, it is kind of 80% services. We are a very service-heavy economy, and we also have very significant within that. I mean, we obviously have global services. We're the second biggest service exporter in the world after the US, but we have very significant retailing, hospitality sectors, and those have been a lot of relatively low-paid workers hit by particular, aspects, or in terms of their employment of their national insurance contributions increase, as well as increases which were very much consistent with past and present government policy to increase living wages, up to 2/3 of median income. So I think the reason we focus on services more than goods is we just see it more prevalent, more apparent in that very large service sector, and also goods inflation, once you take out food and energy, as my chart showed, has been broadly behaving itself. That may change depending on what happens, but that's not a kind of something we draw attention to in terms of either the inflation or disinflationary process. And look, on Beat's question, it's possible you could get those second round effects. My risk assessment is that is less likely. I do see, in fact, the last time we were on a panel, 3 months ago, seems like a long time ago, but I emphasized, the cumulative evidence of the loosening in the labor market. And although it took a bit of time to come through, that is now coming through into wages through this year, which I do see on a track, which I can explain, with how I think about how the labor market, you would normally expect it to operate as slack opened up because of the restrictiveness of policy. But as I tried to emphasize, I'm not ruling out that there might be more structural factors at work that could mean that you get that, that disinflationary process, which I've been quite confident in playing out via the labor market, does stall. And I think some of my colleagues on the Monetary Policy Committee put more weight on that risk than I do. And it's why I think there'll be a big focus on what happens to the settlements data. Does it continue to fall back to target consistent rates? Or do we see further inertia, rather like I think we saw at the end of last year? Do we see a new bout of that? I don't see any evidence of yet, which is why my risk assessment is balanced. But on the committee, that is a concern. And that's, again, comes back to, I think, analysing these structural factors in the labour market, depending on the characteristics of whether it's the UK or the Euro area or the US, I think is going to remain a super rich area for research.
Thanks a lot, Dave. So, Philippe, President Hamak, you have 3 minutes each.
Okay. What I said earlier on about whether what we just went through is for the filing cabinet, which would be relevant decades from now, but not immediately relevant. I think there's an issue here about are we going back to a kind of phase of rational inattention? So in terms of tiny fluctuations, so we do have a shortfall in overall headline inflation next year. In the baseline, it's going to be 1.7. As I mentioned, that's a mix of non-energy inflation being around 2, and then energy inflation being still negative. One important factor is we do assess food inflations will be markedly coming down next year. I agree with the assessment that there's lots of global commodity prices here, but there's also for food in general. It does connect to wage disinflation. It connects to lower transportation costs and so on. So let me mention, another reason why inflation next year we think is going to be lower is exactly a smaller contribution from administered prices. This is, by the way, where the Euro system has a big advantage over private sector, because we have 20 member national central banks in addition to people here in Frankfurt. At the peak, I may be wrong, and the staff can correct me afterwards, but we had hundreds of fiscal measures we were tracking, hundreds across the 20 member countries when the when inflation went up. And they're still rolling off this year. So there's a noticeable contribution to the upside, basically of reversing subsidies this year. Next year, that kind of dwindles away. So going back to Benoit's question about peak inflation being reduced, but the inflation episode being prolonged, I think that's true. So we did have this windfall of energy inflation coming down and being negative for the last several years. So the worst, maybe this is where you had it worse, which is basically, again, to repeat, non-energy inflation is still well above target. But with the energy deflation windfall, I think being around target is a nice place to be. I'm quite attracted to the instability. My bet is a function of peak inflation. So anything that reduces peak inflation, there's a big reward, I think, to reducing peak inflation, even at the price of prolonging the above target episode. For me, I'm not. Again, for me, with the expectations, the inattention issue, I think, is relevant. But I do think going to the institutional set of the European labour market, the cost of living channel is relevant. So we know that essentially the wage settlement is a big factor is the lagged cost of living increase a year from before, 2 years before. And so anything that reduces increase in cost of living will be persistent via lower wage settlements. So if we have inflation well below target next year, it will have a footprint in terms of I think, lowering wage settlements, all else equal. And then demand levels. So the reason what I said, my bottom line on inflation is, I think it's plausible that we're going to converge to around 2. We're not going to have this plunge below 2, is the support for demand in the European economy, which means that firms will be interested in maintaining price increases. It's there, I think, in terms of the recovery, the level of real wages will support consumption. We still have the interest rate sensitive sectors of the economy only starting to respond to lower interest rates. And we do have more fiscal support than normal.
Thanks a lot, Philippe. President Hamag.
Thank you. So I'll start with survey versus market-based measures. Yes, I like both of them. We pay attention to both of them. I think I take away different things from each, but I think it's important to look at all the information that's out there and try to collect that and understand where things are. And obviously the different surveys will give you different insights into different slices of the population, whether that be firms, consumers, businesses, and putting that all together really helps. But the market-based measures, the thing that I take away from that is, do the markets believe that we are serious about our 2% of inflation objective? And if I see that drifting away, that says to me that the market might be interpreting us as being less serious than I am, or that we intend to be, about getting back to that 2% inflation target. So that's an important signal for me, just in terms of our ability to deliver against the mandate. On the the impact of tariffs and why aren't we seeing more of that show up in the data? A couple of theories. It definitely has been less than I would have anticipated when the tariffs were first announced. There are a couple of things that I hear. It's not that it's exporters who are picking up most of it, although there are some cases where you see exporters are picking up some of it. Businesses pulled ahead their inventory accumulation pretty significantly in the first quarter. That's pretty transparent in the GDP data. And what we've seen is that businesses were slowly working through that inventory to get that out. It feels to me now from my conversations with businesses that they're largely through that inventory pull ahead and that there may be a second round of impacts that we see coming through. The other is that the businesses have been trying to buffer consumers. They're worried because we've been in this environment of above target inflation for quite some time. They recognize that in the US, we've got this two-speed economy going where the top end of the wealth spectrum is doing incredibly well, is happy to pay any price increases, but the lower and middle income families are really struggling and most of their paycheck is going to housing and food and gasoline prices, and they don't really have a lot of disposable income to spend. And so we have seen that businesses have been more cautious about passing on some of those costs, and they've been trying to absorb some of it. From my discussions with businesses, that's not going to last forever. They're going to have to start pushing that forward. And so that's another place where we could see it coming through. And then the third one is really around the collections. What we've seen is, as Benoit noted, you're seeing a headline rate of something around 16 to 17%, but the collected tariffs are closer to 8 to 10%. That could be enforcement, that could be transfer pricing amongst businesses. My guess is the longer that the tariffs are in place, the more that bleeds in. And so you could see, again, more of these impacts flow into it, which, again, we can talk about, is it transitory? Is it more persistent? If it's transitory, but it takes 2 years for the full impact to come through, is that transitory? How do you think about that in terms of what that's going to do to individuals, businesses, inflation expectations, and their experience, and what that flows through into the growth outlook?
Thank you very much. So a lot of food for thoughts and ideas. Where your research is in high demand, and so I'm very much looking forward to the papers that will come out of you listening to our three speakers who deserve a round of applause. And we resume in 15 minutes.
I think it's time to start. Welcome to the second session of the day on inflation expectations. We have 3 exciting papers on the program, and we will start with Guido Scari.
Okay. Thank you very much. So thank you very much to the organizer for inviting me and having us on the program. This is a joint work with Paolo Bonomolo, who is sitting in the audience, and Alessandro Celani. And if you have any difficult question, Paolo will be ready to answer. Okay, so the title is The Macroeconomic Effects on Inflation Expectation, the Distribution Matters. And this is somewhat related to the keynote talk that we just, a fantastic keynote talk that by Christian. And I will explain why. So what we are after in terms of research question are the following ones. What are the macroeconomic effects of shocks to the short-term inflation expectation distribution? So we're looking at short-term inflation expectations, but in particular, we want to look at the distribution themselves. So let me start from the very beginning. Here, as I will explain also, spend a little bit later on, we are taking a very different perspective from the literature. There is an enormous literature on inflation expectations. We have seen it, in the morning. We will see it even more today. And normally, this literature asks what are the determinants of inflation expectations, how inflation expectations are formed, and so on and so forth. And the keynote talk by Christian instead is asking about how, for example, macro affects inflation expectation and inflation expectation distribution. In particular, she was able also to link to characteristic of the single. Here instead, we kind of flip the coin and we say, okay, let's assume that inflation expectations are at least partly subject to exogenous shocks. One thing that we think we learned from this literature is that so let's move it here, is that expectations are volatile and might be subject to exogenous shocks that partly not rational. We don't know where they're coming from. So I think it's a good question that I think is a bit overlooked in the literature. Of course, the other question is also pivotal and very important. But a question is if expectation changes by exogenous reasons, does this have any macro effect? And I think that having been in the central banking for a few years now, I think this is also the way, and I was surprised at the beginning, how policymaker thinks about this. Because when you read these speeches or talk to them, they think that they need to discipline expectation, that these expectations are running somewhere, and they have to do something to control them. Of course, in a rational expectation world, this thing would not make sense. You just do what you have to do, you say what you have to say, and the expectation will discipline themselves. The other thing is that what we learn, again, from this inflation expectation literature is that when you have these randomized trials and you solicit with some signal, then agents do act. They change their consumer behavior. They change that their investment employment behavior. There's a paper by Tiziano with Kobian-Golondichenko, for example, showing that. There's a paper by a colleague at the DNB, again, with Olli and Yuri showing about that on consumers. So it seems that actually these shocks do have economic consequences, and therefore can affect macro shocks. We also touch, obviously, on this literature on expectational shock in general. There's another literature that has been burgeoning about, sentiment shocks by Angeletos and others, or the literature by Baudry and Potrier about expectational shock and the effects of expectation shock, which are exogenous shocks to expectations, and how this is going to affect macro. So as I said, we take a macroeconomic perspective by assessing what are the macroeconomic effects of an exogenous change of short-term inflation expectations. And surprisingly, there's not much. I think there's a literature, and I think I quote here just one paper, which is one of the first by Fabio Milani, which is an NK model with learning everywhere, and there are shocks to the learning process. And then he's looking at the shocks. Then there is a literature on de-anchoring. That's slightly different because usually these looks at long-term inflation expectation when we talk about the anchoring. Here, just a few papers looking at that. There is a paper by Truly Yours and some others that look at recently in the JME at the effects of a shock that increased short-term expectation in the average, so the average of this expectation. And we show that this is stagflationary. Actually, this is a paper that I presented at the same conference, I think, in Cleveland a few years ago. So here we want to take a step further. Instead of looking just at the median or the mean of this expectation, we're going to look at the full distribution. And I think, at least on my side, the paper that kind of elicited this question to me was a paper by Ricardo Reis in the Brookings, showing that how the distribution of inflation expectation actually was very important for the episode of high inflation in the 70s. And one thing that comes out from that paper is that it is possible there is a lot of information in the distribution of inflation expectations, and in particular in the tails. And that's basically what we're going to try to assess. So how do we do that? And that's how I think our paper is somewhat related to the paper presented by Christian. So we have met a parsimonious monetary policy BVAR with the distribution of short-term inflation expectation to investigate, as I said, the macroeconomic effects of changes in this distribution. We want to account for the full heterogeneity in beliefs. We want to understand if it's expectation that influence macro or macro that influence expectation, and that's the question of Paolo from before from the audience. And then we're gonna, and that's where the fun is. I had a lot of fun in doing this paper, because then you can think about shocking this distribution. Of course, the distribution is an object that you can shock it in many different ways, and you tell me how you want to shock it, we can try to shock it. Okay? So what are the results? The results is that expectations affect macro variables quite a lot, while vice versa is not very much. So not very little vice versa. Distribution matters because models that are based just on consensus estimates, let's say on the mean or even the mean and variance, tends to underestimate the effects of expectation shocks on macro variables. What we find is that mean and variance shocks are stagflationary, and tail shocks too, or even recessionary, in the sense that prices at the beginning go down too. And the tail matters, and in particular, the tail that matters is the left one. Then we do some, if I have time, I will talk about how we can think about communication shocks or communication in this framework. And the main message, if I don't get there, is that it might be more important to reduce dispersion in this inflation distribution rather than moving the average to the target, let's say, towards 2%. Okay, methodology and empirical models. So what's the problem here? It's a problem similar to what Christian was talking about previously. We faced the problem of incorporating distribution into a linear VR, right? So how do we do that? There are some papers that do that in the literature. And what we do, we employ a simple multi-step approach. And we kind of discretize this distribution. And we can use either raw data. And that's important because if you look at this survey, this was also evident in one of the graph that Christian shows about the 3D graph with the distributions. These guys tend to, these are Michigan survey, okay, so these are consumers. These guys tend to report round numbers, 1, 5, 3, 10, right? So there's nothing in the middle. So a previous version of this paper used quantiles. But then we decided actually to do rounding exactly because quantiles moves maybe a bit too much that problem. So we use a continuous kernel approximation, or otherwise as a benchmark, a parsimonian Gaussian distribution. So these are the data, just to show you this. So these are, as I told you before, this guy basically report only integers. So this is the mean proportion of the data. So that's the discrete distribution. That's the red one, which is also can be approximated by a kernel, and that's the blue one. And you can see there's a lot of match, for example, on 10. And the other one is the Gaussian as a benchmark that's been used often in the literature, and you can see that the Gaussian is not a good approximation of the data. Okay, that's kind of obvious. So how do we do that? Well, we replace discrete and kernel distribution with the cumulative probability. So we define intervals, basically, by discretizing the distribution. The interval selection is completely data-driven, so they should obey some basic criteria, so they should contain an average large amount of probability mass. The last interval is wide enough to guarantee that the sum is 1, and the largest number of intervals, in particular, such that the median is distinct between all these intervals. Okay. And therefore, at the end of the day, we selected 9 intervals, which at the end are 9 time series. So this is the proportion of people that reported the numbers below -1. This is between 0 and -1, and this is 1, and so on and so forth. Okay, and you can see actually some, I mean, I don't have time to dig into it, but you can see, for example, in times of crisis, right, the proportion of these middle guys kind of tend to go down, while the proportion of the extreme tend to go up, as you can see here. So that means that during times of crisis, kind of the dispersion increases of this inflation distribution. Then we're done. We have these 9 aggregate proportions, and we can build our VAR. So our VAR is built like this. There is an expectation block in which we have this 9 time series plus sentiment. And that's because the Michigan survey, they also report sentiment. And then it's difficult to understand if it's sentiment or inflation. So we treat them as one single block with therefore 10 shocks. There is a macroeconomic block in which we have the consumer price index, industrial production, federal funds rate, the standard. We control for real oil price and 3 measures of uncertainty, 2 measures of uncertainty, solely financial and macroeconomic uncertainty as from Jurado. And we have a battery of robustness on that. So we model the VR like this. We model in deviation from steady state alla Villani, and we have monthly data from 83 to 2019 for a total of 422 observations. Why we use consumers? Because we want a distribution. So on average, we have 500 respondents from minimum 500 to maximum 1,500. We cannot use really SPF, which has only 30 people. Okay, so that's the main thing. So identification. How do I identify? We identify shocks to the expectation block. So it's a timing identification. So households are going to fill the questionnaire on the 3rd week of the month. So that basically means they do not observe the monthly inflation, interest rate, or industrial production. So they don't know the data about the macro variables. So we're going to assume that on impact, the macro variables does not affect expectation because of the timing assumption. On the other hand, since we know, as has been discussed today, that actually oil price is a very salient price, it's very much related to gasoline, and people do observe that when they fill the tank. This is actually endogenous to expectations, also as a control, and the same for the uncertainty measures. So basically, the block is like this. So you have that uncertainty and oil price are first. So the shock affects all the others. Shocks to the expectation blocks does not affect oil price and uncertainty. And a shock to all the other macro variables does not affect the expectation block. Okay, so that's the important thing is that this block, if this block recursive structure, people might question that. So we have a extensive robustness check, making endogenous first only the interest rate, because you say, they get a mortgage, so they observe the interest rate. And also we have a robustness basically reverting the complete block structure. And the results go through almost quantitatively the same. Okay, so everything I would say is not depending on the identification, if we do believe that this is a good identification. So for the rest of the talk, I will go on with this. Results. Am I doing with time, Damian? Okay, good. So that's the steady state distribution. So these are the 3 approximate distributions. So that's the discrete, the red one, that's the kernel, that's the blue, and this is the Gaussian. what we're gonna, so the first results, we're looking at the forecast error variance decomposition. And what you can see here, so that is how much of the expectation block variance decomposition is explained by the macro variables, CPI, industrial production, interest rate. And you can see that is not much. We have 9 lines here because these are the 9 time series that I show you about. So there's a different, point of the distribution of inflation expectations. So the right tail, so the red dash line are the guys that have high inflation expectations, and the left tail are the guys that have low inflation expectations. Uncertainty and oil prices instead do explain a bunch of this first error variance decomposition. So first of all, it seems that expectations are barely affected by macroeconomic shocks. And by the way, this is also true if you look at the lagged coefficient in the VR. Okay, they are almost zero for the, and this do not depend on identification. The second thing is that if you look at the forecast error variance decomposition of the macro variables, exogenous variation expectations do affect the macro variables quite a lot. That's the blue area. And you can see that they can explain quite a lot, especially long horizons of the forecast error decomposition, variance decomposition of consumer price index and industrial production. If you do a Gaussian, if you use just a Gaussian instead of using either the kernel or the discrete, you're going to miss that big time. So that is going to be the variance explained by the expectation block of the macro variables for variance forecast error. And you can see that if you use a Gaussian approximation, you're going to underestimate it quite a lot. So now we look at the density impulse response function, something that actually Christian talked about. So what we can do now, we have these 10 shocks, and we can move the shocks and do any. Of course, there are 10 shocks because there's also sentiment. So we're going to apply Antolin Diaz's kind of methodology to show the 10, to select the 10 most likely shocks that may induce the movements we are interested in. So that's a mean shock. So that's a location shock. So that's the baseline distribution. That's the dashed blue line. And we shock it, we move it to the right. Okay, so that's an increase in the mean of inflation expectation distribution without changing the shape in the kernel and in the discrete case. So let's look first at the left here. So here we have the Gaussian and the kernel. And you can see what are the effects of an increase in the median inflation expectation. Consumer sentiment goes down, and with that, industrial production and consumer price index goes down. So this is a stagflationary shock, right? So in which, consumer prices goes up. This is a stagflationary shock in which industrial production goes down and inflation goes up, following an increase in the median inflation, or the mean of inflation expectation distribution. If you are going to use the Gaussian, then there will be the gray line. You can see you're going to you find the same results qualitatively, but quantitatively, you're going to underestimate the results quite big time and significantly so. On the right-hand side, instead, you have the same kind of experiment looking at the kernel and the discrete. And you can see that you find pretty much the same. The only thing that, as expected, the discrete has a lot of, the bands are much bigger simply because of the nature of the data, right? It's because the discrete approximation obviously had much higher variance. So what we're going to do, we're going to proceed with the kernel from now on. Or that's, we choose kernel as our baseline characterization. So then, as I said, you can look at dispersion shock, but dispersion, is a very general concept, and there are countless ways to do it. So you should tell me what you want to show. Joke. So you can have a variance shock, right? And then you just, stretch the distribution out. You can have a kurtosis shock. You can have skewness shock. So the only thing I'm going to show you, so if you're interested, you can look at the paper. For sake of time, I'm going to show you a tail shock. And in particular, I'm going to show a tail asymmetric shock, because of course you can also do any sorts of asymmetric shock. You can increase the variance by increase the variance only of the right of the distribution or of the left of the distribution. Or a tail shock means that basically you take the tails and you stretch them out. Okay? So that's what we mean by a tail shock. So that's a symmetric tail shock. So you take the tail of the distribution and you put this mass basically on the tail and this mass here on the tail. And you can do it even by doing only on the left or only on the right tail. Okay, so we're going to look at the symmetric and the asymmetric case. So the tail shock, let's look first at the symmetric case. So that's the black line. Again, sentiment is going to drop like crazy. So that's, but that's also in line with the literature. We know that these guys, consumers, when they see inflation that goes up, this is bad times. This is, there's plenty of paper that shows that for consumer, this simply signal bad times. Sentiment goes down, and through sentiment, industrial production is going to fall quite a lot, and also prices are going to fall. So this is a shock, which is little at the beginning, is recessionary, and eventually will become stagflation if you want, because eventually prices are going to go up. So let's look at the asymmetric case. If you look at the left tail, so that case here, you can see that the left tail reproduce almost exactly the same results, while the right, nothing happens, or very little happens to sentiment and to the consumer price index, and just production actually going the other way around. So all the movements in the symmetric case comes from the left tail. So the left tail is the one that matters in producing these results. And you might wonder, okay, with the left tail are crazy guys. They tell us -10, -20, right? So, and indeed, we look at the characteristic of these guys, because we can look at, and apparently these guys are relatively more educated. They have relatively higher income than the other guys. Okay, so these guys on the left tail are the ones that have capacity to spend. And maybe from their point of view, this is not too surprising. So the left tail is actually the one that matters. That's one thing that you should take home. So what are the main policy implications? So if with the 2 minutes, this is kind of a heroic thing, but let's assume that you can move the distribution by talking the distribution of consumers' expectations, even if we know that consumers don't listen to us. If they listen, it's not clear that they understand us, and if they understand us, it's not clear that they follow as we think that they should, right? So, in a sense, this is a very heroic scenario. But so we do 3 scenarios. So the first one, we just perturb the steady-state distribution with the ideal distribution. That's a distribution which is Gaussian, centered on 2, exactly as you would like. The second one is simply a location shock that we have already seen. So we just move the distribution. We center now to 2%, but we don't change, don't touch the dispersion. The third one instead is a kind of mumbling kind of communication in which you are able to just center at 2%, but actually you confuse people such that the tail becomes even bigger, right? So that the distribution becomes much more dispersed. And that's a generalized normal. So what do we find? And with that, I'm finished. Damian is becoming nervous. So you can see here that you have the normal, okay? So the normal, that's good news. So industrial production goes up, consumer price index goes down, sentiment goes up, all right? So if you're able to do this, good, thumb up, okay? But if you do the location, we already know, you go quite, we already know, because that's a location shock that I already show you. So industrial production goes up, prices goes down, but not as much as in the blue. That means that actually there's a value added not only in changing the mean, but also try to shrink the distribution and make the distribution kind of less dispersed on the mean. And then look at the third case in which you are able to do the location, but to move the mean, but dispersion actually increases. Well, then you're doing real damage, because industrial production is going down, sentiment is going to tumbling. Sentiment is really skyrocketing down. Industrial production is negative, and the consumer price index actually goes up for a while. Right, so that's the message from this graph. I think is that it's much more, or can be even more important to, convince people that of not disagree too much, rather than locate to 2%. And in particular, again, here is the left tail. So if you want to go out, you have to go out, convince people that inflation is not going to be 0, or it's not going to be -1, or 0 or 1, right? But these are things that, because the left tail is what matters, the left tail is the one that you want to kill. Okay, I think I'm out of time. So we have proposed, I think, a very simple, and in particular, something that it's easy to, I think, interpret, because it's difficult, no? For example, there is this paper by Schofeider, others looking very sophisticated, putting non-linear approximation of using non-linear approximation distribution, but this is very difficult to interpret. I think this 9-time series in which we approximate the distribution very easy to interpret. And then, you can do a bunch of experiment, and we find that household inflation expectation do affect macro variables, while the opposite is not clear that it's true, or at least we don't find much evidence for that. A positive and dispersion shock is stagflationary, and a tail shock too, even recessionary, and the left tail is the one that matters the most. Thank you very much for your attention.
Thank you very much, Guido. Michael Herman will do the discussion.
Yeah, thanks a lot. Thanks for having me. It's great to be back here. Already on. Okay, here we go. So slides up. Thanks for picking me. This is a super interesting paper. I really enjoyed reading it, and I also anticipated that Guido would do a great presentation. So I don't spend a lot of slides summarizing the paper for you. I hope you all got the message. I'll just repeat 2 or 3 parts of the message that I'll pick up upon afterwards. So, I mean, there's the augmented monetary policy BVAR with the Michigan survey, heterogeneous inflation expectations. We see inflation expectations react little to macro developments. In contrast to the other way around, the macroeconomy reacts substantially to inflation expectations. And here the point really is we need to look at the entire distribution. And then there's this very interesting asymmetry with respect to the tails. Okay, so shocks to the left are much more important than shocks to the right. So the people with the low inflation expectations, these are the people we need to look on. And then the paper draws conclusions for central bank communication. Again, focus on the tails, given how important they are. This is much more effective than anchoring the mean. So my overall take is, this is really a pleasure to read. It's very well written. I think it's a super interesting question. It's very well executed, so I learned a lot. And I find the results thought-provoking. So that's always nice if you're a discussant of a thought-provoking paper. So I can really recommend reading that. I think it's a very nice paper. So let me start with my first set of comments on what I call the curious asymmetry of tails, because the paper doesn't really give us an economic explanation. Why would the left tail be so much more important than the right tail? So I was wondering, is it really an economic fundamental asymmetry? Is there a theory that helps us understand this? Or is it a period-specific effect? Or maybe is it a compositional effect that we have in the data here? So let me first think about the period that the paper analyzes. So they have data from 1983 to 2019. And I just plot very simply here CPI inflation in the United States there. You can see there's a couple of episodes where inflation is pretty low. And we all remember that inflation was close to the, very much below target. We also have a couple of episodes where inflation is somewhat elevated, but it's nothing compared to an extended sample of, say, 1978 to 2025. Now, the Michigan survey data do exist from 1978 to 2025. Now, I understand you didn't want to include the COVID pandemic in there, but still, I wonder, could it be that the sample you have picked basically just doesn't give us enough variation in the right tail? So there's variation in the left tail, but just because of the sample, we really don't get any variation in the right tail that helps us identify this, and that leads to the asymmetry of tails. The other question is it maybe a compositional effect? So Guido already mentioned in his presentation, the people who sort of sit in the left tail it's not a representative consumer. Actually, they run regressions and they find out these are people with high income. And the paper then argues, these are people who matter for macroeconomic outcomes. So I took out the microdata from the Michigan survey, and I just plotted the distributions of high income and low income households. So this is 1 year ahead inflation expectations, bottom quintile versus top quintile. I think this chart is really interesting. It shows a couple of things. So the first thing is the red clearly has a lower mean than the blue. So high income households have a considerably lower mean inflation expectations. But there's also much lower dispersion. So you see the whiskers of the red box plots here are much smaller than those of the blue. In particular, if you go towards the end, which admittedly is not part of your sample, I still thought this is very interesting. Now the red sort of respondents here are also much less likely to be in the upper tail. I mean, just look at the very last set, so 2024, where the red whisker ends. This is basically where the blue whisker just starts, okay? So these low-income households, basically they populate the right tail. The high-income households are much more likely to be part of the left tail. Now, given that the blue is so dispersed, I'm just wondering whether the blue households or the low-income households actually have just a very inferior signal-to-noise ratio, right? So I was wondering, what if you just looked at the high-income households? Not very democratic. That's not what you're after. But if you only include those people who probably have a higher signal-to-noise ratio, would you actually be able to get rid of what I call a curious asymmetry of the tails? So is it a composition effect? Is it a time-specific effect? Or is it really economic fundamentals? Very quickly, the paper doesn't really talk much about the role of uncertainty, and I think this is important. I think it should be discussed because it shows that both shocks that raise the mean and the variance of inflation expectations are stagflationary. Now, we've seen work that tries to disentangle these things. So if you actually run RCTs where you increase the mean of households, the variance also, uncertainty also increases, right? And there's a very nice paper produced by colleagues here at the ECB, which disentangles this and actually shows that raising the mean actually does lead to lower consumption, whereas, leads to higher consumption, whereas raising the uncertainty, which happens simultaneously, actually lowers consumption. So disentangling these two effects, I think would be interesting, at least talk about it. You cannot do it with your data. And then my question would have been, maybe do look at the SPF, which allows you to disentangle mean and uncertainty effects. And the last set of comments are, of course, I couldn't help it, implications for central bank communication. That's sort of my pet topic. So the paper does all of these scenarios. I think it's super cool. So it asks, what if the central bank moves the mean closer to the target? What if it decreases disagreement? Or what if it only targets the tails? So there's various scenarios. It's very elaborate, very well done. And of course, given the importance that's given to the left tail, the paper then, at least in an earlier version, concluded that a central bank should focus its communication on convincing consumers that inflation will not be too low. So basically target the people in the lower tail. Now, granted, I think we all understand central banks should make sure that the left tail does not break away. Central banks are very cognizant of this. Remember, obviously, at the effective lower bound, inflation was below target. Central banks made huge effort to make sure inflation expectations don't fall through the floor. But central banks are equally concerned about the right tail. And again, we've just seen this now in the more recent post-pandemic inflation surge, or the ECB strategy review was all about symmetry. Or in the panel, we've also heard this, we're worried that inflation expectations are unanchoring to the upside. So central banks don't have this asymmetry. And I'm wondering, how should we interpret the statement in the paper? Is this a time series question? So is this central banks should worry more if the entire inflation distribution drops down? Or is it really more a cross-sectional question, like, always target those people who are at the bottom of the distribution? Now, maybe things are not as complicated as you have them in the paper. Again, it's very elegant, but maybe central banks can actually achieve all of this at the same time. If you look at the outcomes of information treatments, typically what they do is not only both, so they, at the same time, they move the mean closer to the target, they decrease disagreement, and they take people out of the tails. So this is an example of a Bundesbank study where you can sort of see the red distribution. You know, people are taken out of the right tail. The whole distribution moves closer to 2%, and the dispersion is much less pronounced. So these things are not separate communication scenarios. With one communication, you can actually achieve all of this. And similarly, paper on the US, Michael Weber is a co-author of that paper, shows the same thing. So not treated households have these inflation expectations on the blue line. As soon as you give them an information treatment, be it the target, be it the central bank forecast, or be it past inflation, you actually in particular reduce the mass in the right tail, but you also reduce mass in the left tail. You move them closer to 2%, and you reduce dispersion. So it seems a magic wand here. They can do all of these scenarios in one go. And looking at this, you know, then I sort of thought, you know, my earlier take coming into this, you know, working on central bank communication for a while, I haven't changed my prior here. I think central banks should focus on the first order importance issues, that is, provide information about the target, and that achieves a lot of the things that you have in mind. Maybe make people better understand, enhance financial literacy and trust. And then if A and B are insufficient, then work on the tails, but in a time series sense. So if the distribution really shifts down or up in a symmetric way, you know, that's something central banks should focus on. I think I'm out of time, right? So I'll skip the other comments, and thank you.
Thank you, Michael. We'll collect a few questions from the floor and then let Guido reply if that's okay. Jean-Paul.
Thanks. Fascinating paper, Guido. So I'm trying to understand. So, okay, so this stagflationary effect seems to be the same thing that, you know, we learned from Koibion and Gorodnichenko about inflation expectations. And kind of it sounded like, you know, we now know it's there, but at some level, I want to kind of remind us that if that's how the data looks like, we should be, you know, a little bit uncomfortable, because it really is at odds with the standard New Keynesian model. Because if what's going on is that people have these stagflationary beliefs, it means that really what drives inflation is this shocks for which we don't have a good theory, these non-structural shocks. And, you know, that's number one. And number two, if we really think that monetary policy's job is to control inflation expectations, then it means, first of all, it means that, you know, exogenous monetary shocks are not going to move expectations, or agents are not going to really, you know, attribute any inflation movements to monetary policy. And moreover, you know, even the systematic component of monetary policy is not going to have the effects that our model predicts. So that's one. And the second is, so what are your thoughts about that? And the second is, so if I follow, given that effect, it means that a central bank that cares about this lower tail of inflation expectations, and, you know, by communication, let's suppose that tail is below target, and, you know, a central bank wants to increase those inflation expectations. According to the evidence that you show, is going to have, so it's going to raise inflation and it's going to cause a recession, which is not what I thought we were trying to do during the zero lower bound episode, where we were trying to raise inflation expectations to stimulate the economy, right? So just tell me if I'm completely confused, but, you know, it seems to me that from what you showed, that's the way to think about it.
Any other questions? Yeah.
Thank you. So, Guido, I'm wondering whether one reason why you find that surprising, at least to me, result that the macro block does not affect expectations is because both variables in the two blocks, they're in fact readings of an unobserved state, that is the current state of prices. You know, the people in the survey, they observe prices in their daily life, and this is what then at the end of the month plus some weeks is reported in the CPI. And so have you thought about that, or am I wrong?
One.
You talk about the left tail. I am curious to know who are these households. It seems that this left tail is people at zero inflation expectations. And I'm wondering whether these people, they really believe that inflation is below the target. If you think that prices are stable, this is in line with our mandate. It's not clear that you want to push them to believe that it's 2%. Maybe they are already believing that prices are stable.
I will actually follow up a little bit on Erwan's point. So recently, for example, in the New York survey, they found that after the pandemic, there was a large chunk of expectations that were actually in the negative territory. So we know that, in Michigan survey, variance is counter-cyclical. So that there is in recessions, there is the dispersion of inflation expectation goes up quite a bit. But what New York Fed people found is that after high inflation, their consumers actually thought that the price level should return to the previous value and not the inflation. So it was like this mean reversion argument, or that was prevalent in those people that had very low inflation expectations. Yeah. So maybe we'll give you some time to respond to Michael's discussion and to answer these questions.
So first of all, thank you very much to everyone for all the comments. So I come back tomorrow. No, I'm just so much time do we have?
2 minutes.
So yeah. So let's start with the discussion. Thank you very much, Michael. Lots of comments that we should talk about, think about seriously. So the first thing is why the left tail matters. Extend the sample. That's something we can do. Even though we don't want to take the COVID period for all sorts of problems, we do have actually something I didn't have time to talk about, counterfactuals that we do for particular crisis time. We do it also for COVID. And we try to identify, we shut off the shocks of inflation expectation, see what would have happened if inflation expectation didn't move exogenously in our framework. Composition effect, only look at high income. That's also something we surely can do. Disentangling the two effects and discussing the role of uncertainty. I think this is exactly what we're doing, right? Because we can move the distribution by just moving the location, just moving the variance, or moving just pieces. So that I think we did. Both tails are important regarding central bank communication, point taken. We're not saying that the right tail is not important at all, even though data seems to be to suggest that are much less important than the left. In the communication counterfactual, we do move also both mu and sigma. You say they move together very often. We actually have this counterfactual in which we.
Let me just quickly say. I mean, there's within individual uncertainty and there's disagreement, right? So these two things are different. So individual, how uncertain am I? And the SPF has on the
individual, we don't have anything to say, unfortunately, in the sense that the data we have don't even allow us to do it, right? But that's a good point. So Jean-Paul, I think it's true. This is in line with a lot of RCT's results. But RCTs are about individual. Pretend to say that we didn't have any macro evidence, right? And that's at the end of the day should be the ultimate goal, I think, of all this literature. Does it matter for macro? At least that's my, I'm a macroeconomist, and I want to know if that matters for macro. And I think that's, one attempt to go in that direction. So we worried about all these expectational shocks that are floating around, the Baudry-Potier one, the new shocks, or even the sentiment shocks. As policymakers, well, here an idea is that maybe, as Michael was suggesting, this might be due to signal problems, or communication can help actually to discipline at least inflation expectations. So I don't know about business cycle shocks. Marco, about a distribution of latent, I think oil prices, at least, oil prices uncertainty to some extent are there exactly to try to capture some of this, if there is some things that moves the two blocks together. And I think the literature says that gasoline or oil prices are actually the most salient one. We also, I think, try food, no change. Ervan is true. I mean, this left tail is basically 0 and 1. I remember these are, they basically say round numbers. So these are basically 0 and 1. Then you say that this is in line with our mandate. I mean, this is Banque de France. I wouldn't say so. I mean, yeah, no, I was joking. But still, I mean, this is you know, you like them to be a bit less. I mean, if you have in mind a kind of Gaussian distribution and more people centered on two. And to the question about high inflation, the New York Fed, there is, I mean, I don't remember. It was the last one.
It was just about that in recessions.
Yeah, that's I showed the recession.
But they got some extra questions in their survey, and they showed that.
But that's not long enough. Yeah. No, if I can, sorry, just again going back to Michael saying, you know, maybe you don't have enough movements of the right tail. Oh, one of your first comment.
Or noisy movements on the right tail, right?
Yes,
because it's the.
But actually, we have crisis, and in this crisis, the right tail do move. So it's not really about, you know, having the 70s because inflation is high, but we do have movements to the right tail too in our sample.
But they're not informative.
Yeah, they are not informative. Thank you very much anyway.
Thank you very much. Our next presenter is Michael Weber. He will be talking about information and macroeconomic expectations, global evidence.
Well, thanks a lot, Damia, and thanks a lot to the organizers for putting our paper on the program. It's always a great pleasure to be here at the ECB at the joint conference with the Cleveland Fed. And so, like, what I want to do is talk about some ongoing work we've been doing with Francesco D'Acunto at Georgetown. And now, at this audience here, I don't need to motivate that, but here I just have two quotes from two policymakers on the two sides of the Atlantic. What we thought is actually quite interesting, if you actually follow up a little bit on the speech of Jay Powell, he keeps emphasizing that he cares a lot about the expectations of households rather than maybe looking at financial market participants. Maybe, like, you know, to follow up on what Guido was saying, like, you know, even as a macroeconomist, you might care about households because they might ultimately represent 2/3 of GDP, at least in the US. Now, you know, why would you potentially care? It's also a policymaker. So imagine now you set a homogeneous policy rate for everyone here in the room, but for whichever reason, and Cristiano showed it to us this morning already, there's lots of dispersion in 1 year ahead inflation expectations. This would actually transmit into heterogeneity in perceived real interest rate, then which via a consumer Euler equation matters for consumption savings behavior, matters for whether I buy a house, whether I take out a mortgage, which type of mortgage I take out, could even actually matter for stock market participation. Now, thanks to the great work that the ECB is doing with the wage tracker, and I look here at Sarah, like, you know, it's also, of course, a concern, like potentially wage price spirals being triggered by inflation expectations. Even normally, like, you know, if you're kind of in times like now, you oftentimes assume inflation expectations are well anchored, so you move around kind of policy rates that then should transmit into movements in real interest rates, and all those things should be going on. In unconventional times, when you cannot move around policy rates to the extent they're stuck at a lower bound, you can potentially move inflation expectations via communication. Again, it potentially shift people's action. Now, if you look actually at the micro data, what's a little bit maybe sometimes worrisome, you tend to see, and this is kind of like where the title of that paper comes from. In 23, we studied homogeneously inflation expectations across 47 countries around the globe. So everything that is non-white is the country that we serve. And that's just tremendous variation in average 1 year ahead inflation expectations. Now, naturally, you would say, well, look, Michael, if you look and compare maybe Brazil to Germany, of course, naturally, there's differences in average 1 year expected inflation, or Turkey and France, just given that the economic environment in these countries is very different. Yet, what you also see is that independent of which country you pick, on average, compared to ex-post outcomes, you see an upward bias on average across all countries. Of course, the upward bias varies across countries. And so like what we now want to do a little bit kind of like, try to understand, is there a way to a little bit make sense of why people on average have upward bias expectations? This is not just averages across countries. Another thing that came up in Christiane's keynote presentation is this kind of systematic variation across socio-demographics. What I'm showing you here, so I'm going back to the work of Joning for Swedish households in '82. You tend to see that women have higher inflation expectations than men, was then shown also in the US and other countries. Here, what you see, if you request 1 year inflation expectations on a gender dummy, you can also take out kind of country fixed effects, or you can take out, when you pool it, here's country by country, you can take out financial literacy, education, and these type of things. By and large, among most countries that we surveyed, women have higher inflation expectations than men. There are 4 countries where you see the opposite phenomenon. You might give it to me that maybe those countries are special. It's Argentina, Turkey, Zimbabwe, and Egypt. And, I don't want to now single in on specific countries, but maybe you are kind of like open to the interpretation that these 4 countries are special. Now, kind of like to set the stage for, some of the questions that we brought to the field into 2023. I want a little bit motivate based on what we did previously and what we found to kind of appreciate maybe. It's not that we randomly kind of came up with asking certain questions. Like, going back to this gender dummy and inflation expectations. At some point, like I was just a first-year assistant professor in Chicago, and Anil Kashyap, who many of you know, completely derailed my first paper I ever wrote on inflation expectations. All my colleagues thought I'm a moron because Anil is the expert, and he completely derailed my talk. Afterwards, Anil told me, well, Michael, it was an excellent presentation. So, okay. But, unless you can explain to me why women have higher inflation expectations than men, I don't think you should work on this topic. Okay, so we went back to the data. We fielded our own survey. It was the first time we worked with the Nielsen HomeScan panel. What is really, really nice with the Nielsen HomeScan panel, given it's such a large cross-section, you can actually survey many people, but crucially also you can survey at the same time male and female head of the same household, meaning you can absorb many determinants of inflation expectations that typically vary across survey participants: housing choice, family structure, household income. Because in our case, we kind of look within household. Is it the case that there's a gap in female versus male household heads inflation expectations? That's what you see on average across 10,000 households in the left bar. Within household, women expect about 0.45 percentage point higher inflation expectations than men. Then you move to the middle bar. What we do here, we simply look at a subsample of survey households where the male household head in the survey declares to never partake in grocery chores. And you see this gap increases by 40 to 50%. And the far right bar, that's a admittedly small sample of roughly a third of our overall sample households, where the male household head declares at least once in a while, I walk down the aisle at the Rewe, I see the price of milk and butter and maybe the price of beer fluctuating over time. And in those households, men have equally high inflation expectations than women. And that's why the difference between the two is economically and statistically zero. So like exposure to volatile price changes, while grocery shopping potentially might be relevant. And so like, just kind of like to then motivate a little bit the framing of the paper, what we try to understand is kind of how to make sense of these patterns. So clearly, like, it's almost like a dead horse. Can fire explain this pattern? Obviously, no. Is rational inattention potentially fully consistent, at least the standard formulation? Can, of course, explain to us like time variation, accuracy, and also dispersion in the cross-section. a persistent upward bias, maybe is less consistent with a standard formulation. And then the question is like, what potentially should we add to such a framework to make it fully consistent with what we see in the data? And that's kind of like a little bit the attempt to zoom out from a single country setting globally to understand what are robust features of the data, or saying it differently, what's worthwhile to shed the light on to potentially then spend efforts making sense of that theoretically. So now what is our kind of like, lens through which we looked at that? So like in April of 2023, together with Morning Consult, it has done amazing work also with the Cleveland Fed, we were fielding a homogenized survey in 47 countries that represent roughly 90% of the world population and the world GDP. We, in the kind of fall of 2022, designed the survey. Then Morning Consult fielded it in January on a pilot version in 5 countries. They then went ahead and translated it across all the countries. And then in April, it went to the field. And as I mentioned, it's like we want to understand like what are kind of features that robustly show up. So like we already saw, lots of dispersion across and within countries. Generically, there's an upward bias relative to ex-post realization. And like also already a little bit, we saw that there's some sorts of demographics that systematically are related to differences in inflation expectation. We want to kind of a little bit understand why do those sorts of demographics relate to inflation expectations. Now, what I want to actually argue now in the next 15, 20 minutes, that this has nothing to do with gender, has nothing to do necessarily with high and low income, but largely it is due to people consuming different sources of information. Like I kind of like, might go to the newsstand and read the Bild-Zeitung, whereas maybe Damian reads the FAZ, because we have differences in coverage of a certain topic in different media outlets. That's could potentially drive differences of our inflation expectation. Now, unfortunately, I might know the different quality of news outlets in Germany. I don't know that globally. So unfortunately, we don't go into that granularity, but it will be like, local information sources, like, walking down the aisle grocery shopping versus aggregate information sources, newspaper or TV. And so like what I would actually want to kind of show you, if I rely on local information sources, this is consistent with rational inattention, I do actually acquire more information when it's potentially more costly to be uninformed. But given that those local information sources might not give me a representative signal of prices, I might actually, when I consume more information, in fact, become more biased. And then what I should actually show you, that demographics relate to inflation expectations because they relate to which information sources I consume, but conditional on the information source, they barely matter for inflation expectations. So I do say women and men on average have different expectations, but not because they process information differently, largely, however, because they consume different information sources when they form expectations. And then like at the very end, I want to zoom out and understand like, why do people consume different information sources? Will then be a cross-country analysis. And here we want to actually argue that it's kind of trust in the producers of aggregate information, the government and central banks. Like, famously think about the case of Argentina. If I have a high inflation environment, maybe the producers of aggregate information have incentives to fudge the data. I then actually have less trust in those institutions. And that's where ultimately I walk down the aisle and look at the supermarket prices that potentially can actually help us understand the sorting into information sources. Now, what I want to do is actually first kind of like, come up with a classification of information sources where we want to then elicit whether people actually rely on these sources in forming aggregate expectations. Like the first one is signals in my daily life. Similar to like a Luke and Islands model, I focus what's happening around me, talk to family and friends, co-workers, or maybe shopping activities. Social media is a little bit kind of like unclear. So Michael has this nice paper that, oftentimes like I focus on what other people are retweeting, but maybe I also follow what maybe at ECB is tweeting. The difference, however, from a Lucas world is that potentially when I kind of source from those local information sources, I might not get an unbiased signal about the aggregate price. And what I mean by that, this came also out in the panel by Dave earlier. And so like, this is based also on some previous work, so where we use the scanner data and then create at the individual level a measure of realized inflation, meaning that's crucial, individual bundles and individual prices paid. You create at the individual household level kind of Chandler's pair price index, and then you bin people based on own realized inflation in the past 12 months, and you just collapse and look at their 1 year ahead overall CPI inflation expectations. You do see that people expect higher overall inflation when higher inflation is realized over the last 12 months in their own bundle. What you don't see here is, in fact, people tend to focus or weigh more good price changes that actually they purchase frequently rather than based on expenditure share and price increases relative to price cuts. And so like this is why we wanted to elicit local information sources. And then alternatively, you can think about aggregate information sources. So here, newspaper, central bank reports, TV, and so on. And so now the first thing I want to show you, based on like those 47,000 respondents, what do they on average state? When you ask them, earlier you told us you expect inflation to be 7%. How important were the different information sources for you thinking about inflation? Like the information sources were provided in a randomized fashion so that there's no ranking effects or anything. And so like if you focus now on dark and light blue, very important or somewhat important information sources that were not mutually exclusive. You do see across all of those survey participants, it seems like, local economy sources, energy bills, shopping experiences seem to be potentially the most important one. People also read government reports, but maybe to a lesser extent. Then you could say, well, maybe if I'm, living in Germany, I trust the government, I trust the ECB. For me, kind of reading those newspaper articles too costly. I just kind of check out what's happening at, let's say Kaufland. I'm not getting paid by Rewe. So like, maybe that's kind of normal. And indeed, you do see, if you now focus on a sample of countries that have below median realized inflation, either in the 10 years or 20 years prior to our survey, you can also look at the below median inflation volatility. You see like, countries like Germany, Japan, or Switzerland, again, like, energy bills and shopping experiences are the most prevalent mentioned information source. But if anything, in countries that had above median inflation or inflation volatility, like all information sources become more important, but especially, again, local information sources. So like, indeed, if I live in Brazil, Turkey, or maybe Argentina, when it's maybe more costly to be uninformed, I do state information is more important, but it's still my local information sources that predominantly I consider as most important. Now you could say, well, maybe that's cheap talk. People just state in the survey that they consider like newspapers less important than supermarkets. Let's actually see, and again, like this is purely survey-based, purely correlation. So like you might disregard anything I say as kind of not interesting or purely correlational, but let's actually just understand whether kind of like what they previously stated in terms of 1 year inflation expectations matters then in terms of like being determined afterwards by the information sources they mentioned. So we don't ask information sources first to make them salient and then ask for expectations. We first have expectations, and subsequent, after a couple of questions, we ask for information sources. And so the regression we run here is 1 year ahead inflation expectations on like a dummy variable that equals 1, important or very important, given information source, zero otherwise. That's pooled here, so we have country fixed effects in there. And then you throw as many sorts of demographics at that specification as you like. Income, age, age squared, kind of education, gender, family status, housing choice, and so on. And what you robustly see in that regression is that if I state, I love to read government reports to think about inflation expectations, you have like by about 3 percentage points lower 1 year ahead inflation expectations relative to someone who doesn't state that. Instead, if you state like, I look at my energy bills for inflation expectations, you have roughly 2 percentage point higher inflation expectations relative to someone that doesn't state they look at energy bills. And this is again within country by adding country fixed effects and saturating with all the type of sociodemographics that we elicit. Now you could say, well, why do you look at aggregate results if you actually have country by country evidence? And that's what I show you here. Now what we do, we standardize inflation expectations at the country level. We then use standardized 1 year ahead inflation expectation, regress it on source dummies, and again, sociodemographics. And you see like across most countries in the top row, if you adhere to aggregate information sources, you have lower 1 year ahead inflation expectations. If you focus on local information sources, you have higher 1 year ahead inflation expectations. And so like, why does it actually kind of result in higher inflation expectations? Because if you read the newspaper, you just think that inflation right now is lower. And then we know from going back to Yonung, perceptions tend to be the strongest correlate of expectations. If I think current inflation is lower, I also expect inflation going forward will be lower. And similarly, if I look at my energy bills, I think that inflation is higher than what it actually is. And that's why I form higher 1 year inflation expectations. Now the title is about macroeconomic expectations, not about inflation expectations. So therefore, I also want to show you briefly that similar patterns hold if you focus on the left house price expectations, on the right interest rate expectations. But for the rest of the talk, I want to focus now on inflation expectations. You could say, well, look, of course, information choice is highly endogenous. I'm totally agreeing with you. One way to potentially get a little bit closer to causality is to exploit an intensive margin. So for like grocery exposure and gas price exposure, we elicited within the survey how often people go grocery shopping and how often they pass by the gas station. And again, of course, depends also where you live, whether you go shopping at kind of a, I don't know, a Target versus Whole Foods and so on. Again, so like I don't want to kind of push that too far, but you do also see more frequent exposure, both along the grocery domain and the gasoline domain also results in higher kind of forecast errors for inflation in both of the panels. Now, coming back to how I started out with, like, and this goes back to our discussion throughout the day already. We have like this evidence across decades now that there are some sorts of demographics that reliably correlate with 1 year ahead inflation expectations. Now we want to understand, like, on the global scale, what can potentially help us understand why certain sorts of demographics differ in their inflation expectations. And I remember like last, I think October, and when Anna Maria Lusardi gave her keynote speech, I think at the joint ECB conference with the New York Fed and the Bank of Canada, she actually made convincingly the point that financial literacy would be really important also for central banking. And so that's why we also had focused actually in like, how literate or financial illiterate different countries on average are. And now what we want to see is kind of like, can those different variables help us understand why we actually consume different information sources? And so like, what I want to show you now is like, it is true that unconditionally in country by country, if you have a college degree, you have lower 1 year ahead inflation expectations than if you have no college degree, but conditional on which information sources you use, there's pretty much no difference whether or not you have a college degree. So let me say that again. College matters for whether you say I read the newspaper or government reports versus I look at my energy bills or my shopping experiences. But fixing newspapers, and this is what you see the far left bar for college and the far left bar for less than college. If you read newspapers, independent of whether or not you have a college degree, you have lower inflation expectations instead, independent or not whether you have a college degree. If you state you look at energy bills, you have higher inflation expectations. It is the sorting that matters, not the processing of information. Now, just briefly flip through a couple of those pictures. The same if you have economics degree or not, if you are above or below median age. Now, I wanted to say older or younger, but now I'm also almost old, so I don't want to say that anymore. Like whether you're male or female, doesn't matter. Whether kind of like, any of the other things I had like on the graph. And so now what I want to do is kind of zoom out and look at cross-country evidence to a little bit understand what potentially might help us understand the sorting. And so like, here, just to give an idea, there's lots of variation of whether people state, I look at local versus aggregate information sources. And so like, what we kind of like argue is really important is kind of like the trust people state in like governments and central banks. We had kind of a battery of trust questions, also trust in commercial banks, international institutions, and so on. What I'm showing you here is a principal component of trust in governments and central banks, just because they were so highly correlated. You keep constant trust in other institutions. And what you see here, and like, at first you might say, well, this is a little bit of a tautology, but then, I think it's actually quite meaningful. If you state that you have trust in central banks and the governments of your country, you kind of are way more likely, country by country, to read newspapers, to get news about inflation, to focus on TV shows, get news about inflation. Of course, also government reports. Instead, it's unrelated of whether or not you kind of look at kind of grocery prices or energy bills. So like, like the way I think at least about these correlations is naturally if I live in a country that had a history of high and volatile inflation, and that's of course also like quite concerning, like right now in the US, at some point I might lose trust in the producers of those aggregate statistics. I might no longer, I'm sorry to now say something negative about the BLS, given that we have colleagues at the BLS here in the audience, but I might no longer trust the statistics of the BLS, and instead might actually, and this is actually why the Billion Price Project came about, I might actually try to maybe get alternative data sources. And that's kind of what you see here. If like people do have high trust, they indeed actually rely on official sources, they have lower expectations. Instead, like, if you don't kind of like trust the producers, naturally you will not actually read government reports. And so like, coming back to like the motivation at the beginning, like, at least the way I think about it right now is like, what you would need to do, like people do kind of get more information when they live in a setting that is more volatile and where inflation is higher. But of course, endogenously in these settings, you might also, at least over the medium run, lose trust in the producers of aggregate information. And so therefore, like, potentially what, like, the way to extend the standard rational inattention model is like to allow for the information sources to not be biased or representative of the overall price, as Lucas says. And like more generally, I think, that, our findings potentially also shed light on the importance of building trust by institutions. And, of course, like was already alluding to, like right now, it's of course, at least from a research perspective, a really exciting time where you can see how potentially undermining trust in institutions could potentially also result in unanchored expectations and all the ramifications we were discussing earlier. Thank you.
Thank you, Michael. The discussant will be Fiorella De Fiore.
Thanks so much to the organizers for having me to discuss this great paper. It was really exciting to read. So what the paper does is to relate to two robust findings in the literature on consumers' belief, the large dispersion of macroeconomic expectations and a persistent bias across consumers over time. The evidence is typically drawn from a single country type of data sets. And so the paper here today asks three type of questions. Is dispersion robust to an homogeneous elicitation of beliefs at the global level? Are there common drivers at the global level of this systematic bias that we observe in expectations? And can mainstream models explain the evidence? So what the paper does is builds this impressive global survey for consumers' expectations and perceptions covering 47 countries. And there are lots of findings, as Michael was showing. I will summarize it in two main ones. The first is that households' macroeconomic perceptions are consistently upward biased. And the bias is heterogeneous across countries and is also larger for consumers that tends to acquire information from local sources. The paper also provides evidence on the information acquisition of consumers and their update of beliefs. And what it finds is that consumers in countries with higher inflation try to acquire more information, but they also make larger errors because they tend to draw more on local information sources. And rational attention models predict something else. So they do predict that higher inflation should lead consumers to collect more information, but they also predict that the bias should decrease over time as more information is acquired. And so the reasons for the discrepancy between theory and evidence is a neglect for trust and for the quality of information in this kind of models. So my discussion will have two comments on the general results of the paper and one on the ability of rational inattention models to explain the evidence of this paper. So the first comment is about the classification of information sources into aggregate versus local, which is inherently a bit imprecise, and that's because, of course, you can think of social media that here are labeled as a local type of information sources, as reporting as much aggregate as local information, depending on the reader and on the type of social media. You can think of work-related activities that are here labeled as local, as generating aggregate information for professional use. Or you can think of newspapers and TV that here are labeled as an aggregate source of information, as having also local newspapers or TV channels that focus much more on local type of information provision. And so I wonder whether this type of difficulties in the classification can lead to strengthen the link between local sources of information and high expectations and biases, and vice versa for aggregate sources of information and low expectations. The second comment is about the take of the paper that low trust induces agents to use local information sources, which send less accurate signals about the aggregate economy and therefore are more prone to perceptions errors. And here, this finding is based on various pieces of evidence in the paper. I cannot all show, but let me summarize them as being, for instance, the fact that there is a positive relation between higher past inflation and the use of all sources of information except the official reports, which the authors take as hinting at a loss of trust in governments after periods of high inflation. A second type of finding is that the trust in government and central banks correlates positively with the willingness to use official reports. So if you think that a country has been characterized by high inflation in the past and today there is a lower trust, you will tend to see that that country, consumers in that country tend to read less official reports. And so the issue is that the evidence also points to a positive correlation between trust and all other sources of information, which to me point to a lack of reallocation of attention of consumers from aggregate to local sources of information. And this may matter because reducing information acquisition from official sources without replacing it with larger use of local sources may not be conducive to a higher bias. And indeed, the results suggest that there is a limited role of the level of trust, whether high or low, in affecting the relation between the sources of information and the biases in expectations, which is what this figure shows, that there are differences in coefficients, most of the time not very large, but in particular it doesn't seem that they are significant, but something to be checked. The last comment is about the role of rational intention models and whether they can account for some of this evidence. There are the typical rational intention model postulates that the cost of information acquisition depends on the learning of agents, and in particular that the costs are a function of the entropy reduction or of the remaining uncertainty after observing a signal from the information source. And this is reasonable when agents are sure about the amount of information they can extract from a source. But there is an alternative type of model that model cost of information acquisition as a function of the total source capacity. So, basically, they postulate that the costs are a function of the maximum amount of entropy reduction of an information source. Think of, for instance, a broadcast where you need to pay to get access to the information, but you don't know exactly what information you will be able to gain as novel information. So maybe 90% of what the broadcast give is something you know already. Only 10% is new, but you need to pay for the entire amount of information produced. And so this latter class of model can, I think, generate endogenous choice of the information source and also persistent errors that are more in line with the evidence of this survey. So let me quickly give you an example of how this type of models can reconcile with the evidence, largely based on an example given by Nimark and Sundaresan. So here, think of a state, omega, think of it as inflation, taking two values, 0, 1, and the signal S that also takes the value of 0 and 1. And an agent's prior belief that inflation will be high with probability pi. And then define an information channel, capital S, by the error probabilities of the signal that this channel can produce, S. And then entropy here, or the expected information about the state variable omega, is given by this function omega that depends on the priors on the state. And so you can think of two concepts: revealed information, I, that is the amount of information you can get after observing a signal, and another concept that is channel capacity. So this is the maximum amount of information that a channel or an information source can release across all the possible priors of agents. And so these two concepts lead to alternative definition of the cost of acquiring information. One, gamma I, is a shared theta of the amount of the information released, I. And the other one is the cost gamma C, that is a fraction theta of the maximum amount of information that can be released by a certain information source. And here, the information released is given by the expression. What matters here is that the more precise the signal is, or the less informative the signal, the closer to 1 is this, the closer to 0 is the log, meaning that the information released by this channel tends to be low. And so depending on how you model the cost, you can have very different implications, because if you model through cost of acquired information, the value, the cost of this information when the prior is very precise goes to 0, while if you model it as a cost of channel capacity, it remains independent of this prior. And so the implication is that if you have this cost of acquired information and the priors are very precise, this decreases the value and the cost of these new signals. And so agents, they keep acquiring information and updating their beliefs until the prior is equal to the posterior. But if you model is at this cost of channel capacity, then the value of an information when the prior is very precise is low, but the cost doesn't change. And so agents decide not to acquire very expensive signals and not to update their beliefs. And so this model create a confirmation effect where agents can choose channels that are more likely to confirm their priors. And so these lead to beliefs that come out of random signals but become self-fulfilling, and they lead to permanent clustering. So how does this explain the survey results? Imagine that there is an agent that has low inflation expectations, randomly get into an official source that tell him that inflation is low. Then if the prior is precise enough, this agent will choose to keep sourcing from the official report and will stop updating beliefs. And the same will happen to agents with high inflation expectation, meaning that there will be clustering of beliefs in very different levels of high and low inflation and high and low biases. Let me conclude here because I think I'm out of time, but great paper.
Thank you very much, Fiorella. We'll collect a few questions from the floor. Yes.
Thank you. Striking results, Michael. No, I was just wondering about the interpretation. So do I understand correct? So you feel this one particular point in time, no? So I was wondering, is it correct to take away that, okay, we observe the sensitivity of expectations to local information, but the bias that you showed could be just specifically dependent on that particular point in time where you fielded the survey?
Other questions? If not, I'll let Michael respond to the discussion and this question, and perhaps we'll have some more questions.
Yeah, so like you're totally right that indeed, like, this is from a one-off survey. Now, you do see similar patterns in terms of like how consumers react to information sources in different inflation environments. This is where the cross-country comparison actually comes in handy. But ideally, you would also want to see within country over time. Like, there has been a little bit of work doing that also. But I think this is now an excellent opportunity to kind of advertise kind of like some work we are doing in collaboration with colleagues at the BIS, and in particular Fiorella also here. So we had actually another wave of global surveys in the field earlier this year, and we were just earlier in the coffee break discussing like redoing that with kind of like a special add-on modules also next year again. So hopefully kind of like in one of the future iterations of the conference, I can give you a more informed answer relative to what I was just saying. So like I also briefly want to kind of like take the opportunity and thank you a lot, Fiorella, to kind of like for the great discussion. And, I'm definitely totally with you that, some of the distinction in terms of local versus aggregate information sources are less sharp than, ideally we would want to do that. As I alluded to, like, if you do a single country study, I would also, even with the newspaper, want to kind of stratify a little bit, based on Michael's finding. Also, Twitter is somewhat ambiguous. I'm totally with you. Now, similar for high and low trust, I think it matters mainly for the sorting. Then conditional the sorting is like not that important anymore. And actually, like, yeah, need to look a little bit more into the paper by Chris Niermagen you mentioned. And so, like, at least as far as I understood it, it couldn't explain persistent biases and clusters. I'm not totally sure I've followed completely. That would actually help us fully explain, but I think, you said like can partially explain. I think that's potentially it. Why in high inflation countries, people are more likely to sort into local information sources and then have a higher bias, but I need to go back to that paper. Thank you so much, Fiorella.
You have another question?
Thanks. Super interesting presentation and also discussants' comments. Michael, I guess one thing we're trying to do at the Bank of England is move into different communication channels. I believe I'm going to be doing my first interview with an influencer very soon, and I know a lot of others are using these routes, and we've started to use it with things like banknotes and more sort of tangible things, and now we're branching out into trying to condition inflation expectations. But I can't remember from your slides, but they looked quite conventional channels that you had, and I guess it's a version of Fiorella's point in a way, as channels become more blurred. Or one of her points, as channels become more blurred, because I mean your results are really striking, and I just wonder, as you know, as everything, the media world just becomes more, or sorry, the reception for our messages becomes more and more diverse and dispersed. And I guess what you think of that, but then I guess I'd be interested in any views on whether these efforts, I mean, I must admit, I go round my local shops in London, and I'm sure I'm slightly influenced, even though I am a, rate setter. Sorry, I'm not sure if there are any media, but you have to sort of sort through all your sources and then deal with any biases. But I'd be interested in any views on that kind of direction that central banks comms are taking, in terms of going down the social media and even the influencer route. And I'll stop there.
Damian, how much time do I have?
I'll give you 4 minutes.
Okay, perfect. Like, I think that's a super interesting question and initiative. And like, let me maybe just take a little slight detour. So like, when I remember, it must have been maybe May 2019, I was presenting an early version of the paper with Korbjorn Gornichenko in Central Bank Communication at the ECB. I remember there were many comps people, and like they afterwards kind of said, yeah, we already use social media for communication. And like, in particular Twitter. And so like, I remember I was asking, what's kind of like the Twitter handle you're using? It was @ECB. Now, the issue is that, people, when they use social media, most people, like normal people, not us here, we are, anyway, like they don't actually follow institutions, they follow people. Now, they might also not necessarily follow a central bank governor, they follow people they care about. And so like, I remember at the time, I got a haircut in Chicago, and I was asking my hairdresser whether kind of like she would care if LeBron James would actually rap about inflation. And she said, well, look, whatever LeBron talks about, I'm interested in. And the background was that at some point, I remember the Cleveland Fed with a former president was considering kind of like doing a little bit of a US version of the Central Bank of Jamaica had done. My understanding is that the lawyers, after all, came and kind of intervened there. But so like, to kind of like cut it short here, I do think like, to the extent you can speak the language, or someone kind of can take your words, communicate it or translate into a language that ordinary people care about, and you borrow the visibility and I guess kind of reach of someone who is an influencer. I can definitely see, I haven't seen like academic work on that, but at least putting those different pieces together, that potentially could be quite kind of powerful. And I could go back, but maybe to the Lego videos of the Cleveland Fed, but that's a different topic. And maybe we can discuss that at dinner.
Thank you very much, Michael. Any other questions? If not, we'll go to our last paper in this session. So Raphael Schoenlein will present how inflation expectations de-anchor the role of selective memory cues.
We're putting on this paper on the program. This is joint work with Nicola Genaioli, Marta Leva, and Andre Schleifer. So what motivates us in this paper is this fundamental question, right? How people form inflation expectations. There's a delay in all of that, which is also related to my first point, right? You're not the first to ask this question. Conventional belief tends to say, inflation expectations are somewhat sticky. And this can be due to many reasons. So this can be because they depend on a time-discounted slow-moving measure of inflation experiences that we have had. This could be because they're processing costs to form these expectations that lead to inattention and rigidity in belief updating. Clearly, inflation expectations depend on experiences and attributes of respondents. So there's definitely a role for socio-demographic characteristics, as well as for mental models, social network. There's also a role for recent salient prices and price changes of salient goods like groceries and gasoline. And there are many, many other papers from people in this room, obviously, who've contributed to this. So instead, let me just tell you what we do in this paper. So when we look at inflation expectations in the recent period, the data actually show just the anchoring in 21. There's not a lot of stickiness. Then we present a model of inflation expectations that's based on memory and selective recall, work by my co-authors. And we provide evidence for a state-dependent inflation expectations formation mechanism that is micro-founded in cognitive psychology, whereby basically expectations tend to be rigid when inflation is anchored, but there's also sharp instability during inflation surges. And this instability, moreover, is cohort specific and it depends on experiences. And finally, we also present some evidence that whether expectations are elicited as a density forecast or as point forecast can actually change the average expectations, as again, I think a lot of people in the room are aware of. So this evidence that we find is inconsistent, particularly with either a Bayesian model or a simple mechanical experience effects model. So instead, we think this points to a psychologically realistic memory model. But to motivate a little bit more the central state-dependent element in belief formation, let me show you two figures here. So the left panel shows inflation expectations in the US, and the lower envelope orangey line is the youngest age cohort. And the right panel shows the actual experience inflation rates where the same color coding holds. And what you see is there is, as we also learned in a very different approach earlier, there's rapid belief updating during the recent inflation surge. And this is more so there for older cohorts. And you might think this is puzzling, right? Because, new data has less of an impact on an older cohort database, it's just longer. But also, as you see from the right panel, older cohorts actually experience somewhat less of current CPI inflation. So a theory of selective recall, especially for high inflation episodes, can help us understand this. This is a more universal pattern. So here you see the same inflation expectations, the same color coding scheme from the US Michigan survey of consumers. Older cohorts, it's the same message, increase their expectations faster than the younger ones, who then catch up. This is also true in this Bank of England inflation attitude survey. You see exactly in the same color coding, normalized to 1 in the beginning, right? There's a faster increase for the older cohorts, and again, the younger tend to catch up. Look at the ECB consumer expectation survey, again, same color coding, slightly later start of the data set. You again see the same pattern. You can look at the Cabinet Office consumer trend survey from Japan. Again, the same color coding, again, same normalization. You see a similar pattern here of old versus young and dynamics. And then finally, let me give you also some motivation that relates to the density forecast, which is going to be important to a central point about the inconsistency in forecasting that we find. So here you see in these three panels the weight that respondents attach to low, medium, and high inflation during the same episode. And you can see very clearly that the older cohorts in the US shifted weight to higher inflation ranges, while the younger tend to stick to the middle ranges. And there's not much going on in terms of economically meaningful levels on the lowest range at that period. So I'm going to show you a model next, which builds on regularities on selective recall based on cognitive science. Usually what tends to happen in these experiments that are relevant is that they ask, how do we recall what we have experienced? So you might be given, for example, a set of cards. They have words like tape, mole, dad on them. And you do something else. And then you ask to recall what you've just seen. And people recall words like ring, girl, or dad. And what's behind the likelihood of recalling certain cards is really primacy, recency, and similarity. So what are these things? What this figure shows you here. So the left panel shows you the recall probability for these cards depending on the serial position of presentation, while the right-hand side figure shows you the probability of recall depending on cards' word similarity with the cue that you're given. So the retrieval or the probability of recalling from your memory database or what you've shown depends on similarity in a temporal context. So in a U-shaped fashion, as the left panel shows you, that is, there is recency, but also primacy. So things that you see in the beginning and then at the end are most likely to be recalled. But there's also similarity affecting recall probabilities in the semantic context. The similarity between the cue that you're given and then the experiences that you have. So this particular example I gave you, if you're cued with the word parent, you're more likely to recall dad rather than girl. In an inflation context, you're more likely, if you're cued with high inflation, to recall high inflation rather than low inflation. So next, I'm going to show you how to think about these regularities in an economic model of inflation expectations, and then I'm going to present some supporting evidence from US inflation expectations data. The model framework that we build on goes back to my co-author's work, where individuals selectively recall experiences from their memory database when they give them a cue to form inflation expectations. And then the similarity of the experiences with that cue is going to determine the recall probabilities. So the question is really, how do you form these recall probabilities? Well, they're computed based on the database that you hold. In this case, quarterly inflation rates that an individual has experienced since some starting age A. There's some robustness about how you define that. Also, clearly what matters is the cue that you have at the time. So that's the temporal context and the inflation estimation task. Everything is worded, including the event that you consider. So these three features here, for the sake of the model position, are embedded in these in this PyTE. So in particular, the temporal context is going to imply similarity to recent and early experiences relative to your age. And the task itself implies numerical similarity to current inflation PyT that you as the decision maker or the respondent sees, and the event you're going to think about, which we think is described by the average experience about that event. So what is then similarity that's going to pin down this recall probability? Well, it's a function that exponentially decays in the divergence of these features. So consider a particular, so this is the equation here, particular experience pi t minus s, given that vector pi t e. Then there are these three terms here. So let me start with the last two. The last two capture numerical similarity. So this particular experience tends to be harder to recall if it's different from your current task, captured in this case by pi t, and the average experienced values in pi TE. And then the strength of all of this is given by this elasticity sigma. And there's some weights to the different ways of measuring this similarity. There's a first term as well. This first term captures this first figure I've shown you, so the primacy and the recency. And it has quadratic, so it gives you this inverse U-shaped divergence. And then this divergence basically pins down your subjective recall probability in a very conventional way. This recall probability of this particular memory is proportional to the negative of that distance. In particular, more frequently experienced inflation rates in your database are going to be more likely to be retrieved, and less similar inflation rates are going to be less likely to be recalled. How do we get to expectations then and probabilities assigned to different ranges? So believe that you are, for example, in a 2 to 4% inflation range, which can be implicitly or explicitly in the description of this event E, for example, is quite simply the sum of all the relevant recall probabilities embodied by these inflation experiences that fall in the range that I'm asking you about. Point expectations are simply the sum of the subjective recall probabilities times the memories that you have, the pi t minus s. So let me emphasize two things here. So recall and also then the beliefs are state dependent via these pi t and the QQs, but also the beliefs, and this is quite crucial, depend on which event is elicited in this forecast task, how this is described. I think that has really important implications for what we think this is one of the key parts of the paper, for the consistency across different survey elicitations. Okay, I think I should be ready now to give you two testable propositions so that you can take them to the data. They're going to be about the two typical elicitations in surveys, but obviously this is just, everything is just a proof of concept here. You can expand that. So I'm going to talk about point expectations and forecast densities, which basically chop up the real line in different buckets. And I will give you two sets of predictions. First, basically says that in both elicitations, beliefs will depend on the temporal and numerical cues interacted with the frequency in the database. And the second emphasizes that there is a systematic inconsistency between the two elicitations here. And particular density-based elicitations will explicitly prompt you to recall some rarely experienced events simply because they force you to do so, and that's going to affect your probability that you weight and thereby the expectations. So the second part is really giving us a new implication for the role of selective memory. It tends to reject any rational model, including Bayesian models in which agents hold consistent beliefs. So let me walk you through this first proposition where we think about elicited point expectations. So when you linearize them around temporal context and numerical similarity, you see basically these three different lines, and they're somewhat intuitive. So the first line just tells you that expectations depend on your average experiences. So in particular, in terms of higher inflation, higher inflation during your lifetime, you're going to have higher inflation expectations in the future. And then there's the second and the third row. So the second row basically tells you here that it's easier for you to recall high inflation if your high inflation experiences are very early on or close to the present, so this primacy and recency. And the third row is the newer part. So you're more likely to recall high inflation if your high inflation expectations are quite similar to the two Qs, right? That's the quadratic term that shows up. So if that becomes very small, then you're going to have a negative sign, you're going to have higher expectations. So this is really the essence of this new element of state-dependent inflation expectations formation, right? You can have very sharp belief changes because of this numerical similarity, even if you're a very slow-moving database. So let me just briefly tell you how we bring this to the data. The data comes from the Michigan Survey of Consumers and the New York Fed SCE. This is monthly data. It's like obviously by the nature of the data sets, it's different periods, it's rotating panels. We take point estimates from both of them and from the New York Fed, the density forecasts. We have a source of inflation data. We started everything at age 16, but this is quite robust. And we have a current inflation queue, and we also allow to control for some kind of common signal, the SPF inflation forecast. How am I doing with time, Damian? Okay, so the first set of results from the Michigan survey and the New York Fed sort of provide evidence for this first proposition, and they basically confirm all the three memory effects are there. From the first row, just don't look at the details, right? You'll see that this average inflation experience comes out very significant in predicting your point expectation. And then the second row corresponds to the second row in this proposition, that you have a U-shaped temporal context with both primacy and recency. So primacy tends to dominate, but both are there if you compute that. And then the fourth and fifth row basically capture this new element, this numerical similarity, and it's also there. Now, the New York Fed data tell you basically the same story. Strong evidence for all the three memory effects. And I should probably at this point also add that, what do these numbers mean, right? Basically, all the three elements are there, and they sort of have the same economic magnitude if you multiply them with standard deviations in these data sets for these time horizons. Now, perhaps somewhat more interesting for the particular audience today is a medium horizon, expectations over 24 and 36 months. You can run the same regressions and you see the same free memory effects at play, but there is a key difference here from the very short-term inflation expectations, which is that the similarity with mean inflation rate tend to be statistically more important than the similarity with the current rate. So that's the one line, the fourth line, where we look at the similarity with respect to the average rather than the fifth line where we have contemporaneous pi t. So this suggests perhaps that long-term or medium-term inflation expectations are shaped by same period experiences. So different cohorts might have different medium targets. I think you can also think about the density forecast, and I have sort of two propositions here. So the first one relates to the odds of one particular event versus another, and that event relative to some frequency of experiencing it, so the nk, and some midpoints, high k, basically gives you a very similar set of results relative to the first proposition. The only difference is everything is in relative terms now because you have a base here. So particularly, the first term just tells you that the odds of a particular event increase in their relative frequency, the nj ratio. Then there's a relative temporal context, and there's a relative similarity effect. But there's one interesting new element here, which is basically that there's an amplifying effect from the interaction with this relative experience frequency. So if you, for example, go from 2 to 10% inflation, the probability of high inflation should go up for everybody, but obviously it should go up more if you have lived through more of these experiences. Right? This is why this nj over nb multiplies these other terms. That's what this is saying. So I think this really emphasizes the key mechanism due to selective recall. Elicitation of a particular event itself really helps think about this event, stimulating retrieval and the recall probabilities. Don't have that much time, so let me just say, if you take this to the data, based on this beautiful New York Fed density forecast data, basically all the three memory effects pan out, and also in relative terms. You have this basic relative experience effect, the U-shaped relative temporal context, and again, the numerical similarity. So now thinking about the density forecast also leads you to another testable proposition, which emphasizes that really different elicitations are systematically inconsistent. And I think it's something where our paper sort of has gravitated towards over time. So to understand it, think about an elicited point forecast as a weighted density-based average. So your expectation is basically the product of the weights you place on one of these buckets, and then the range J expected value, which itself is computed from the subjective probability that you attach to that bucket times that bucket's midpoint or some other measure of the bucket. And the rational model, the weight should all be 1, but this is not true with selective memory, especially if you forget certain ranges when you form point expectations, because you're not reminded of them, right? So in fact, we can show that the point forecast, so it'll be the third testable proposition, are above the density in a systematic way if your experiences tend to be more similar to high inflation ranges. So your point expectation is equal to your density-based expectation plus this extra term in the second row. So that term exists if the sigma, the strength of similarity, is not 0. So similarity plays a key role in here. And then the sign depends on the difference between the distance of that range to average experience inflation. So that's the DJ. And then the average of all of these, of all the different ranges that you have. That's usually positive if for higher inflation experiences, you are more similar to the average experience distance. And I think the one prediction here is also that if you move into higher inflation, then this term can sort of the two expectations here become a little bit closer, right? Because due to selective recall, you're going to overweight these higher inflation buckets. So the density-based expectation is going to shoot up, but the second term is a little bit more slow-moving because it's attached to some averages. Average experiences. Let me just leave it at that. So I think this really emphasizes this key mechanism of selective recall that introduces a systematic discrepancy across people with different experiences and also based on this changing Q. And obviously it seeks with other findings that, how you present questions and then ask about events affects the probabilities. So what's in the data? Well, in the data, elicited point forecasts tend to exceed the density-based forecast. So this is what this figure shows on the left. You see that the blue has more mass on the right, and this has a mean, also a median that's further to the right than the density-based distribution. And then the right figure shows you the two terms, the point forecast versus the density forecast means. And you see that there's a stunted sensitivity of the point forecast to the density ones, just like this proposition predicts. So there's an intercept at 0, but then this gap also narrows down as you move to higher density forecasts, which tend to occur when inflation is high. So this is exactly confirming this intuition that I just gave you. And I have to move on quickly. So let me give you a little bit more evidence that indeed there is a neglect of deflation and an overweighting of high inflation in the microdata, which speaks to this key mechanism. And I'm going to do this in 2 steps. So first, I'm going to regress household point forecasts on the same household's estimated probability of different ranges. And in a rational model, the coefficient should be close to the midpoints that you attach in this integration. And like I emphasized, under a selective memory model, right, the coefficient might be smaller in magnitude, especially if this range is neglected when you form the point forecast and vice versa. So this gives you this difference. So here I'm just showing you with or without fixed effects sort of these results. And again, don't look at the details. I think what this table tells you is that the pattern of coefficients is consistent with the selective recall model. So you sort of look maybe at the the buckets around 0 and above and below, and you see that you don't really see that the midpoints come out as the estimated coefficients, right? So households actually tend to overweight the high inflation ranges. And at the same time, deflation ranges bear non-significant or even positive coefficients. So that really means if you put more weight on one of these lower buckets, you're actually increasing expected inflation, right? So, but that's also not significant. But clearly, there's some violation of rationality going on. And in this table, I test systematically this proposition that I showed you, regressing point expectations on the density-based mean plus this extra term that accounts for the difference, sort of different configurations, and very clear systematic similarity-based bias emerges here, meaning this extra term plays a significant role. So if you look at the first row, the coefficient on the forecast mean, you see, yeah, sure, the density-based mean has a coefficient that goes up once you control it properly for the second term. And then there's also a positive sign on similarity, which is exactly in line with the model. Last 2 minutes or so, let me give you 2 more slides where I speak to the quantitative importance of selective recall to account for what we actually saw in the data, right? Inflation goes up, and does so differently for different cohorts. And then we can also throw another test at the validity of that model. So this slide basically shows you that the anchoring of inflation expectations really needs similarity. So this figure has two panels. The left panel is basically the predicted values from our model by different cohorts. And the right panel takes sort of the workhorse model, the Malmendian-Nagel model, and does the same. And you see that from the left panel, state-dependent cues really play an important role for the de-anchoring, especially for the old. So this is the orange line shooting up when inflation becomes more salient. Whereas by contrast, this experience-based learning does really well, as we know, right, in capturing cohort differences. But it doesn't quite, in absolute terms, right, this is all normalized to 1 in the beginning, capture the magnitude of the changes that we see here. So I think what this says is we need to combine this idea of slow-moving databases with time-varying cues and selective recall to get sort of both the levels and the instability right. And my last slide here to argue for the validity of the model is, we do this nowcasting exercise, where we find, again, support for the selective memory model. So what do? We take our basic estimated model up to some point in the middle of 2022, when inflation actually peaked, and then we just put the population constant, right, or the age distribution, and we feed in at each point in time the Q, the inflation Qs, and we can compare the realized with the predicted expectations, and you can see that in our model, that's the solid red line on top. We sort of get both the de-anchoring and sort of the re-anchoring of inflation, right, in terms of dynamics, while the more conventional experience effect models with a slow-moving database just can't really do that. To conclude in my overtime, I think I try to argue that these laws of recall are highly relevant for belief formation, especially because expectations are not rational, but they're also not mechanically adaptive. There's clear interaction of experiences and cues. There are potentially many policy implications. So, for example, policy shapes your memory database, but also realized inflation and any act of communication is also be in memory, right? It's going to be a cue at the same time. So I think there's this rich food for thought.
Thank you very much, Raphael. Our discussant will be Lena Dreger, who will be joining us online.
Hi, thanks for allowing me to do this online really spontaneously. Let me just share my slides quickly. All right. Yeah, that seems to be working great. So yes, thanks to the organizers for asking me to think about this really interesting paper. I will just summarize it very briefly and then talk about my thoughts on it. So as we just heard in Raphael's presentation, what the authors propose is a model with selective memory cues driving the formation of inflation expectations, where expectations depend on the database that in their example depends on age mainly, as well as on cues for recent inflation, and that depend on the period that we're in, as well as current inflation, and the type of forecasting task that people have to do when we measure expectations. And then there's this interaction between the database and the cue, where we have, for instance, primacy effects, where the cue triggers early memories, or recency effects when the cue triggers recent experience, as well as numerical similarity effects when past inflation experience that are close to current inflation are easier to recall. And as Raphael just showed, this can explain some features in survey data of households' inflation expectations, such as the faster increase of older cohorts inflation expectations during the recent inflation surge, and the fact that then younger cohorts caught up quickly and also raised their forecasts. And it can also explain some of the differences that we see between point forecasts and density forecasts. And the authors explain the difference by the fact that the density forecasts remind people of the fact that there can also be deflation, and then this lowest average forecasts. So when I read this model, I thought about the database first. And I think that this is a really relevant part of what we should think about in terms of inflation expectations. And I totally agree that databases differ, of course, across age cohorts. But I think they can also differ according to other characteristics that might be relevant and that could maybe make this an even broader idea to think about. So for instance, education or literacy is, as we know, a really important driver of inflation expectations and affects kind of the personal database in the sense that how well does an individual actually understand what inflation is and is able to then correctly remember it. So even people from the same age cohorts might have different databases in that sense. Another important factor could be the personal inflation rate. So we know that experience inflation can vary across income, education, or age groups because of differences in consumption baskets. So then if you think about a personal database, perhaps we should consider that personal inflation rate as the benchmark and not average official inflation. And finally, perceptions of current aggregate inflation. So we measure these in some surveys, and we typically find that there is a difference between perceived and actual official inflation, and we often see a similar bias in perceptions than we do for expectations. And so if we take those perceptions as the relevant database, we still see similar effects from the model perspective as well as in the data. And just to illustrate this a little bit, I took the University of Michigan survey data and just did some graphs here for the age groups that are in the paper, and then comparing that with education, for instance. And you see that there is a similar pattern when inflation rises. So higher education groups, they increase their expectations faster. But then there's something else that emerges, which I also find interesting in the sense that when inflation then decreases again, so in this disinflation period, there's this large heterogeneity that emerges between the education groups. And perhaps that is because not all of them updated their database to the fact that inflation was going down again. In terms of personal inflation rates, these are calculated personal inflation rates from the ECB consumer expectation survey based on spending shares that people give in the survey and then the relevant cocoa price indices. And we see here for age as well as income and education groups that there are these differences in terms of experience inflation during the recent surge between the groups. So different to what the US data seems to suggest here, older cohorts experienced a stronger inflation surge compared to younger cohorts. And similarly for the low income groups. And then also for education, we see these very striking differences, particularly at the peak. So that also could suggest that kind of the personal experience inflation differs across the same categories for which we find these differences in inflation expectations. And then just aggregating across everything, here we have inflation perceptions, and you see that it matches the perceived inflation rate quite closely during the search, but then people also on average did not perceive the disinflation and instead were more persistent in their inflation perceptions. The next comment I had was about this inconsistency between point and density forecasts. So in principle, I think these results are very plausible. They're also in line with another paper in the literature that shows that when we center the bins around individual point forecasts, that improves the consistency between the two types of forecasts, which goes in exactly the same direction as to the proposal by Raphael and co-authors. But I was wondering about this, two facts actually. So one, that there are these unbounded bins in the upper and lower categories, and then typically there is a number that is given, and then it says, I don't know, 16% or higher, or minus 16 and lower. So there's a numerical Q, but it's still an unbounded bin. And the question I had was how relevant this Q might be for during an inflation search. So usually we would be far away from these numbers, but then there was a period when we weren't that far away. And how that maybe links also to very high inflation point forecasts that we always have in this type of data, which typically get winsorized or truncated because we would think that these are not plausible. But then again, during an inflation search, they become perhaps more plausible. And where would we draw the line there? And what does this imply for this difference between these two types of forecasts? And then maybe related to that, the issue of forecast uncertainty. So typically we say, okay, in a point forecast, we just don't know the level of individual forecast uncertainty around that forecast, but then other authors like Carola Binder, for instance, have suggested that forecasts that are multiples of 5, for instance, point towards high individual forecast uncertainty in the sense that these people don't really have any idea and they just pick a number that is round. And when we look at density forecasts, of course, we can estimate individual point forecast uncertainty, but that can also be misleading because if a person puts 100% probability mass in one bin, this looks like she's extremely confident in her forecast, but it could also be that she just doesn't understand how this type of question works and she's actually very uncertain about her forecast. And then how can we distinguish that from a person that puts the same probability in all the bins, which would also then be recognized as a very uncertain forecast? So I think a robustness check that could account for that to some extent would be by taking the people in these spikes at multiples of 5 that we can see also here in the data that the authors use, and their density forecast as well, take these out of the equation and then check again what the results tell us. And to see it just if we get the same result. And then finally, I was thinking about this selective memory model and rational inattention models that are often used to model kind of inattention, changes between inattention and attention. And so the rational inattention model would say that there is a higher incentive to be better informed about inflation when inflation becomes high and volatile, because then the cost of getting informed is lower than the benefit from being better informed. And that kind of implies a dynamic database in the sense that sometimes I'm attentive, sometimes I'm not, and also a strong kind of imprint of high inflation in that database, because those are the periods when I become better informed. But then, of course, in the rational inattention model, people endogenously choose when to pay attention, because there's always this cost-benefit analysis going on. Whereas in this model here, it's more of a psychological mechanism that is more unconscious or happens unconsciously. And so I think it might be really interesting to think about how this could interact, or how the two models might be combined, that there is an aspect of conscious endogenous attention, and then also these unconscious mechanism ongoing. So yeah, that's it for me in some great paper. Thanks again. And I look forward to seeing you all in person next time.
Thank you, Lena. We'll collect a few questions on the floor. Yeah, Benoit.
Yes, so in some sense, your result is very, and in this room, I can't help making the link, is very consistent with Otmar Singh's view of the credibility of central banks. You know, there's no such thing as a track record. So basically, if you go through a long period of inflation stability at the aggregate level, so you may have this disaggregated differences and heterogeneity in experience because individuals have different baskets. But you know, the longer you go through a period of inflation stability, the more likely it is that people will not pick up, the inflation expectation will not pick up when they experience inflation. So that's basically, to a large extent, having had a short-lived inflation cycle after COVID and the Russian invasion of Ukraine, was a dividend of this long stability. But by the same token, now, I mean, are you running, or can you run experiment of, how fast it would take using your model? And, what, for instance, we have this a great natural experiment, or natural quote unquote, of tariffs. And this is going to increase inflation in the US, with reasonable estimates of how much this would increase. Can you forecast, the disanchoring of inflation expectations that your model would suggest?
Thank you. No, also along the line of showing ignorance on this type of mechanism, but I was wondering, I was struck by the specific functional form that you postulate based on this, cognitive theories. I was wondering, is this an approximation of some more general form, or how robust is this? Is this the only way? These distances or the cues from the experience, is this the only existing theory of this kind of expectations formation in the psychology literature? And perhaps along the lines of what Benoit just mentioned, so how should we use these mechanisms within a model, within a framework that we would normally use in general equilibrium?
Thank you very much for this excellent paper and the really thorough discussion afterwards, Lena. One of the points you made was around, the personal experienced inflation rate, because of potentially different consumption bundles that different people have. And I'd just like to add to that, if I may, please, that it may, you can get this even without different consumption bundles, because the personal inflation rates, they also can depend on or be a function of the price point. And this is one thing that we've seen by looking at the micro data set underlying the UK's HICP, where especially for food prices over the recent inflation surge, you saw a compression in that distribution coming from the left, i.e. with cheaper prices, products that started with the cheaper price level exhibiting higher inflation rates than the sort of the more expensive alternatives of those same quick products. Thank you.
One last question. There is one. Rafael?
Yeah, so let me answer these excellent questions and the great discussion. So thank you, Lena. Let me maybe start with the questions, so which I might be able to recall more easily. So thanks, Benoit, for this excellent comment. I think I agree. I don't think we'll ever step into the same river twice, right? So it's very interesting to see it's another test of basically this selective recall model right now, right? If inflation goes up more in the UK, the young are not the same as the young that we had before the inflation surge. Well, you can have something similar in the rest of Europe, right? Or when you go down, so I think this is definitely true that you'll get different forecasts in some way. That there's lots of gifts that we have to test our theory right now, and particularly tariffs might be an interesting thing. You can also use potentially the simple nowcasting exercise that we have and just feed in what we have, keep the age structure constant, and see what this predicts, and then you get a little bit of a potentially different forecast than we get from other models. I think there's a lot of open questions also, right? So I think we just give sort of some food for thought here, and I think it takes a lot of a central bank perspective to develop this further. So these were excellent questions and suggestions, and I think you can potentially also run experiments to get a better gauge on this. So maybe we can talk more. I think this is really interesting. Now for the other question, I somewhat defer this to the more psychology experts on the team. I think it's also one of my comments for Elena. I think we try to make give a proof of concept that this can work, and this actually goes a long way, like the last two figures show. Certainly, there are different ways to pin down this similarity function. This the divergence. I think somewhere in the paper we actually have higher order terms for that. So to think of this some convexity in that. So I think that actually gets even somewhat stronger results. So definitely there's something to explore there. I don't, I think in terms of our more conventional models where we have, in contrast to this, more rational expectations, I think the main call would be to incorporate some behavioral element and see how far that gets us. But I think that's very difficult, and some people in the room have worked on. So I think there's something to do there as well. We haven't taken that step. And I think that's a little bit related to Lena's comment too, right? There's different measures of time series we can look at in the memory database. It could be perceived, more personal experiences, and so on. I'm totally sympathetic to that. And again, I think we're just trying to prove there's this additional, this state-dependent element that we introduce through the selective recall that matters, and then we can apply this to any kind of objects you're interested in, any variable. I think this is a rather primitive way to do this. I think it goes surprisingly far. So you can also think about what cues people are looking at. You can encode them. I think there's a lot you can add to this vector. Again, similar to how you specify this divergence function. Now let me move on a little bit to the specific comments that you had, Lena. Thanks for the excellent discussion. Hopefully we can talk in person next time. I'm very sympathetic to everything you've said. For your first comment, I think, apologies if I repeat myself, I think we sort of give a proof of concept that this extra state-dependent element is just important in trying to understand what we have seen, right? Expectations were not sticky, and they were differentially moving, as we also saw from Christiana's work earlier, by different cohorts and kind of other cuts. So there's something there that, we don't explain with our more conventional approaches. Can swap in different elements here, right? Is it perceived inflation, or as I just said, we have some kind of fixed effects in different regressions, controlling for age, education. I think that doesn't speak to this differential speed. I think this is really interesting to explore. At some point, data is also a bit of a limit. For example, like the stuff you showed, the data series you showed from the Michigan survey, right? Like there's very few low education people, right? That's why I see a lot of noise. So I think there'll be some empirical trade-off, but I think central banks like the ECB are collecting really thick data, so we can do a lot of this stuff really well. So thanks for that. Yeah, and I'm very sympathetic to your other comments. The second comment, I think more broadly, I would say, as a call to arms to think a little bit about how we want to design our surveys. What goes in there? What's sort of you want to write a theory? What's the optimal way of elicit these beliefs? I think we don't say much here. We have some robustness in the paper, how we think about this. I think it really is important to think first what we want to use as a design to get at beliefs and sort of then put that in relation. So I think that's what I have to say. I should also say in more normal times, we sort of also get this inconsistency, right, which is sort of emphasizing the key mechanism. So I think this mechanism is really there. And then thanks for your final comment about inattention. I think there's actually some great work by Olli Poiti and co-authors where they sort of base the ways according to which we update on inattention, but also they relate this now to experiences. So there's the different layers of how you can see this, and it also gives you this differential dynamics. I think once you have information in any of these inattention models, you're more of a Bayesian person, right? And I think that just points to this new dimension that we add. There's still the selective recall that creates this inconsistency, and as a Bayesian updater, you should be consistent across how you use this information. So I think that's just something else we're adding that's important to understand expectations.
Thank you very much, Raphael. I think this concludes our first day of the conference. I think it's, we have a little break and then it's dinner time. I don't have details. Maybe somebody who knows the details can say something more, or we play it by ear otherwise. Thank you very much.